Tere hommikust. Good morning. How are we doing? Are we doing okay? I hope that, excellent, great. I hope that all of you have been able to catch some coffee or tea, a couple of snacks I've seen being enjoyed as well. Welcome to the Estonian FinTech Forum 2023. My name is Florian Marcus. I'll be your host for today. I'm an e-governance expert, but in the area of finance and so on, I'm still a bit green behind the ears. So we have plenty of panel discussions where you will have expert moderators for these particular discussions as well. In any event, I'm glad that you're joining us for a day packed of interesting discussions. You're joining us both here in person and also online, so there's a YouTube stream connected to this as well. We will learn a lot today, I think, certainly I will, about the status quo of the Estonian fintech ecosystem. We will discuss the some people would say thrilling, some people would say scary relationship between fintech, regulators, academics, cyber criminals, and also politicians across the Eurozone. Before we really get started with the nitty-gritty details, there's a bit of housekeeping that we should do before. We want to make sure that the FinTech Forum really builds proper dialogue. For that reason, all of the keynotes and panel discussions, with the exception of the introductory opening speech and remarks, we've tried to allot some time for questions from the audience. So unless people are going crazily over their time limit, which can sometimes happen, we have time allotted for questions. We've got the team that is ready with microphones. If you have a question, raise your arm at the end of the speech. Please wait until the microphone reaches you so that also the people joining us online can follow your interesting and important question. Later in the day, we will also use some public participation tool called Mentimeter. Some of you might be familiar with it. And you can share your thoughts on the event, the most important takeaways that you saw during the day as well. But I would say that's enough housekeeping from my side. Let's get the official part of this event started. Please welcome to the stage for his opening remarks the chairman of the Finantsinspektsioon, Mr. Kilvar Kessler. Welcome to the stage.
Yeah, it's a pleasure to be here. However, I walk, past this room on daily basis. But it's a pleasure anyway to see so many people here, and I hope very good discussions will come up. Anyway, to start, dear member of the Parliament, dear participants to the event, I'm very pleased to welcome you to the first Estonian FinTech Forum organized by Finantsinspektsioon. We have this conference here in the Iseseisvussaal, or Independence Hall, which is where the Republic of Estonia was declared in 1918. That was quite an innovation itself at the time. And I'm sure we all agree it was a very successful one. In context of business, for example, 10 unicorns founded by Estonians and/or Estonia in Estonia have taken the country to Europe's and maybe also to the world's top in number of unicorns per capita. As a warm-up for our discussions during the rest of the day, I would like to highlight 3 topics and make 3 arguments related to fintech. First, innovation and technological innovation have been always an intrinsic part of finance. I quite vividly remember my year in Boston almost 20 years ago. How I, as a Humphrey Fellow associated with the university, visited the trading room of one of the world's largest asset managers. A team of mathematicians and former athletes, and why this type of team, this is a different story which we can discuss during the coffee break. Former athletes were trading stocks the other side of the glass. Their fellow colleague suddenly whispered to me, "Soon traders will lose their job." This was because at the same time software wizards were programming the tools for algorithmic trading for the same asset manager. And this made the human brokers almost redundant. Algorithmic trading is now a household tool, and almost all the deals in bigger regulated markets are made by algorithms. A couple of years later, big data processing followed into other areas such as credit risk management and AML. And that was later followed by cloud computing. Nowadays, the whole Estonian banking industry is considered to be fintech banking, at least by SSM, because of its use of technology is so very much more extensive than in similar counterparts in the rest of Europe. A conclusion here is that technological innovation is heavily present in finance all the time. Consumer interfaces might be an outlier in this context, as they are still quite traditional because people tend to prefer familiar solutions when they are consuming financial services. Second, the financial industry is a people business, and the players there are quite competitive. I can take you back to a conference in Helsinki in 2015, almost 10 years ago. Several influential analysts estimated in their presentations that the Nordic banks would lose as much as a third of the market to fintech companies in the coming 3 to 5 years. They worried that such a trend could be even a threat to financial stability. Fast forward to the end of 2023, today, and the banks are still operational and are earning well, some of them using more modern technology, while some have acquired fintechs to let them achieve that. Some big techs have attempted to launch digital currencies, but they have been blocked by governments. What is the conclusion here? Finance is a business that is tightly bound to the overall economy and overall well-being of people. It is a careful industry that must pay due consideration to different interests, fears, and also opportunities. Today's financiers seem to have quite good skills here. Third, to facilitate innovation in financial markets, you have got to have working plumbing. Enough of cold Helsinki or Tallinn, let's go to Caribbean now, and to the Bahamas at the end of 2022. Well-known crypto king is arrested and charged with fraud. Less than a year later, a trial court in New York has found him guilty as charged. This complex case was resolved in less than 1 year. Signal was sent to industry and society that no fraudster should mess with our money. Just a reminder, in finance we handle the present and future of households and businesses. A bank is not a factory making running shoes that can go bust and nobody even blinks an eye, except of course owners and employees. If a bank or any other financial intermediary fails, a smaller or larger number of our friends and family may lose their life savings and might be exposed to risks they had assumed were covered. Such an event may affect the whole texture of economy and society. This means the right incentive structure for innovation and risk-taking has to be in place. While competition and the potential to earn profits will nurture innovation, fraud and other types of criminal threat to common funds must be dealt with decisively and swiftly. To conclude, fostering innovation has been on the agenda at Finantsinspektsioon since 2014. The current Finantsinspektsioon strategy states clearly that our priorities are to foster technologically novel business models and risk management tools, as well as to address technological risks. But I would dare to go even further and say that the drive to understand the business, the risks involved, and the mitigating mechanisms is in our bloodstream as part of our supervisory DNA. I wish you a successful conference. Thank you.
Thank you very much. For the first keynote of the day, we figured it would be a good idea to sort of situate the nature of fintechs in the wider global context. For this purpose with us, we've got Lars Hornuf, who's a professor of finance at the Technical University of Dresden. He is asking very intriguing questions that I would say many of us have already wondered about in the past. The first one we've already heard being touched upon in the opening remarks. Are fintechs good or bad for traditional finance? What makes a successful fintech? I mean, we've seen some successful stories. We've also seen some big failures over the last couple of years. And then also looking at AI, for example, what impact can ChatGPT have on the industry? But as opposed to most of us wondering these questions during our breakfast or morning shower, Professor Hornuf is also a globally leading academic, so he has the time and the brain to get the answers for us. So let's welcome him to the stage and see what he has to tell us about the nature of fintech. Thank you very much. Let's welcome him to the stage.
Yeah, thank you very much. I hope I have the brain to answer the question, or actually I wish I would have the brain to answer the questions, but at least I will try my best to give you a good answer. So actually, why did I come up with the question, what works in fintech? Because I thought it's interesting to answer the question, right? And then I thought, well, this is actually a very difficult question to answer, so how should I know what works in fintech? And then I remembered that I wrote a lot of academic papers about it, so I would like to tell you a bit about it. So if you think about what works in fintech, you actually have to make a more structured decision, right? You first have to think about, do you mean what works in fintech in terms of how can you attract fintechs to your jurisdiction? Or do you mean, as we just discussed, right, what works in fintech in terms of what works in order to have these firms survive? Or third, what works for these firms, right? Yesterday night we had a very nice dinner and we discussed actually what can you do to make a fintech successful in the eyes of the customer. And since I know there are a lot of, on the one hand, regulators, but on the other hand, startups, I will actually focus on the last part, right? I mean, that might be most interesting for you guys. So let me start with what works in fintech at the state level. So how can states encourage more fintech startups in their jurisdiction? So Marie-Liz, who invited me here, actually told me that I shouldn't come up with too many statistics and too many regression analyses, so I only give you the most important insights on one slide on this paper. But if you want to see the details, you can actually scan the QR code and just download the entire study. Everything is open access. Okay, so what did we do? So we collected data on around 100 countries and more than 7,000 fintechs all around the world. So this study is very broad, right? It's broadly applicable. It might not be very causal, but actually it tells you a lot about what's going on. Okay, and we got the data from 2005 to 2015, and the first most important insight was the following. Well, we saw that there was a big upsurge in fintech following the financial crisis. Again, there's no causality, right? It just tells you that what we found was there were twice as many fintech startup formations in 2011 as compared to 2008. But then in 2014, actually the numbers started to decline again. Okay, so what are the factors that are important for a fintech to come to a country and to get started? And actually, there's not so much new, right? If you look at the most important factors, actually, first of all, we thought about, is it the developing countries that get fintech, or is it actually Kenya coming up with M-Pesa and so on, right? And then we realized, well, it's actually a more developed country, GDP per capita, strength of legal rights, regulation, having enough labor force which is well educated, were all important factors to attract fintechs and have fintech formations in your respective country, on average, right? And then the second thing we realized is that, of course, once you got seed finance, right, all the startups know that if you want to grow, you need venture capital financing. If you don't have that, right, it doesn't work for you. What else? Well, the infrastructure must be in place. You need telephone subscriptions in order to do it, right? Must not necessarily be a smartphone. A telephone might be enough, as we have seen in the case of M-Pesa, for instance. And you also need secure internet servers. And again, so the red color coding doesn't mean that it's not significant or relevant, but actually, if you have a bad access to loans, that's good for fintechs, right? Because they will take up the market, and we are not the only one finding that. Okay, so far, not much new, I would say. So the next thing we ask, well, is fintech actually good or bad for the traditional financial sector, right? That's more interesting, I think. So we thought, if you have more fintechs, would that make banks and traditional financial institutions more efficient, or will they actually become less efficient and leave out the market? Or will they take more risk, for example? So that's what we answered in the next paper. And what we did, again, we had to collect a lot of data. It took years and years to collect all the data. And then we got data on more than 6,000 financial institutions from more than 80 countries. And we tested in empirical analyses what happens if you have 10 more fintechs formed in your respective country in a given year, right? If you have every year 10 more fintechs relative to the average, how would that turn out? And actually, it turned out quite well. It was good for the net interest margin of the banks. It was good for their return on assets, return on equity. It was also good for their annual stock returns. Obviously, these are not percentage points, right? It tells you that it's a percentage change, meaning if you had an annual stock return of 1%, then if you have 10 fintechs more, it would have been 1.6, okay? So not that you're confusing, right? That you're thinking 60% more annual stock returns, that would be great, but fintechs can't help with that. On the other hand, again, this is not bad, right? Actually, even though the color coding is red, it just tells you that there's a negative relationship. What is the negative relationship? Well, you can actually show if there are 10 more fintechs in the economy, this actually decreases stock volatility of the bank, and it also decreased systematic risk exposure in terms of the marginal expected shortfall. Okay, I think that was quite interesting, and to us it was actually surprising that fintechs had this kind of positive effect. Okay, so let's move from the state level to the firm level. Okay, what matters or what makes a fintech successful? And here again, we collect the data on almost 900 German fintechs. Why did we choose Germany? Because we could get hold of the data, and as we will see in the next presentation, it's very difficult actually to get hold of the data because fintechs are not that clearly defined, right? I mean, there are technology providers that provide financial services, and the other way around. Is that really a fintech or not? Is Facebook a fintech? Well, very difficult question. So we got the data for more than 20 years on almost 900 fintechs, and what we see is like, the background of the founders is decisive, surprise, surprise. But the thing is, it's not really that one background is sufficient. Well, and also not one background for one particular thing. So meaning, if you have a business degree or you had previous entrepreneurial experience, that actually has been shown to be good in obtaining BA, a business angel or venture capital financing. But it didn't help you with firm survival. It also didn't help you with being more innovative. So on the other hand, if you had a STEM background, being an engineer or technology, mathematics, science, then at least you filed more patents. It didn't mean that you actually obtained them, but you tried to be innovative in a certain way, namely by filing more patents. Moreover, if you had early third-party endorsements, meaning good networks, or if you were a subsidiary of a foreign company, that was good for your firm survival. And finally, we also checked what is if you have made statements on your website which were more B2B related, or you actually positioned yourself as a technology provider. Again, that was positive for your firm's survival. On the other hand, if you positioned yourself more in the traditional banking sector in terms of you did financing, asset management, and you said like you kind of reforming what they are already doing, this was actually bad for your firm's survival and also bad in terms of your innovation capacity. Okay, let's come to what matters for the investors. So the first question we asked was, because it's probably one of the most important questions of our time, right? I mean, do retail investors invest because they have true ESG preferences? Meaning that they have true inherent preferences to do something good for the environment? Or did they just believe it's more profitable to invest in ESG? They didn't care inherently about the ESG preferences. They just thought, if I invest in ESG, I will make a buck. Okay, so now we are almost only running experiments. So what did we do? Well, first of all, the problem here is that if you ask people, do you like green investments or do you think it's the right thing to do? Of course, what will they answer? They will say, sure, it's the thing we have to do, right? It's the right thing. It's like if I ask you, do you think we should support the poor? You say, yes, we have to support the poor. If I ask you, but then we have to tax you more, you will say, I don't know, right? So that's the problem with self-reporting and social desirability. If we ask people, do you like green stuff? They will for sure say, yes, investing in green is a good thing. Okay, so we will overcome this with the little experiment. And the next thing we did was we wanted to disentangle whether people have environmental preferences or social preferences. So it makes a difference whether you want to reduce carbon offsetting or whether you want to reduce carbon emissions, right? Or whether you don't want to have the people drown in little islands somewhere in the Pacific because the sea level is rising, okay? That's a different thing. So what did we do? Well, we collected data with the rocket platforms, Green Rocket and Home Rocket. 399 investors participated in the experiment. We got ethical approval for the study, and we also pre-registered all of our analyses we did later on. So that's pretty standard nowadays. So what did we do? Well, here you have one of these platforms. So this is Green Rocket, and you can see, you cannot read it, but I will tell you, it looks already green, right? So what they do is like they come up with real green innovation and startups and so on. And then, if you look at the descriptions, you see there's this reusable cups, but the whole idea about Green Rocket is that they do something green, right? And you should finance it as a crowd investor. Okay, on the other hand, they have the Home Rocket platform, and that one is not about green at all. So the Home Rocket platform actually only gives you investments in real estate, but it's not that the real estate has been transformed in an ecological manner or something like this. So it's a purely investment type of investment, right? Also, if you look at the description, right, they don't say like we use environmental standards in order to do it. So it was a real investment case. So how can we find out about the true preferences, right? We didn't want to ask people, do you like the green stuff? Then they would have said, yeah, for sure, I like it. So we asked them the following. Would you rather have a 25 euro voucher for the Home Rocket platform, which means there's no green component at all, right? I mean, it only gives you an additional return. And it's quite high, right? I mean, if you wanted to make a 100 euro investment, now you only have to invest 75 euros. Getting 25 is almost a 33% expected return, right? So that's not too bad. Or would you rather have us to donate money? And we offered to donate money for Greenpeace, carbon offsetting, or the International Red Cross. And now you can think about it yourself. What would you do, right? I mean, if you get the choice, would you take the 25 euro voucher? Or would you have us donate the money somewhere else? So if you're a really green and social person, right, you would accept a very low number in terms of donations to carbon offsetting, right? So if you're a really green person, a little donation would be fine for you. But if you're not so green and you think like, the return is more important to me, you need a very high donation to offset the 25 euro voucher. So this is actually how we can elicit whether people have green preferences or not. Okay, so we gave them the choice and we told them, would you rather have the 25 euro voucher or 1 euro donation or 25 euro voucher or 2 euro donation? And in order to make it not that boring, right, they didn't have to go through all of the numbers. We just asked them, at which line would you actually switch? When would you forego the 25 euro voucher, the real investment return, for the donation in a good course? So we know where the cutoff is, right? So that's very interesting. We did Greenpeace and we did the CO2 reductions because not everyone likes Greenpeace, right? So for that reason, CO2 reduction was more neutral and the social purpose was the Red Cross. Okay, so we have this measure, willingness to accept the green donation, and we have the other measure, willingness to accept the Red Cross. And as I just said, the lower the willingness to accept this donation, the higher must be your environmental preferences. So we sent out an email to more than 4,000 investors in 2021. We only got people who have invested before, so we wanted to have the real investors on the platform, not only people hanging around there like me as an academic, right? And then we got 399 people actually participating, which is a participation rate of 8%. So were these the more altruistic people and so on, were they different from all the other people? No, actually not. We could check like the people who participated were the same gender, same age, and so on. They also came for the green platform in the same percentage as all the other guys. So they were not special in a sense. Okay, so here's the first result. So a little bit of statistics. So this is a density function. So it tells you, a cumulative density function actually. So what it tells you is like if you start here on the left-hand side, you see here, these are the donations, €1 to up to €50 that would be acceptable to investors. And you see 13% of the investors give up a higher return, that is the voucher, for any kind of impact, right? They would say, if I only get €1 donated to Greenpeace, that's fine for me, right? I don't want to have the €25 voucher. And then on the other hand, you have like these 25%, there you have to give a very high return in order that they, very high impact in order that they give up the return. So it means like they would never give up the €25 voucher for any kind of impact we give them, right? I mean, it must be more than €50. But what is interesting is like in between, and that might be interesting for the startups, right? I mean, it really matters of how big the impact is to the investor, right? I mean, it's not that they're saying like, there's greenwashing. If there's a little bit of green on it, that's fine for me. Like, let's put a little stamp on it, and I accept that as an investment, right? They want to see how big the impact is that you're making with your investment. Okay, that holds for the green stuff, and it holds for the social stuff as well. Okay, a little bit more of statistics. You don't have to understand the statistics. I will walk you through them. So what does it mean? So what we want to explain is the share of investments people actually made in their portfolio. So we know their portfolio composition in terms of green investments, right? Can we explain it with their green preferences? Well, actually we can, right? So there's a statistical effect throughout, and it tells you that, if you had a true preference for green, so if you were willing to accept a lower donation to a green cause, right, then you in fact had previously already a higher share of your investments in green assets. So your intrinsic green preferences did play a role. The next thing is, like, we asked them, do you think that green assets are more profitable, as profitable, or less profitable than other assets? Well, as a finance professor, I can tell you an expectation they shouldn't be more profitable, but at least not in the long run. But what you can see is that those people who believed that they are more profitable had a more than 20% higher share of green investments in their portfolio. So the belief that they are more profitable actually made people invest in that. Okay, so it doesn't only hold for those people in general in our sample, it also holds for those people who never joined a green platform. So meaning that they didn't go for Green Rocket, they might have come for the real estate platform. So even those more conservative investors, as you want to say, like even for them, both factors played a role. The belief that it's more profitable and the intrinsic environmental preferences. Again, like as a poor university, we could only spend €50 as a max, right? So if we had different funding, we could have done differently. But what we see is like, those people who said like, if you donate more than €50, I might change my mind and I would go for the environmental course. But you can see that those guys who said like, you need to make a really big donation for environmental course, then I would actually change my portfolio composition. Well, they actually had also a 43% lower share of green assets in their portfolio, so which is consistent. Finally, for the red cross, you see that the social impact didn't play a role for them at all, like not in their investment decisions. So it didn't change their share of green investments. And I will tell you what it means. So the first thing, what it means is like, we have actually very equal elasticity, meaning that you have a share of green projects of 1% more in your portfolio if you would be willing to forego more or less a €1 in smaller donations in green stuff, right? So meaning that if I go from €50 donations for Greenpeace down to 1 for one investor, it would mean that they have a 50% higher share of ESG in their portfolio. What else? Well, 20% higher share of green assets if you believe that they are more profitable. I told you that before. I also told you that the more conventional investors, you see the same effect, even though the effect size is a bit smaller. But finally, we also observed that investors behave as if their green investments do not have a social impact. So what does it mean? Well, it means like they invest as if investing in green doesn't affect the people living on the islands that potentially drown because of climate change. So that doesn't matter to them, right? It matters to them that CO2 is reduced. So that's important to them, apparently. So we also asked them, like we gave them a simple survey question just to make sure that our experiment has worked. And actually, here's what you see. So on the right-hand side, you see what is very important to them, fairly important to them, not important to them. You see, again, a higher interest rate in terms of the return is very important for them. Environmental impact is very important to them, right? They receive previous funding as a signal is very important to them. But what you can see is like the measures that venture capitalists would actually use, are the founders any good? Did they already have a marketable product? For crowd investors, it didn't really matter. Like a market already entered, didn't matter. Likeable of founders, like if the founders are not so nice, it didn't really matter to them. Then we asked them, why do you do crowdfunding? And that was very interesting to us because it showed the most important thing for them was, you can actually choose your own investment. So people said, I don't want to buy a big stock of a big index because you buy a big bunch of projects within this firm. What they wanted to do is they wanted to invest in a specific project. So they wanted to choose which project it is. So they're very self-determined, right? On the other hand, again, like venture capitalists, they would probably, that wouldn't be the most important thing for them. And then what is interesting is like there's a lot of literature saying like, why do you do crowdfunding, right? I mean, they say, well, this is because there's this community spirit, right? There are all these people in the crowd, they work together, and it's so nice, right? And then you can say, if you ask people like that others are doing crowdfunding too, like their family and friends, and you can actually observe that they do it too, didn't really matter to them. So that was not the most important point. So now the interesting question comes. How can you actually, now that we know that people have environmental preferences, how can you make them invest? How can you attract their attention, right? So what we did was, again, another experiment. We manipulated the newsletter on a different platform now, which was BetterVest. So we had 10 newsletters, and we sent them out to all of the investors. So BetterVest came up with their initial newsletter. We sent it out. We observed more than 50,000 clicks and investment decisions. And we wanted to know, did they click on the newsletter to get more information? And did they actually make the investment later on based on the newsletter? We gave them 3 treatments. So one was the original basement. So it was like what BetterVest would have written. The other one was we reframed it. We took out all the return information. We only put in the environmental information and said like, it's a very green project, blah, blah, blah. And then in the other treatment, we said like, we took out everything that was related to ecological stuff. We only took in the return information. You make so and so much return on this investment. Here's how it looks like. This was the first one, and it's probably too small for you, but here we're stating the UN development goals, the CO2 reduction savings, and so on. And here we are saying like, there's a return, and you get an advanced interest, and then we change the text so it would be purely ecological or purely return-oriented. Think about it. Would you think that makes a difference for investors? Well, it does. It makes a difference. So if you have the ecological treatment, this is a positive and significant effect. So it meant that if you had the ecological information, people clicked more often. But did they invest more often? No, they didn't invest more often. What we also found is like, first of all, with the ecological treatment, you saw 13% more clicks, so people got more information, didn't change their investment behavior. But older people, so above median people, so not judging anyone, right? Just saying in our sample above the median, you could see that actually investors click much more often, approximately 37% of the time than the control group, once they got the return information, right? Older people are more in for the return. And interestingly for us as well, maybe I'm too prejudiced, but women also clicked more for the return information. So they found it more interesting if we gave them a newsletter about the return information. Okay, so now if that didn't work, right, I mean, they got more attention, what does work? So then we run another experiment with the robo-advisor in Germany, and that actually worked quite well. So what did we do? It's actually just still running, but this is the first time we're presenting this. So we got almost 1,000 customers during the onboarding process, and we changed the onboarding process a bit. So what did we do? We gave them a default, which was green investments, and we gave them another default, which was non-green investments. And as you might think, right, as an economist, you might think, well, if people like chocolate ice cream more than vanilla, they will like it today and they will like it tomorrow. It doesn't matter to them, right? I mean, if you tick the box chocolate and they like vanilla, they will still go for vanilla, right? I mean, defaults shouldn't matter for them. But it mattered a big time, right? So here's how it looked like, right? I mean, it says like, how would you like to invest? The default could be classic or ESG in our treatments, right? The one or the other. and we could click foreign currencies, yes or no, emerging markets, yes or no, and then here are the results. And as you can see, it mattered big time. So if you can see, classic means the default option was classic, 20% invested in ESG. If the default option was already ESG, sustainability, then almost 50% invested in ESG, meaning that that's a 150% difference in percentage-wise, right, between the two. So the default make a big difference whether people are investing in ESG or not. Same holds for foreign currency and emerging markets. You can see with both slightly above and below 60% invested in foreign currencies or emerging markets if it was not the default. But if you made it the default, then you can see almost 100 or almost 90% invested in these stocks. So defaults matter a lot. Okay, so there's no keynote without talking about generative AI, right? So that's the last thing I'm going to do. So the question we raised here was, can GPT-4 provide financial advice? What did we do? Well, we know that retail investors often make costly mistakes. Financial advisors, oftentimes, they don't want to correct them because they have their own products, right? They want to support their own products for that reason. They give you some advice that might not be very helpful. And modern portfolio theory suggests that if you're very uninformed, what should you do? Just buy a big market portfolio as broad as you can. And if you're not able to rebalance, just try to hold it, right? And that's it. So, but GPT-4 and Gen AI in general is capable to use a lot of public information, right? So if someone should be able to give informed advice and potentially also less biased, it should be generative AI. Okay, so what did we do? We know there are all the regulatory guidelines, right? You have to take the individual circumstances of the client into account. So what we did was we generated 48 different accounts on GPT or profiles, as you want to say, of different individual investors. So we changed their risk capacity, investment horizon, 5 or 40 years, risk tolerance, high or low, ESG preferences, yes or no, and so on. And then we entered this text. I'm a 40-year-old and live in the United States. I'm investing for retirement over, for instance, 40-year horizon or 5-year horizon. And I have a high risk tolerance. Environmental aspects are not important to me or are important to me, and so on. So we did all the variations, and we want to say whether it changed the portfolio composition. So okay, we did this, and then again, you might not see it, but what it tells you is like, GPT gave you very precise financial advice. So it told you the portfolio composition, how much percentage points you should invest in which asset, and it also gave you an explanation why you should do it. That's very good because actually this will actually help to people accept the advice they got. So here's the portfolio composition for GPT, and what it tells you is that first of all, large percentage of stocks, which is good, right? A large equity share depending on your investment horizon. So if the investment horizon was longer, you got a larger equity share. There's a lot of domestic assets GPT-4 would recommend. And then we actually benchmarked it. So we said, like, what would a professional portfolio advisor in the US do that has around 50 billion under management? We generated the same profiles with the US robo-advisor and entered it. And we saw actually it was quite similar to what GPT did and what the robo-advisor did. No worries, the robo-advisor didn't use AI, so we checked that before. So what did we find? Well, most generally, the assets that have been recommended had the same geographical regions in GPT and the robo-advisor. We also found that they had more or less the same assets. Interestingly, GPT had a considerable home bias. So if you entered the US as a nation, then you would get a lot of US assets. If you entered Germany, the same would have happened. You would have a home bias for Germany in your assets with GPT. And it was much bigger than the robo-advisor. Like GPT recommended 80% of the total assets to be domestic. The robo-advisor recommended 47%, and the MSCI World would have been 60%. So in any way, GPT was a bit home biased, I would say. So what else? Portfolio suggestions were very sensitive to risk tolerance, but less sensitive to risk and investment horizon. And so what else we did was, that apparently doesn't appear right. But what it actually shows you is, or should show you, is that that we also calculate the returns and the risk and the Sharpe ratios. So what it means is that actually what we find is that the risk GPT is taking is a bit higher than the benchmark. So GPT is a bit risk-loving, but for that reason, it also slightly outperforms the benchmark. Okay. So yeah, for the highest risk profile, it had also an outperformance. And if you would have invested $100 in 2016, then actually you can see on the left hand, this is GPT performance for 4 profiles we generated. This is the robo-advisor. So the performance was quite similar. Like the macroeconomic shocks in the portfolios were absorbed quite similarly for both of them. So final thing we did, and that's the final thing of my talk, well, the GPT outperformed in terms of, on a risk-adjusted basis. Well, then you can actually see, so this is a factor model, so it has the 6 most common factors in here, so in alpha, whether there's outperformance or not. You can actually see, well, the outperformance is negative for GPT and for the big robo-advisor, while truth being told, the outperformance given that you consider all the 6 risk factors, right? I mean, the robo-advisor and GPT cannot outperform above and beyond the risk factors. So on a risk-adjusted basis, GPT is as good as a good financial robo-advisor in the US, and it has earned a negative alpha, but the robo-advisor didn't earn a positive alpha either. Okay. So what do we do out of this? So here comes my conclusion. First of all, on the state level, I would say not so much new, right? I mean, what matters is economic development, institutions, infrastructure. Whoever telling that, right? Estonia is doing pretty well in all of these things. Not surprisingly, they have a lot of fintechs on a per capita basis. But on the other hand, what I found interesting in the research is actually that fintechs are actually good on average for the financial sector, meaning good for risk and good for their performance. Second thing, what matters on the firm level? Well, founders and firm resources matter. Also, not that surprising, right? But on the other hand, what is interesting is that it takes the right mix, right? I mean, it's not that you should only have financial people. You should have STEM people, financial people, so you survive, you get funding, and you're innovative. And then invent something new, right? I mean, if you come up with the financial stuff that banks have doing for ages and you're trying to do a little bit new, right? I mean, that won't really help you to survive. What is better if you come up with any form of leap innovation? I mean, it's not easy to do, but obviously that would be the greatest thing you can do. Final thing, so investors apparently don't fully understand ESG, right? I mean, they believe it should outperform. Well, it shouldn't in the long run, it could in the short run. Nowadays, potentially almost everything is ESG, right? And then we find that generative AI can be a very cost-efficient solution for financial advice. And even for traditional financial institutions, I mean, they can simply put it in the background, right, and still give financial advice. We found it worked pretty well, right, on a general basis. And it will probably work even better in the future. And if you want to do any experiments, please let me know. And if you're still looking for a Christmas present, I have a couple of suggestions for you. Thanks very much.
Thank you very much. Yeah, if you haven't found any good Christmas presents for your children, you can always go for diginomics research perspectives. We have a couple of minutes if we have questions in the audience. We have a lovely colleague with a microphone. Yes, please, over there, the gentleman here in the front. Yes.
Hi, yes, thank you. Thank you for an interesting presentation. Very insightful, very interesting results. I had a question on one of the earlier slides you had on fintech effects on traditional finance players. There was a result there that the net interest margin actually increased, what I understand, for traditional financial sector players. So what if we turn that around? What does that mean for the consumer? Does that mean that actually financial services become more expensive for the consumer when fintech activity is higher?
Yeah, good point. I can't make it back, so yeah, good point. I mean, yeah, that's a good question. I mean, potentially it could. I mean, it must not turn directly to more cost of the consumer, right? I mean, the bank could simply become more efficient and for that reason have a higher net interest margin, right? I mean, it would perfectly possible. But as I said before, these are very average effects, right? I mean, you could even have a couple of banks who transfer that onto their customers while others are not. Personally, I would think Probably it's not, because it indicates if there are more fintechs, there's potentially more competition, right? So I would expect, but I cannot prove it, that they became more efficient, and for that reason they have a higher net interest margin. But what you said, like, they could also transfer it on the consumer, but I don't know that.
Okay, thank you.
Yeah.
I mean, my takeaway from all of this was that I'm just going to put all my, get all my investment advice from ChatGPT now. So don't know why we're talking about any of this, but yeah, we've got one more question.
Yeah, thank you, Lars, for a very interesting lecture. I have one question regarding your result saying that fintechs are in general helpful for the financial sector. So what would you say that is important for the government to do to basically create more fintechs, create more startups, and basically facilitate innovation? Thank you.
Yeah, I think I'm sorry for that, but the answer is quite simple in a way. I mean, you should do what you should always have done as a good economy in a sense, right? I mean, you should have good institutions in place, right? I mean, it's easier said than done, right? I mean, if you have good rule of law, good regulation, you actually explain well what the regulation is, then fintechs will appreciate that, right? If you have good infrastructure, right, you can do your taxes and everything else, like in Estonia, right, all digital. Then that will certainly help to also come up with more fintechs and so on. And also apparently, if you do some financial advice such as asset management, right, more development apparently helps, right? I mean, there might be also fintechs that will be working in sub-Saharan Africa doing asset management, but to become big, it's better to go to developing countries.
That was a beautifully short answer. I know you looked at the time tracker as well, and both being Germans on stage, it was clear that we were going to finish on time. Let's put our hands together one more time. Thank you very much to Lars.
Thanks.
Before we head to the first panel of the day, we're going to have one more keynote, and that will be about the country that we, or at least the physical audience here in this room, are currently situated in. So Estonia obviously is a home to a thriving startup ecosystem. It's already been mentioned. There are seasoned investors that have years of experience. There's a globally leading e-government environment that sort of helps prop all of that up. And the founders who know that while Estonia is a good test bed, they also understand that Estonia is a very small market, so they're being pushed abroad almost immediately after inception. So it's really quite interesting. So it's an interesting case study, which is not just what some of us think, but also a research team from Tallinn University of Technology. And they've been thinking about that topic for a couple of years when they started their Estonian FinTech report. Here to share with us the findings of their latest third edition is Associate Professor Laidroo from TalTech. Please welcome her to the stage.
Thank you. Now, as said earlier, I will talk about the FinTech report, which is already a third report that we have prepared. We have done it in 2-year intervals. Of course, as already said in the previous presentation, there is always a question, what do we really mean when we talk about FinTech? In the context of this report, our objective has been to kind of define it maybe a bit broadly, but based on the European Banking Authority approach. So we are talking about financial innovations, which eventually have some kind of impact on financial markets, financial institutions, or for the provision of financial services. During this presentation, I will just go through some key points. So if you're more interested, you can Google and find the entire report in the web. But maybe one of the more interesting points of this report is everything related to the actual situation. So how many fintechs actually are in Estonia and what have been the developments in terms of their numbers. If we look at the history, then as you can see from this figure, we started off with 84 companies, which we were able to identify in 2018. And by now we are at 264. Now, when we talk about the fintechs in the context of this report, I'm referring to those companies which are registered in Estonia. And in most of the indicators we provide also in the report, we don't include any of the companies which operate in Estonia through a branch. So, for example, when we think about Monese or Wise, then they are not included in most of the statistics. And the reason being is that when trying to identify these companies, we need more background information, and the more information we can get, the better, and focusing on these registered companies is a bit better approach. Now, in terms of the number of fintechs, when you look at this figure, of course, you see that there has been like a deceleration in the growth rate over the years, especially compared to this 2020 report. But it is a bit misleading in a sense that there is actually a lot of activity going on. So during this 2-year period, we had over 100 newcomers entering the market, and then at the same time, we had 77 companies leaving our list. And when thinking about the reasons why these companies are no longer part of our research is either they have switched their activity, so we no longer kind of consider them truly as fintech company. There are many companies which have stopped their operations for different reasons. It may be that they just have decided to close their business. In some cases, it is something which is followed after they have lost the license that they need for a specific activity, so there can be different reasons. Now, when we look at the statistics, then in terms of the size of the market, the companies which are registered in Estonia have 2,500 employees working in fintech. Of course, if we focus also on those companies which are operating here through branches, then we would say that the sector could be 2 times larger. In terms of financial statistics, one of the more reliable things we can focus on is the size of total assets, and it is close to 2.2 billion euros. And of course, if you compare it with the traditional financial market, then it's not really huge. But you also have to consider that the activity profile of these companies is a bit different. Now, in terms of the revenue, close to 400 million euros. And if we would include Wise with its global operations, then it could be like 3.5 times greater. So yeah, so there is a kind of, I think Estonians like to kind of emphasize that, yeah, these companies also are like Estonian companies, then yeah, we have like greater global impact in that case. And net profit positive. If you look at individual companies, then some companies clearly are earning losses. But there are quite many of them who are earning profits as well. And when thinking about these companies, they are on average 3 to 5 years old. And this is also reflecting the fact that when we compile this list of companies, there is a higher likelihood that we capture a bit older companies, because when startups are established, then during the early years, there is not so much activity going on, there is not as much information available about their activity, and therefore we very often cannot say whether this company actually is a fintech. So it may take a couple of years until they are captured in our list. Now, in terms of the activities of fintech companies, very similarly to the definition of fintech, there is no kind of agreed framework for categorizing different fintechs. The approach that we use in this report is based on the classification system which has been developed over the years by the Cambridge Alternative Center for Alternative Finance. Those of you who are really interested can actually have a look at their website, and they have a lot of different reports where they try to capture the fintech sector also globally using rather similar categorization. So our categorization more or less resembles theirs. There are some slight differences. For example, we don't include in our list any companies which are focusing on accounting solutions, because in their categorization, actually, these companies are also included. Now, when you look at these bars, you see immediately that is rather colorful. So different types of companies here. Actually, 73% of them are in 4 main categories. And the biggest category is the digital asset exchange. What may seem maybe a bit surprising to those who are really familiar with local circumstances is that the fact that their share has increased is a bit peculiar, but it is related to the way we have created the report. Because as we know, close to 2020, we had a huge number of companies appearing who had virtual so they had the licenses to provide virtual currency services. But what we did back in 2020 was that we were really critical in terms of what kinds of companies we included. So most of these newcomers were never in our list, meaning that most of them who have now lost the licenses are also not included. So instead, I think what we captured with this 2022 numbers was that maybe we missed some of these companies who were already existing in 2020, which just weren't in our sample. And of course, if you look at these other different types of activities which are there, then we can say that there are a lot of companies in digital lending, enterprise technology, provisioning, and also digital payments. Now, their proportion has more or less remained the same. And I think that what is really positive, if you look at this figure, is that there are so many different types of fintechs actually operating in Estonia, and especially considering the small size of the country, I think it's a rather kind of good result. And if you're more interested in what types of fintechs have been categorized under which category, then you can have a look at the report where you also find this map. Of course, when looking at it, you have to consider that it is an arbitrary decision where to place which company, and in our categorization, one company can be only in one category. So if the company is involved in different activities, then it is a question of judgment, so where we put it. Now, in the second part of the survey, we have always tried to get some kind of insight also from the companies themselves. And this time we were able to obtain 33 responses, which basically means that 13% was the response rate. But I would say that considering that in all these survey rounds, the companies who tend to be more active are also more active business-wise, then maybe it captures rather well what the sector thinks. Now, in terms of the location choices, this was also the topic which was touched upon previously. The companies which already operate in Estonia, when we ask why they decided to start up the business here, you get really ordinary responses. So it's just easy to establish a company here, and there's a good quality infrastructure, reputation of Estonia, and of course, considering that many of the fintech entrepreneurs are also locals, then for them it's a kind of natural way to start a new business. So you have a good familiarity with the entrepreneurial environment. Also, regulatory clarity, availability of qualified workforce are very often mentioned. Now, although this sounds very good, there's always a question how long this decision holds. And during these reports, the last 2 ones, we have also tried to ask a question whether they have considered moving outside. In this report, we get a response that 1/3 of the respondents who actually respond to this question say that, yes, they have considered it. And when asking why, then, of course, what emerges quite strongly is the fact that you want to improve the access to customers, you want to gain additional credibility in the eyes of the customers. And these 2 reasons are really strongly related to the fact that you just find the Estonian market too small to continue. So if you grow, then at some point you have to think about how to expand your business. And in doing so, you may also think that maybe being located elsewhere has some additional benefits. Now, if we think about the regulatory restrictions, then This time, this was something which was brought up mainly by those companies who are working in areas where you need virtual asset service provider licensing, which maybe seem even quite natural considering that this area has been under pressure and there is new regulations coming in which may also have some impact on their activity. So this may be the reason why they are maybe a bit more critical. If we think about the outlook, then what the respondents really clearly state is that many of them expect either large growth or moderate growth in the number of employees. So despite the fact that economic conditions maybe are not the best, these companies are slowly growing. Of course, if we compare these percentages with those that we got 2 years ago, then there has been a somewhat decline here. So maybe a little bit less of the optimism. And in terms of the revenue trends, then 82% of the respondents actually say that they expect increase in revenue this year compared to the previous year. And taken together, it would mean that the revenue of those who responded could be in total 46% greater than last year, which I think is a rather good result. Now, thinking about the challenges, I would say that most of the challenges have remained the same, so nothing really new. So again, top one is finding customers. So how to really catch them. And as well, expansion to foreign markets, which are kind of interrelated. Now, economic conditions are also here, but what is interesting is that in this report, clearly, there is more concern over the access to finance and also the cost of labor, because in the previous reports, they were ranked a bit of less of an importance, which is, I guess, also reflecting the overall developments in the economy. You never get around of the regulatory issue when you ask fintechs what is going on. And this time it's also there, maybe not the top one. And again, when you look inside, then you find out that those who still remain more critical are the ones in digital asset exchange sector. So it tends to be more sector specific. Now, what could be the development areas? Cloud-based systems, Web3 environments, also support services. And when we asked the fintechs how the development of the sector could be speeded up, and then, as always, the first one which comes up is improving the regulatory environment. Now, more specific things which were mentioned in connection with that are related to the remote identification and online verification outside of the European Economic Area, which is really closely linked to how you can do your business. Additional licensing, and more from the perspective that it may provide some additional business opportunities for fintech companies. And what was mentioned here was actually, very specifically, was factoring. So this kind of idea. Also improving investment account system, multilingual regulatory environment, making debt collection faster, and creating a positive credit register. So some things which have appeared also in previous reports, so something not very new things appearing here. And of course, what you might expect, entrepreneurs care about taxes, so if you could have like a social tax ceiling, it would be really great. Now, one really interesting point, because in these previous reports, this cooperation with relevant authorities has been something which has been discussed really often. But I think that one of the greatest surprises for me when compiling this report was that when I looked at the way the relationship with regulators was described, it was significantly more positive than it used to be in the previous reports. So I would say that there are some signs that people may be a bit more open-minded in terms of communicating, maybe also cooperating in specific areas. So this may be something which benefits all the parties. And last but not least, what was mentioned there is the finalization of the Estonian FinTech strategy, which has been in a process for a very long time. So having a kind of more specific direction to where Estonian FinTech is going may be something that entrepreneurs would really appreciate. So thank you for your attention.
Thank you very much, Laivi. Do we have any questions from the audience? We have roughly 4 minutes left. I mean, that was a very clear and concise presentation. I think all the numbers are very, very clear and straightforward. Okay. In that case, thank you very much. Thank you very much, Laivi. Time does fly by, doesn't it? And it's already time for our first panel. The participants are gathering on stage to discuss the relationship between regulators and fintechs. I mean, we've already heard it in the report. We've already heard it in the previous keynotes as well. For this purpose, we have gathered fintech founders, regulators, researchers, all on one stage. I'm greatly looking forward to the discussion where I think we will see whether even the juxtaposition of regulators versus fintechs is even accurate anymore today. We've just heard about the strength in communication, the better feedback between the two sides. So the question is, does this old juxtaposition still hold water in a world where there are more than just two stakeholders? I think this is a very clear question. So here we go. We do have 45 minutes. We have Nõmm from the Finantsinspektsioon. We've got Andrus Lehtmets from the European Insurance and Occupational Pensions Authority. That's a mouthful. We have Egert Juuse from TalTech. We have Sokk from Lightyear, we've got Triin Hertmann from Grünfin, and to top it all off, we have Andrus Alber from Finora as our highly experienced moderator. Please welcome them and give them all a round of applause. Thank you.
Hello.
Sit here. No?
Oh. Yes, good morning, and thank you, Florian, for your kind introduction. I think the first two presenters put a very good background to our discussion. Professor Hornuf was saying that fintechs are good for financial sector as a general remark, and Professor Laidroo was saying that fintechs in Estonia are growing. So that puts a kind of positive network or background into our discussion. Although the assumption that Florian was saying that maybe there is not anymore the division between regulators and the fintechs, I'm afraid the end discussion will show that there is still quite a difference between the fintechs themselves and regulators. But indeed, we have a quite good mix between the people here, people from regulators, people from academia, people from startups. So as we are in the event that is organized by FSA, I first will ask the question to Andre, representing the organizers. So we know that we have across Europe free movement of capital and services, at least in theory. But we have very local regulators interpreting those rules and regulations. So is there, in your view, still a high entry barrier for fintechs or startups, or you see that actually all FSAs are interpreting the rules the same way, so it's actually very easy for startups to join in fintechs?
Thank you. Yeah, it's a very good question. I've been in this industry already 25 years, and the mutual recognition model has been always there. Yeah, I mean the passports, single passport in the European Union, and we still see a lot of differences between the countries and different approaches. What I mean in the financial industry, this is a very complex one. Yeah, I mean industry itself, market participants, regulations, different approaches from the supervision. What I mean here that in very complex systems there are still a lot of playground, and the financial capacity of the countries are very different. So I'm not very naive here that we will end, I mean, in the next 10 years, then there is a kind of flat approaches from every state. And I'm not even think that we necessarily need this, because I mean the competition between the countries, it's also good for the innovation. Otherwise, we are similar approaches in European Union. I think it's not good, and I really think that this kind of competition must be there. But what comes to the entry barrier, of course, it's a bit challenge for the small market like Estonia, for example, because if you look at the amount of the regulation. When I came to the industry 25 years, there was maybe only 100 pages of legal acts. Now we have 20,000, and how it usually works, you know, Innovator came into the FSA and welcome here. You have a good idea, but here we have 20,000 pages of regulations. And those regulations goes very technical. And my personal view is that maybe it's not good, yeah, because, I mean in the meaning of the innovation, because when we go too technical, we cement some legacy approaches, and there is no room, I mean, for the different, I mean, innovative approach sometimes. I have seen it, AML, for example, there are certain very specific rules, but maybe we need to invest in the technology to monitor better, I mean, all these transactions and so we have to be careful here. We have to find better balance, but this is my personal view, of course, and to move maybe more to the principle-based supervision again and the regulation. Let's see what comes from the digitalization. It's not easy to take all this rule book and put to the digital channels. It's quite a challenge. Yeah.
Thank you, Andre. Martin, you operate in different countries and jurisdictions. Have you seen that regulators in some countries are more cooperative than in others? Some are more innovative than the others? And maybe in the beginning you say a few words about what Lightyear is doing, because maybe some people in the audience don't know it.
Thank you for that. So I'm Martin. I established Lightyear roughly 3 years ago. And like the main point is to make a better investor. So we see that society would benefit greatly if people invest more, create wealth in a long-term perspective. And like, let's be clear, like it doesn't really make sense to only build it in Estonia, because Estonia has like a little bit more than 1 million people, but Europe has 500 million people. And that comes into the kind of our kind of approach. So we are trying to bring Lightyear into every single market in Europe. So today we are in 22 markets. Soon we're going to expand into the rest of the European Economic Area markets as well, plus UK now, you have to say that. And when we started this business, we had to make a choice, where do we make a regulatory kind of steps in one way or another. Today we are regulated in 2 places, one in the UK, another in Estonia. Totally different markets, but we went through also like Germany, BaFin, and various different European states, and there is a massive difference, I would say. So, and like this difference comes in from this smaller kind of ways you wouldn't expect. One is like what you can do, but it's also like the relationship with the regulator, because it's rather intimate kind of way how do you operate with, and it really matters if you are able to work with them properly, able to have like a clarity, able to move fast and whatnot. So I would say that like a simple view would be that if you go to Germany, like really recognizable regulator, but really slow. So if you want to do a startup, then this is actually hinders you quite a lot. Like you have almost no way to have a communication, your answers take way too long and so on and so on. If you are coming, I have to say that like Estonian regulator is like really fast and constructive. So like if you want to actually build a startup, like Estonia is a rather good place for that. There's some nuance around it. The nuance is that in the previous presentation, there was that Estonia has a strong brand, and a couple of lines below it was that people are considering moving out Estonia because brand is not that strong. So the credibility is not there. So again, coming back, like if you're going to do non-Estonian market and you say like, is it the BaFin or fee, then we are actually in a disadvantage in that sense. So Estonia, it's not that Estonia is bad, but Estonia is small. Nobody knows Estonia effectively, so you need to go fighting against that. So what I see is that this regulatory differences between the markets is actually really strong competitive advantage. If you have good protection, what we have for our customers, if you have a good clarity on the regulatory aspect, that like gets quite a bit better for establishing a startup, but then add on top of the things what other markets don't maybe have. So like for us, you can see that we are not competitive because, for example, our deposit guarantees are not there. So we are significantly weaker than the big markets in a way. So if we would change that, like a simple thing where like firms themselves pay for it, you will equalize the playing field or you make it better and like you're highly competitive. So I would say that the competitive is mostly like these boring things. Like I'm less interested of this kind of sexy new innovation. It's more about let's make sure that our regulatory aspects and customer protection and all that stuff is on the same or better level, and then we are actually like amazing place to build a startup. So.
Good to hear. Egert, in TalTech you have done research on fintech's innovation and so on. Have you also looked how innovative different regulators are in different countries, or can you at all do any academic research about regulatory innovation, or are we seeing that there is kind of a strive to lowest common denominator in the regulatory aspects?
Well, yeah, I mean, if you look at the international experience and what countries have done, how they have responded or taken a regulatory approach towards fintech, there are certainly differences. But I mean, in general, if we talk more broadly, we can kind of classify the approaches into 3 groups that countries have taken. As a regulator, you can, let's say, focus on the fintech-related activities directly. You can then adjust the regulatory perimeter around the services and the goods that are offered there on the market. But alternatively, you can also kind of focus on the, let's say, the use of specific technologies, right? You create the frameworks around the adoption and use of, you name it, I don't know, AI or API or cloud computing and so on and so forth, right? And finally, as a regulator, you can also kind of focus on enablers or facilitators that are supposed to support financial innovation more broadly. And here I think we can talk about like foundational elements like data protection or cybersecurity frameworks and even maybe national electronic ID system that are the backbone of digital financial services. And here we can also talk about, let's say, these innovation facilitators. So there are options whether you stick with a very simple point of contact that you accept a request by the fintechs and you respond like Finland has done, or you kind of advance to the, let's say, innovation hub format as we have done here in Estonia for more constructed dialogue, or you take the path of, I don't know, Lithuanians, Latvians, and elsewhere that you introduce regulatory sandboxes, right? But the question is, what you as a regulator do, or where you put an effort and the focus really depends on the priorities at the national level, your risk appetite, and I would say also the possibilities, especially in the context of the European Union, where to a large extent they prescribe what you cannot do and what you cannot do. So I think along these lines, we can see the differences how the countries approach to the financial innovation elsewhere and here.
Okay, thanks. Interesting point you brought out. I hope we will have time. The question of risk appetite of the country and innovation. So who should define it? Is it the politicians? Are the local FSA? Should there be some, I don't know, national assembly of all stakeholders defining it? I think it's an interesting topic where we hopefully will have time to discuss. But Andrus, you come from say European level, and Florian was nicely defining all what is behind EIOPA. The name, Occupational Pension Association and EU regulators on insurance and so on. So how do you feel and see, is there a general, let's say, honest wish to support innovation in financial services, or is it more of a aspect for headaches? Because as we saw from the FinTech report of TalTech, I think last couple of years have brought 6 or 8 new regulations that impact fintechs. Andre was saying that when he started as a young person in FSA, it was 100 regulations. Now there are 20,000 pages or 20,000 regulations. I don't remember which the number was. So is there a wish to support innovation, or more to make sure that innovation doesn't go too far? Let's regulate more.
Thank you for that, and thank you for the invitation to speak here today. I guess a lot of different questions in your one short question, but I guess maybe to zoom out a bit, and if we look it from the European level, then I guess data-driven innovation has been the core of this, and we looked at Europe somehow in cycles. So the one policy cycle is now going to end soon. It's, I guess, good to look back. And if you look at the priorities, then of course Europe fit for digital age. This has been one of the core priority of this commission. And this is really how to make technology work for consumers, but also stating our own rules. So not following somebody else, some other jurisdiction, but really to state our own rules and address this European sovereignty as well. And of course, this has impacted financial services a lot. The agenda has been quite intensive. So, and if you look at the different initiatives, of course, digital finance strategy came out stating 2020, stating how we should approach digitalization. I guess some of the aspects you, for example, mentioned the fragmentation, how to address this regulatory fragmentation, how to also incentivize information, but in innovation, but also how to mitigate the risks. So, and we saw MiCA coming out from there. We saw Digital Operational Resilient Act coming out from there. But also some of the enabling regulations. So we can mention here DLT pilot exercise, for example, which is a sort of sandbox type of quite a unique sandbox type of regulation, but also more recently Data Act, FIDA or Open Finance Framework. So you can see that it has been quite heavily in the agenda, and I guess the aim is really to make Europe a global digital player. How successful we will be on that, I guess it's too early to say. We can say it in the future, probably. Yeah.
Okay, thank you. Triin, you are in rather, I would say, innovative product offering or service offering. Do you see that regulations that exist are helping, supporting you to come to the market with a new solution, or you see that not regulators really understand how much your business needs to be regulated, and this creates more headache than support to you? And also, please say a few words what your company is doing.
Yes, thank you for inviting, and I really think that this type of events are a nice proof of how this dialogue has developed and how we both sides want to make the best of it. My company is providing asset management or portfolio management service for everybody who wants to invest as green as possible. So we want to do that analysis for our customers and provide the best available green ETFs in the world for their portfolios. We do it for retail customers, for small businesses, and also for employers. Our journey with our regulator has been rather like a good one. So let's say that it started off with us being in a very like in a dark, like how all these 20,000 regulations apply for us, and from there I can say that the difference between I've been previously working with UK regulator, where everything was very clear what was asked from the startup or from FinTech. So you either met the criteria or you didn't, and it was rather black and white. So you made yourself to meet the criteria, you got the checkbox done. But in Estonia, it was more of a journey. You never knew what comes from the next curve. But during that journey, we got to know each other, and I think it's for the benefit of both. But I understand that if you have investment firm license applications in Estonia, maybe you have 2 or 3 in a year, but in UK you have maybe 500, so you need to more, you cannot do that tailor-made approach there. Yes, for us, I think this cooperation is pretty well established. I think what was mentioned here before, the risk appetite of the country, I love that sentence. So I don't really realize what is it right now.
But who should define it in your view? Having been in UK, having in other countries, who should define it?
I think the government, in cooperation with all the market participants, should figure it out, and that actually defines what is the role of the government, the regulator, and how to approach the market participants. So, if the appetite is rather high, I would compare the government and the regulator like with a good leader. So as a manager, you can always, set the rules. You can say like what to do, what not to do, and mostly like punish and say that what you didn't do right. But you can also empower, and you can remove the obstacles, and you can always think big, and then you can see how your subordinates like really flourish, and that's where the benefits for the whole country comes from.
Andre, what is your view? Because you usually are expected to protect the consumers, the investors, maybe to have as least risk appetite as possible. So who, in your view, should define the risk appetite of the financial services?
Oh yeah, that's complicated. Yeah, of course, if we don't risk, I mean, as a supervisor, there is no innovation. That's true. I fully agree here, but first, coming back to the regulations, I don't think necessarily that regulations are bad. Let's take this famous banana case in Europe when 1994. I think we started to regulate bananas. The size, the shape, and everybody laughed. And there was a new article in one UK newspaper that now we have all kind of bananas. But the real problem here is that we all love pretty bananas, and that's good for the international trade, at least in the European Union, maybe even wider. We need strong institutions. We need regulations. Of course, we can what I touched before, that there is more maybe balanced way for the innovation, but and still we have a different roles as a supervisors, because it's not easy for the fintech, of course, to get the market, especially from the small fintechs, because the market concentration is so high because of the high cost of the compliance. But still we have different roles. It also has been challenged us because there's a lot of storytelling one side, and turn it to the license, turn it to the compliance, turn to the proper risk management. It's not easy to ask. And now I'm coming to the risk appetite you asked. Yeah, true. I think it should be government. Yeah, I'm very direct here. Because why I'm speaking like this, it's because it can't be only the supervisory authority in the country. Well, I'm responsible as a management member. Any decision what I do in FSA, and I'm not sure that if there is framework, if there is no policy, if there is no investments, investments, that's the most important thing. We can write any strategy here, but we must invest people. We must invest to the FSA, because we have to handle those cases coming from abroad. It's not easy. It's not easy at all. So maybe we have to invest to the deposit guarantee fund. We can. It's very easy to be popular and establish here and give license for the at least 10 international bank. But the problem is that if we fail, and it's it could happen, of course, in the fintech world, should government pay for all those expenses because it's the guarantee fund, yeah. And it's a huge challenge, actually, and we have to be very careful. And coming back to the risk appetite, yes, I think we have to think about it, yeah.
I think when Revolut made their EU-wide license in Lithuania, then there was an article in Lithuanian media that has anybody calculated how many yearly state budgets it would cost to the country of Lithuania if Revolut would fail because it's registered in Lithuania. Luckily, they have not failed, but definitely...
And at the end of the day, it's a taxpayer's money.
Yes.
And we experiment. We can't experiment if we don't have support from the, government, yeah.
Egert, you gave quite interesting kind of 3 options or opportunities how countries are looking at innovation and so on. There was a comment that Laivi Laidroo wrote out that there is no fintech strategy in Estonia, and this was highlighted. Do you think that a document called FinTech Strategy would help us to define the risk appetite, their roles, how here other countries have behaved, or would it be just a paper which is nice to have but will have no real use?
Yeah, I totally agree with what Andrus just mentioned, and I think also this, where we can determine this risk appetite is the same strategy and action plans at the national level, where we need also to have this political backing for that. Because if we don't have this, I would say that every decision related to financial innovation at the FSA regulators in general will be seen as a risk, right? So what we really need to achieve is to come to an agreement, kind of a societal agreement, okay, between the politicians, between the regulators, supervisors, market participants, and all other partners. Okay, what we want to do, right? Where we want to put the emphasis and in which direction we want to go next 5, 10 years, right? Because otherwise, no significant changes will take place, I think. And the second thing is that if you look at the experience of other countries, for instance, the same Lithuanians that came up, it's not enough only to have this strategy. You also need to have so-called policy entrepreneurs, those spokespersons, those enthusiasts who push the financial innovation agenda, who kind of fight for you, who, I don't know, draw attention to the potential reform ideas, disseminate information, frame the debates, and so on and so forth around the financial innovation, right? So we have seen in Estonia here many examples, the same e-residency program or the Accelerate Estonia program, where there are a few prominent figures behind them who have pushed the agenda, but without them, nothing would have happened. So I think we need also in the finance sector, among the regulators, those people who kind of are really fighting for the interest of fintech in a way. Not only FSA, but also the ministry and other regulators as well.
Martin, if I understood your comment earlier correctly, then you emphasized that the strong regulation actually is good if there is a clear protection of investors and so on. So do you see that a good regulation, if you manage to pass it, is actually helping you to protect it from potential newcomers? So if you are a good player, you actually support strong regulators and strong rules.
Okay, so there's a couple of topics here. First, I am 100% towards that we need to have a really strong protection from the regulatory aspect. But this should be competitive, means that it shouldn't be geared towards one or another. Estonia's definitely geared more to the banks. I think it's changing. So because there's other companies who are not banks, like a couple of years ago, it's only banks, banking world. So this is changing. So this is pretty good. So it should be equal playing field. I don't think it should, regulatory aspect should be a moat in a way that now I'm here, others can't come in. So I think I actually celebrate when the competition comes into the play because that forces me to innovate. So, but I'm not scared of whatever number of regulatory aspects are there. Like I think it's still fairly manageable. It's okay to operate on that aspect. It's like in general, I think we're in a good position. I think the question here is, I think there's a couple of points where it was brought out. This one is that we are not rich enough, and then we need smart players. So I would say that on that, like raise prices. Like the things start to happen when you have smart people doing smart decisions. Like I'm 100% on that front that like we should have higher salaries. We should find a way to hire more people into this place. And that's not only an Estonian problem. It's a problem for every single market. Like FCA behind the FCA door, there's like a line of companies who try to hire all the people from there because they're smart people, not get paid enough. So it's like find a way to maybe charge more for a participant on the market to pay higher salaries, but also pay more into the insurance fund so we can have a bigger funds to actually protect there. So there's a lot of things which are, I would say, not innovation. It's more about the way, the structure, the way you can create a competitive environment in the way that you operate together. You create the laws and the regulatory aspects in a way that it creates the competitive aspect. The fintech regulator, or like the strategy, effectively, that doesn't, like, fintechs don't read that and comes like, hey, I need to come here. So that's not going to happen. What's going to happen is that this happens, we have a new framework of how the laws support actually new fintechs to join in, and then they see like, oh, this is a good environment because I can now build a business in Estonia, but also in Latvia, Lithuania, and also in Germany maybe. So that's kind of the environment what I seek to.
I saw you, Triin, was nodding as well, because the kind of an intuitive assumption would be that new technology companies, fintechs, would like to have as little regulation and supervision as possible. But here we hear market participants saying that strong, good supervisors and regulation is good. You're also nodding, so you also think it's good.
I definitely agree, and with Martin, with many points he made, and what we definitely need to protect the customer, and this is like a no-brainer for nobody questions that. And what you also said, that it was very towards banks a couple of years ago. So now we have several laws or possibilities for banks that actually other participants cannot use, like pension investment account, investeerimiskonto, so on. So if we do these like nice innovative things, they should be available to everybody. The other thing that should be maybe easier, or not, I'm not saying that it should be easy, but it should be more like less burden on smaller companies is the reporting, the standardization of reporting. So right now we do have this with this nice portal that we can use, but it's only like partially usable, and there are a lot of reports that are in different formats, different ways you have to send them via email, etc. So to a company where there's only, I don't know, 10 people, it's a huge burden compared to banks, for example. So, and if we think about the fintechs, they have to think internationally from day one. And this is where the regulator can help them, especially what you said, that kind of create this competitive advantage, or at least remove some obstacles. For example, for us in Estonia, it's a no-brainer that you give a digital signature to almost every move you make. And in the beginning of our business, we figured that there is we cannot use that great technology in Western Europe. So you needed to either, I don't know, sign manually and scan it and send it to us, your contract, or you had some really non-usable solutions in these countries. So it was actually a really great how the state and the regulator reacted, that we could make this change into a law change a very short time. And this was like perfect example how regulator and state can enable these startups, these fintechs, to approach the bigger market and to remove these type of obstacles, which we think that are not obstacles actually.
Andrus, looking at the European level, so how to find a good balance where there is room for, in a good sense, regulatory competition, not to having too strict, too technical, as Andre was pointing out, but at the same time not to allow this kind of regulatory shopping or regulatory arbitrage, which is also a concern. So how to find the balance here?
Absolutely, thank you for that. A couple of remarks maybe on previous interventions. I guess what some of the participants mentioned, that the strong regulation, it's not always, I mean, it can be positive side. And I heard this more and more recently, and this is really the fact that it's ultimately consumer trust, and you can build trust through this new regulations, and of course this comes to the fact that you also need to apply these rules in a harmonized way across the union, and this is where we try to do quite a lot of work at EIOPA level, but also, I guess, all ESA level. So supervisory convergence is one of the key priorities for us. So this is really how to make sure that the different, I mean, of course, it's coming from policy making side as well. We see in financial services more and more regulatory type of instrument, not the directives anymore, but also on application side. So how you really make sure that it's interpreted in the same way across the union, and we have certain tools for that peer reviews, opinions, supervisory statements. So with these kind of instruments, we try to achieve that. Of course, Europe is diverse, so you still have these differences. Financial sectors, national sectors are also a bit different. So it's, I guess, it's work in progress, a challenge, but we try to do that. And also maybe on the facilitators part, what supervisors can do, and I guess it cannot be underestimated. So a lot of emphasis in recent years has been on innovation facilitators, so both regulatory hubs and regulatory sandboxes. And I guess, as Egert mentioned, that the hubs can sometimes just be a single contact point where you can go and ask your questions, but it cannot be underestimated in the sort of startup phase where you have no experience on discussing things with the regulators. So you have one contact point where to go. Ideally, you can also quickly find their Q&As or licensing requirements, things like that. But I guess the key thing is that you can really you know where to go, and sandbox it's a bit next level from there, where you can really test certain ideas before you put them in the public domain, or you really engage with the real consumers. And again, from ESA side, it's a joint exercise. So we've been established a framework which is called European Forum of Innovation Facilitators. So there we try to engage with all the national innovation hubs and sandboxes and try to, I guess there's this supervisory convergent aspect there as well. So try to discuss the things that are popping up in national sandboxes, try to find solutions for that. And I guess the key thing or key benefit there, it's cross-sectorial. A lot of innovation is these days, between different sectors, or at least initially when you're developing your business model, you can even sometimes question whether it's something in insurance or really something from payment side. So this is where we have put quite a lot of emphasis as well.
Okay, thank you. In TalTech report, there was also reference to FSA financing model. Is it really supporting the innovation? And also here Martin was saying that perhaps the salaries of the staff should be increased or more financed. So Andre, if Lightyear or Grünfin turn out to be in a couple of years multi-billion euro businesses across different jurisdictions, is Estonian FSA ready to handle the supervision, or you would hope that they will re-register themselves to Germany or somewhere else so that you don't need to take this burden regulatory risk?
Yeah, I mean, the proposal for the salary rise, it's fine, yeah. no question here, but again, I think, the words are strong sometimes, yeah. Let's go back to the FinTech strategy, for example, but what really matters, it's the action behind of these words, and there could be kind of role, I mean, for the message to the internationally that we care innovation and things like that, but still we have to invest We have to invest, otherwise it doesn't work. Let's take the cryptocurrency example here in Estonia. When we started very sloppily, indeed now the government has changed the legal framework, gave more resources to the FIU. The problem here is that if you start sloppily, at the end of the day, we are all in very big trouble, because I'm not even speaking about bad things happen in a specific financial institution. What happened is we lose reputation of the jurisdiction, and that's not good. That's not good. So if we would like to be more open, I don't know what is the, there could be sandboxes, contact points, but the real things behind this, that we have to invest to the FSA, we have to invest maybe to the universities, because we need people also. It's a very complex thing. As I mentioned, we maybe have to invest to the deposit guarantee funds when we would like to open market for the international banks. But sandboxes or not, I don't really think those are headlines. I mean, there are different ways. I mean, the most important is that we, as a supervisor, we are open, transparent, and clear to help innovators. It doesn't matter where it happens. Is it the traditional approach? Is it the sandbox? But again, we need investments. It doesn't work like this, that we just open wide door for the newcomers and we don't invest to the supervision and licensing. Yeah, we can't do this. Yeah.
We have time for 2 questions from the audience as well. And I see here our respected parliamentarian has a question. So please, do we have a separate microphone for him, or he will just yell? Loudly. Yeah, but the millions of listeners online don't hear you, so need a microphone.
And that opportunity I don't want to miss.
And please tell to whom you address the question as well.
One question goes to everybody, but I will start from what Andrus said in the beginning and what I very much like. So your personal view. I think we should now make an effort that your personal view of principles-based supervision becomes an institutional view. Because this is where I think precisely we can contribute to the innovation and development. And then when Martin spoke about a strong brand and not so strong brand, like one side of the same, or 2 sides of the same coin, this is the other point where I think we should put our effort together to make this brand strong on the both sides of a coin, and this is where the question comes to all of you. I was to ask about sort of who should be in the lead, but that answer you already gave, so it should be the government. Then I just note that there is nobody from the government in the panel. I don't know if anybody from the ministry is in the audience, but it would have been great to have them.
We will send the summary notes to them afterwards.
Good. And the same actually goes for the banks. I think it would have been good to have a traditional bank also somehow present here as to see the opportunities. So the question I have to all of you is, when you rightly asked about the country's risk appetite, then in an ideal world, on a scale of 1 to 10, this risk appetite is very well defined, and you give 10 points, and there is nothing, then you give 0. So how many points you give to Estonia at present day, and why?
So, sorry, then we have time only just for 1 question, because long answers probably, but yeah, let's start from you and go with a row, with 1 number and a comment.
The risk appetite, I would say it's an average. I would say 0.5, because again, if I come back where I began my speech, I was saying that there are 3 groups of kind of responses where you can focus your efforts, and I think where we locally have done more is really this, let's say, innovation facilitators, enablers. So if we look at the same, maybe the positive credit registry, or we are piloting with the digital euro, which is, we are doing the experiments there, but also there are kind of pilots with the subtech solutions and so on and so forth. So there is a lot of kind of going on with around the infrastructure and support aspects. So there we are taking more risks. But I think, again, the risk appetite is to some extent suppressed by the same, as mentioned, the European Union, where we get the guidelines, what we can do and what we cannot do. So there is not so much leeway at the national level today as it was maybe 7 years ago.
Thank you. Andre, your points and argumentation.
Yeah, our risk appetite is in law, but anyway, as I mentioned before, we have, in a complex system, we have huge amount of playground. And come to the questions, do we have a risk appetite in country? I would say no, we don't have. And zero then, yeah, maybe the right number, yeah. But I still believe that for the risk appetite, we need leadership. Yeah, we need leadership from the government also. So it's otherwise it doesn't work, because what we are struggling now is kind of silo problem. We all do pretty good work. I really believe we could do really good work in innovation, but still some silo problem is there.
Okay, thank you, Triin.
Yes, I really like what Andrus said, that there is like a bad reputation and good reputation coming like together, and I think it's maybe sometimes because innovation is taken in too rapidly to it's a mess. So the good example was this crypto licenses that were given out in a large amounts, and it created like a reputation risk. It created like problems in many cases, and of course the trust was also a big loser there as a country. So nobody, I think, in Estonia, in all of the market participants want this type of things to be called innovation and called like something that we want to happen here in Estonia. So everybody wants this to be like a trustworthy environment with normal regulations that are like fair to all the market participants. And I think this is where we should actually find this balance there. And I hope that there will be some risk appetite coming up, but in a very like structured and controlled manner, where we have either a sandbox or however we call it. There are borders, but we can easily play within these nice rules.
Thank you, Martin.
I'm actually rather surprised that everybody thinks it's so low. I think it's rather high. If you think about like all the risks what we have taken in the kind of innovation front, like I think it's fair. Like we have taken risks. We also have not been, in some sense, not so successful. We have been sloppy in some areas, but like we were sloppy because we took some risk. Maybe we didn't like play it out well. So I think like the risk appetite is there. If I'm comparing Estonia compared to some other markets, then I think we are actually above average in a way. I think now is the question is that let's not get hurt and like capsule into the kind of and start being scared of the kind of new steps. I think like now is the question like if we can take lessons from the mistakes what we have made and like take the kind of pragmatic next steps to actually make the risks apply into the environment, then I think we can be really, really good because we know what to do now.
Okay, thank you. Andrus.
Yeah, good question. I will not give a concrete number. I guess it's very difficult, but I guess one maybe conclusion for myself from here is that I guess we really need to finalize this fintech strategy quite quickly. I guess this will provide an opportunity to maybe define the same risk appetite and other things as well. And I guess it's ultimately, of course, the government will approve all the strategies ultimately, but I guess the process to achieve it, you need to have a really multi-stakeholder approach and discuss among ourselves what kind of fintech ecosystem we will like to see in, I don't know, 3 years, 5 years time. And I guess we also already got some ideas here as well. We need more money for the local authority, and I guess you also proposed that you're happy to provide that. So some concrete ideas already on the table as well.
Well, thank you for not providing numbers, because I was not sure whether I can calculate average very quickly in here. So I can give a kind of a general feeling from the panel that it's around the average, some think it's below a little bit, some think it's above. I also would give my number around between 5 and 6 on one hand. I agree with what Martin was saying, that we have been in some areas quite innovating, ready to test. Also, the FinTech report showed that 72% of our FinTechs are operating cross-border internationally, so you need to be ambitious and having risk appetite. At the same time, we come back to the smallness of our own regulators, the certain rigidness of EU-wide rules that put certain limits. So I think we are there around the average. But yeah, I see that the clock there is already not in red, not anymore in green, and I haven't seen from our Master of Ceremonies a placard talk 10 minutes more, so I think we have to close here. I think it was, to me, surprisingly unanimous discussion that stronger regulations and strong and professional regulator is good. So in that sense, the FSA picked the panel very well. That I think got a good message that we need good regulators, good regulator itself, but at the same time we should now really try to finalize the fintech strategy that has been under discussion for many years already, and let's try to use this document and this process to also define then our risk appetite for any future fintech development. So thank you all the panelists, and thank you the audience.
Thank you.
Thank you.
Thank you very much. I must expect, I expected a few more firefights, some people showing up in Kevlar vests perhaps, but that was, yeah, a very agreeable conversation. Also, thank you very much for the questions from the audience. Now, it is very traditional for the moderators to say that I am now the last thing standing between you and the coffee break. In this case, yes, it is meant in the sort of linguistic sense, but it's also quite literally, because the coffee break is behind the screen. It's going to roll up in a minute, and you're going to have the coffee right there. So we have around 10-15 minutes to get some refreshments and go to the restroom if we need to, and then we will get back for our next keynote. Thank you very much, and see you after the coffee break. We now have a very interesting situation where anyone else who is still in the coffee break room has to do a tiny limbo dance underneath the screen. So please make sure to applaud anybody who comes through here. We are going to head to our next keynote speech in a moment. I would say no matter who you are, no matter what side of the aisle you stand on, you've probably made up your mind about blockchain by now. We've seen some really interesting solutions to long-standing problems. We've seen NFT bros and crypto scams. We've seen everything in between, really. A lot of money successfully invested, a lot of money also successfully burnt. One thing that all of this still comes back to today, after these first experiences, is the question of trust and confidence. Of course, the public decentralized nature of record keeping can have far-reaching implications, not just for how organizations work, but for how our society works, because it can remove intermediaries, it can replace the rule of law with the rule of code, at least in theory. And here to tell us more about what it means to govern the confidence machine is Dr. Morshed Mannan, who is the research fellow at the European University Institute. Let's welcome him to the stage. Thank you.
Thank you very much. So today's talk, do we have the clicker? Yes. So for today's talk, and I'll just begin even though there'll be people limboing under my slides in a few minutes, today's talk is basically intended to show how blockchain-based systems challenge the rule of law, a point that was alluded to very briefly in an earlier session, by means of a move towards what has been described as the rule of code. But in recent years, we are seeing that there is an attempt to rein in the rule of code using the rule of law. This is an opportune moment to talk about this subject. In a way, it's been an opportune moment for a while, given Mika, the Sam Bankman-Fried conviction related to the FTX collapse that was also alluded to earlier, and many other events that have been happening in recent months. And this is also something we will be discussing further in the context of the subsequent panel on the legal headaches caused by DAOs. So a little bit of an outline of what I'll be talking about. This is based on prior research as well, but I think the narrative flow will work better given that we know what I will be covering in these minutes that I've been allocated. So first, I'll talk about what the differences are between blockchain technology compared to the internet. And so what is the difference between blockchain governance and internet governance, or the same with respect to regulation. And then you heard right now about this analogy between the rule of law and the rule of code. So I'm going to unpack that analogy a little bit before turning to regulatory approaches. And I will first draw on Lawrence Lessig's famous 4 modalities of regulation, something some of you might be aware of, especially if you have an IT law background, and then contrast the regulation by enforcement approach, which we see in quite a few contexts. And I will talk about 2 cases in particular, the ongoing tulip trading case, as well as the OFAC sanction in the US on Tornado Cash, before turning to the regulation via governance approach, which you will probably be able to tell my co-authors and I have a sympathy towards, which looks at the possibility of influencing social norms to be able to change the architecture of these technologies. And there I'll also talk about 2 examples. One is the Risley case against Uniswap, which happened recently. It's a DeFi example, which I hope an audience like this will be interested in. And then the Ethereum merge, which happened a little over a year ago. So I put this image of a horse because it is worth talking about the idea that crypto law is not a subject that people would take for granted as something that is worth studying. So is it worth talking about crypto law as a distinct topic? In the 1990s, we heard the US judge Frank Easterbrook claiming that a course on cyber law, for instance, would be as shallow as a course on the law of the horse. And so to quote Judge Easterbrook, the best way to learn the law applicable to specialized endeavors is to study general rules. Lots of cases deal with sales of horses, others deal with people kicked by horses, still more deal with licensing and racing of horses. And any effort to collect these strands into a course on the law of the horse is doomed to be shallow and to miss unifying principles. And this same sort of argument could be made about any course on crypto law or the Lex Cryptographia, as it's also referred to. But I would, through the course of this talk, try to challenge that by saying that what we actually see is not the law of the horse, but the law of another animal, which I will show later. So first, I think for an audience that is mixed and maybe some are more familiar with blockchain technology than others, it's useful to know a little bit about what is different about blockchain and then go into these sort of regulatory weeds. There have been many claims about blockchain technology that have also been previously made about the internet. So, that blockchain technology, just like the internet in the past, is unregulable, that in the past people have said that with respect to the internet, that the state lacks legitimacy to regulate cyberspace, and that we are seeing this emergence of a new area of law, whether you call it cyber law or Lex Informatica, where the code is used to regulate online behavior. And these claims, as we now know, have proven to be overly ambitious. There are recognized pressure points that can be controlled, for example, ISPs, and their access to the internet has also been mediated by large online operators to whom the law can be applied. And as you will see later on, and those of you who are already familiar with MiCA, this approach is already starting to be implemented with respect to crypto asset service providers, for instance. So what is different about blockchain-based systems and the so-called Lex Cryptographia? So a public blockchain, for those of you who may not know, is a decentralized database or public ledger that is replicated on a decentralized peer-to-peer network and that operates without any centralized authority. Every block of transactions is uniquely identified through its cryptographic hash, so think of it as a digital footprint that is unique to that block and includes a reference to that hash in the previous, of the previous block. This creates a long chain of blocks that chronologically refer to each other, where the hash of every block is incorporated in the following block. Block production can take place following the solving of a complex computational problem in the case of proof-of-work consensus systems, or depending on the tokens that have been staked, so in the case of a proof-of-stake system. So the point being is not so much to go into the technical weeds about blockchain technologies, but to try to explain that why would someone want to have confidence in this, and why is this important? So what was first espoused about blockchain systems is that they are trustless. What my co-authors and I argue is that no, blockchains are not trustless. They rely on the generation of confidence. And confidence, like the German lawyer and sociologist Niklas Luhmann has explained, is different from trust. So confidence relies relies on predictability and reliability of, for instance, a technical system, rather than the sort of a leap of faith that is required in a trust relationship. And the blockchain system is able to generate confidence in a few ways. So first, there is confidence in the mathematical rigor of the hashing algorithm, especially with regard to the cryptographic primitives that constitute the underlying foundation of a blockchain. So for example, the public-private key cryptography. And the idea is that mathematics does not require trust to the extent that it can be proven to work in a predictable manner. This leads to the very high level of predictability, since the ideas of the protocol are guaranteed by the technological design of the blockchain protocol. So for example, with regard to Bitcoin, the confidence in the system is mostly supported by the fact that Bitcoin's open source code has been, observed and scrutinized by millions of people, and there has been such difficulty in hacking Bitcoin. The second blockchain-based way in which they generate confidence is in the economic incentives and game theoretical schemes that govern the network, which are grounded on the premise that miners will always act in such a way as to maximize their financial rewards. Yet because miners are ultimately controlled by people and might therefore be bribed or corrupted, additional guarantees have been introduced into these systems in order to further reduce the need of trust in any individual miner or validator. So on the one hand, the consensus algorithm of most blockchain-based networks, the ones that I've mentioned already, is intended to distribute trust among a large variety of miners and validators, thereby reducing the risk of individual opportunism. On the other hand, because all participating miners and validators hold a copy of the blockchain, they can always verify that every recorded transaction is valid and legitimate. Hence, anyone interacting with a blockchain has a reason to have a high level of confidence that the technology will operate as planned, even if they do not know and therefore do not trust the parties operating or maintaining the network. Again, this is the sort of theory behind it. The more recent experimentation with ring signatures and zero-knowledge proofs seek to guarantee the validity of blockchain transactions in a privacy-enhancing way, which means that they would try to find ways of not having to disclose the source of certain transactions, the destination of certain transactions, or even the content of such transactions. And when I come to talk about the Tornado Cash case, these privacy-enhancing technologies will become relevant again. So if we had to summarize and distill what are the distinct features of blockchain that have a strong relevance for any sort of effort to regulate this technology, I would at least mention these 6. So one is tamper resistance, which basically means that any effort to unilaterally modify a transaction on a blockchain protocol would be automatically detected by other nodes. Thus, they would be able to flag that something was wrong. Again, these consensus algorithms that I've mentioned are public, as are the transactions that happen on a protocol are public if they are a public permissionless blockchain, and so there is transparency. As you only need a public-private key pair to be able to engage into transactions, to be able to do a lot of activities, joining the network can be said to be pseudonymous. You cannot unilaterally stop the execution of blockchain code, and so there is a guarantee of execution as well. And a copy of a blockchain is copied across every node. And so even if you are able to stop or sanction, let's say, every node in Estonia, they would still be able to function outside of Estonia in a sort of uninterrupted way. So meaning that it's hard to shut a public permissionless blockchain down if it has already reached a sort of global spread. And again, you're able to replicate the blockchain from more or less from scratch if there is at least one node that is still functioning. This also means that, that the rules of a blockchain protocol need active participation of nodes to be changed. So again, one blockchain developer is not able to force all of the participating nodes, the miners and validators, to follow their decision. They have to upgrade their clients, which is their individual choice. This is very different than if you think of a normal, centralized platform where the company behind it and those who are, the engineers behind it would have a much more authoritative say on, upgrading, let's say, their software. So this lack of coercion is a very important point also when it comes to regulation. And we can also think of lack of coercion as a type of autonomy that the stakeholders of these networks enjoy. So what does this mean for regulation? So it means that just like as I was saying with internet regulation, there are different pressure points that are available for state regulators to approach. And we started to see this with MiCA, but also with other early legislation that I will get to later. So you can target crypto exchanges, you can target miners, as some countries have started to do. But what is interesting is that when you start talking about autonomous software, so smart contracts that are able to self-execute, you have this appearance, at least, that they are beyond the remit of any jurisdiction. And again, this is not for lack of trying. Once a new code-based system has been deployed on a blockchain, it can continue to operate autonomously and independently of the will of the parties who have deployed them. But again, as I will talk about when I come to the Tornado Cash case, there are now challenges to the idea that software can be truly autonomous. But this is going to be a long-standing battle, which might, who knows, lead to a decision from the US Supreme Court one day about this very issue. So if we go towards the other features, pseudonymity makes it difficult for regulators and courts to identify people to sanction. There have been many cases about this over the years, including a recent DeFi one, which also discussed the issue of pseudonymity a lot, the Uniswap case that I'll be talking about. But even just at a very procedural, civil procedure level, we see, for instance, in the Singapore High Court, an interim order having to be passed against persons unknown when, even though they've convicted that person and they allowed substituted service to these persons, so they used email to contact them. But then there was this issue that these defendants could ignore these emails, they could obscure their physical whereabouts, and the court conceded that it's very likely that the assets of these defendants are not in Singapore either. So again, we see this issue of pseudonymity presenting this particular challenge to regulation. And similarly, we've seen courts having to take very innovative approaches to being able to deal with pseudonymity as well. So in England and Wales, we have a series of decisions where the English High Court essentially had to find ways of serving summary judgments and other legal documents on unknown persons by using NFTs. So if you think about, a lot of people have a lot of skepticism about the use of NFTs, but NFTs are now used for service of legal documentation in certain cases as well, which I guess was not, thought about initially. We also see immutability and tamper resistance, meaning that legislation and court orders on their own cannot roll back transactions. So again, this is about that lack of coercion, where even if you are trying to coerce one particular actor or set of actors to change what is happening on the protocol, it's very difficult or impossible to actually enforce that on the whole network. So what does autonomy, so again, this aspect of lack of coercion, mean when it comes to regulation? So autonomy means that even the forfeiture or seizure of private keys that are held by individuals or the freezing of assets will only allow control of specific assets, not complete control of the entire network. If you try to take down a particular interface or exchange, the network will still continue to operate, and you can spin off a new interface to be able to access the protocol. So again, that regulatory strategy will also have a lot of difficulty in being effective. And then similarly, you cannot regulate the whole network by proxy by saying that, oh, I'm going to go after a particular crypto exchange, because again, not only do we have a great variety of exchanges, also ones that are decentralized exchanges, but that, as I said, it's difficult to enforce the will of the regulator through those exchanges or through those other intermediaries onto the overall network. At least it was not possible to do that well. So all of these challenges can lead to a conflict of the rule of law and the evolution of the rule of law and what is the rule of code, which is encoded in these networks. So I'll briefly go into what we mean by this analogy and this battle that we're starting to see emerge. So I'm sure everyone here knows what the rule of law is, but just quickly to go over this, it's the idea that all persons and institutions are accountable to the law, that the law is equally applied, it's independently adjudicated, and there are adherence to certain principles, so such as the supremacy of law, the separation of powers, avoiding arbitrariness, transparency, and some form of participatory decision-making. We're in a building today which was home to a lot of these very principles being proclaimed. If we look at the paintings that are behind us, that sort of reminds us as well of the importance of these principles. And there are thick and thin conceptions of the rule of law. A thin one would be a very procedural conception, while thicker ones would consider different human rights as being part of the rule of law as well. So the rule of law can be contrasted with the rule by law. So rule by law refers to the instrumentalization of law as a tool of political power. And a key distinction is that in the rule by law, a sovereign who stands above the law and lays down rules that will govern society that doesn't apply to the sovereign itself. And there is no accountability to the sovereign under existing laws, while under the rule of law, nobody, not even the sovereign itself, can rise above the law. And so all citizens, including the sovereign, are equal before the law and are entitled to equal protection of the law. So what we're starting to see in first the internet space, the platform economy, and so on, is that we start to see large online platforms deploying, by analogy, the rule by code, where they claim that that they act as sort of quasi-sovereigns who are able to, using their terms of service and other sorts of user agreements, control the users who operate those, who are a part of those platforms. And despite claims of these mega platforms being quasi-sovereign, though, we start seeing that these infrastructures are quite centralized and are controlled by, for instance, the company that is the operator of that platform. And of course, we have to concede that because there is this centralization, these companies and the individuals behind them are still subject to external legal pressures, for example, from the jurisdiction where the platform is registered. This is quite different from the rule of code situation, which is our rough approximation of the rule of law. So we have to imagine this as a polycentric system, not a monocentric system. So there isn't one central authority, but one where there are distributed overlapping authorities, which sort of influence each other as well. All persons and institutions in this sort of system are accountable to the rules enshrined in the blockchain protocol or in the smart contract code. This code is equally applied. Anyone who tries to validate transactions that violate the underlying blockchain protocol will simply see these transactions being rejected by the rest of the network. And by doing so, this rule of code seeks to avoid arbitrariness and arbitrary decision-making. But the rule of code raises questions of legitimacy and acting against general interests. So for example, Thibaut Schreppel talks about in a 2019 paper, the first mover advantage that can exist to protect privacy or exercise freedom of expression when we start thinking of activities within this space. Which one do you prioritize first? And there's a first mover advantage in who gets to sort of take the first step. And this can lead to the rule of code leading to trade-offs between fundamental rights like privacy and free speech without having the state balancing this out, which would usually be the case in a non-crypto situation. So there are more problems to the rule of code system as well. So of course, in terms of substance, we know about money laundering using crypto assets, illicit content being stored on a blockchain. In terms of form, and as a lawyer and legal academic, these are also issues we grapple with, whether these transactions ignore contract law principles, intent, capacity, entering into illegal contracts, and so on, ignoring how property can be disposed and also taken a control over. So there's questions about how these transactions threaten our notions of private property and theft. And there's also difficulties, as I've already mentioned with the example of trying to serve notice, there's difficulties in seeking and gaining remedies as well because of pseudonymity. And so one very nice illustration of this is the DAO attack, and we'll have a DAO panel, so I'll only use this as an illustration. But it basically shows how the rule of code is not immune to violations, and that thicker principles are developing among blockchain communities in how they want to govern this space. And these relate to private property, conceptions of equity, and so on. So the DAO was essentially an attempt at creating a decentralized Kickstarter platform, enabling the crowd to choose projects to invest in a very distributed manner. They, in a very short period of time, raised over $150 million US, but soon after there was an exploitation of a technical vulnerability in the smart contract code by an attacker that allowed that attacker to siphon out funds. Many millions of dollars. These funds were then, fortunately, initially frozen, but the community had to decide about how to deal with this exploit. The attacker published an anonymous message that if code is law, the term that is very popular in this space, or was very popular, that if code is law, then the vulnerability in the code could be construed as being deliberate, that this was supposed to be a feature, not a bug, and that this exploit of this vulnerability should be a reward for, almost like a bug bounty, for revealing that this vulnerability exists. And so their attack was not theft, according to the attacker. But to many others, of course, it was. This clashed with their ideas about the sanctity of private property and the notions of equity that exist. And so these perceptions helped in implementing a hard fork of the Ethereum blockchain, which led to essentially creating a parallel chain initially, which then became the dominant one. So what we're seeing is, I would say, let's say 3 strands in this discourse emerging. So you have the people like the DAO attacker and others who believe that the rule of code supersedes the rule of law. There are many other academics who are crypto skeptics who would say that decentralized systems cannot create conditions akin to the rule of law. The rule of law needs hierarchy. And so there's no way of equating the two. We take a sort of third ground where we say that just as there's been for centuries this conception of legal pluralism, we are starting to see the emergence of legal pluralism in this space where we'll see rule of code plus rule of law. And so we want to adopt a legal pluralist perspective to underline the fact that multiple legal orders, including those enacted by technological systems, can coexist in the same jurisdiction, even if it isn't always peaceful. Our claim is that while the state's legal order can influence blockchain-based systems, it does not necessarily follow that the rule of law will necessarily always prevail over the rule of code for the reasons I've mentioned. And so instead, we advocate a third approach where we see blockchain technologies as being capable of automating the execution of specific actions or interactions and transforming economic and social patterns, but that in this approach, human agency still has to be important. And so we advocate for what we call the regulation by governance approach, where we try to change social norms within these communities in a way that corresponds often with public policy imperatives. So this aligns very well with Lessig's 4 modes of regulation. So law, social norms, architecture, and the market. A lot of approaches that we've seen so far are basically trying to change the architecture. And then by hoping by changing the architecture, or maybe in some cases changing the market, you will be able to successfully regulate this technology. This has led to many different problems, and the rest of my talk will be devoted to talking about what those problems are. So we see in early relevant legislation, I've chosen the ones that are most relevant perhaps to this audience, MiFID II talking about market transparency and investor protection, virtual currency, AMLD2, which is for preventing money laundering and terrorist financing. We have MiCA that defines crypto assets and crypto asset service providers. It tries to, among other things, improve the management and governance of these crypto asset service providers. There are new impositions on virtual currency exchanges and custodian wallet providers following the 5th AML directive. And we know DORA also deals with ICT risk management, which is also, of course, very relevant in this space. But what is most interesting, I think, are to look at some of these recent cases that have emerged. So one attempt of the regulation by enforcement school has been to enforce against developers. So, when talking about crypto, it's popular to talk about tulips, so it's very appropriate that this is called a tulip trading case. So this is relevant because of the engagement with the question of whether open source technology developers, in this case Bitcoin core developers, can be held fiduciarily and tortiously liable for something going wrong in the technology. This can have this case, which hasn't been finished yet, it's still ongoing, can have a wide-ranging impact on open source software development, as well as affect operations of the largest blockchain. And this line of cases is very interesting because this particular person claims to be the elusive Satoshi Nakamoto, which is very disputed, but still. It's one of the reasons it gets publicity. So the issue there was whether the developers who look after Bitcoin may arguably owe fiduciary duties or duties in tort to an owner of that cryptocurrency. So in April 2021, the claim by Wright was that this was about an issue about $4 billion being trapped in 2 addresses. However, the private keys that that were supposed to be able to move those assets were lost or hacked or perhaps even stolen. And without its private keys, the company of Craig Wright, Tulip, cannot access its assets or move them to safety. And Tulip, in this case, contends that the developers who are named as defendants control and run 4 relevant Bitcoin networks, and that it would be a simple matter for them to secure Tulip's assets by, for instance, moving them to another address which Tulip can control. So basically challenging one of the fundamental properties of these networks, that they cannot be reversed. So this leads to a legal question, among many others, but the one I'll focus on is whether these Bitcoin developers are a new type of fiduciary in relation to the Bitcoin holders like Tulip or Craig. So should the fiduciary duties then extend to implementing the necessary software patch to solve Tulip's problems and safeguard Tulip's assets? So can a positive fiduciary obligation be imposed on them? So there were 2 case decisions so far about this, one in the England and Wales High Court and then following an appeal at the Court of Appeal. This is then going to go for a full trial, and I'll tell you why later in some time. So they came to very different conclusions. The first instance court, by a single judge, said that there was no serious issue to be tried. Basically, there was no fiduciary duty. The court explained, to quote, "A fiduciary is someone who has undertaken to act for or on behalf of another in a particular matter in circumstances which give rise to a relationship of trust and confidence. The distinguishing obligation of a fiduciary is the obligation of loyalty. The principal is entitled to the single-minded loyalty of his fiduciary." So, to end quote. In other words, there has to be an act. That act creates trust and confidence, and then fiduciary duties then are imposed upon these individuals or actors to protect vulnerable trusting parties by introducing a reasonable, legitimate expectations that fiduciaries act loyally in interest of their principal, and then by doing so, they have to also subordinate their own interests for the interest of the principal. So, moreover, the court said that where a fiduciary has more than one principal with potentially conflicting interests, acting for one without the informed consent of the other amounts to a breach of the obligation of undivided loyalty, albeit informed consent can be implied. So when acting for multiple principals, you have to act in good faith towards each of them. And so the court, in saying that there is no serious case about fiduciary duty, she ruled that the imbalance of power that exists between a developer and an ordinary Bitcoin holder is not enough to establish the existence of fiduciary relationship, even if it is often a part of such relationships. It's also not feasible that Bitcoin owners can realistically be described as entrusting their property to a fluctuating and unidentified body of developers. Because it's an open source technology, people are joining and leaving the protocol all the time. So there can't be a positive duty on developers to update the software, as they are a fluctuating body of individuals, and they cannot have continuing obligations to, for example, remain as developers and make future updates whenever it might be in the interest of the Bitcoin holders to do so. And again, there's also the argument that just because you make a software patch for a small group of holders, you are acting against that loyalty that you have to the rest of the holders. They might not want this sort of reversal of transactions to happen. So consequently, even though there have been cases in England in the past where there have been positive duties imposed upon a fiduciary that they have to do certain things, in this case, the first instance court said that there is no reason to do that. The Court of Appeal basically reversed this decision completely. They said that there is a realistic argument that core developers are fiduciaries with a duty that entails a single-minded loyalty to the users of Bitcoin software. In the interest of time, they have a very nice, concise summary of what their reasoning is that contrasts with all that I've said about the High Court decision. So to quote, "The developers of a given network are a sufficiently well-defined group to be capable of being subject to fiduciary duties. Viewed objectively, the developers have undertaken a role which involves making discretionary decisions and exercising power for and on behalf of other people in relation to property that is owned by those people. That property has been entrusted into the care of the developers. The developers, therefore, are fiduciaries. The essence of that duty is a single-minded loyalty to the users of Bitcoin software. The content of the duty includes a duty not to act in their own self-interest and also involves a duty to act in positive ways in certain circumstances. It may also realistically include a duty to act to introduce code so that an owner's Bitcoin can be transferred to safety, end quote. So the Court of Appeal, in my view, seems to have reasoned in the opposite way to the High Court. So instead of seeing if there is a single-minded loyalty demonstrated by the developers to determine fiduciary status, they start their reasoning on the basis that there has been property entrusted and the exercise of agency power seems to exist, and that they've assumed this risk, these developers. And so then they read into this an obligation to have single-minded loyalty. So it's not that you demonstrate single-minded loyalty and then you become a fiduciary, it's that you've done all of these other things that lead to you having to be single-mindedly loyal. This leads, of course, to the types of remedies that the Court of Appeal proposes, and we are going to see eventually how this plays out once the trial happens, because this is not the final word when it comes to fiduciary duties. But this becomes very important because we start seeing a threat towards open source developers who might unwittingly find themselves responsible for technologies they worked on several years ago just because they are retrospectively deemed to be fiduciaries. Aside from tulip trading, we also have the famous Tornado Cash case, which involves essentially enforcement against developers and the code itself. So Tornado Cash is a blockchain-based software system that is used to enhance financial privacy. Users can send cryptocurrency to Tornado Cash smart contracts from one address and then withdraw the currency to another address, in the process of which the link between the two addresses are severed. And the identity of the holder of the cryptocurrency is obfuscated, and the control of the cryptocurrency is retained. It's basically a way of obscuring where the transactions are coming from so as to retain financial privacy. This can have legitimate and illegitimate uses. Financial privacy might be just because you want to feel safe. It can also be because you want to facilitate the laundering of hacking proceeds. And so essentially what happened is that the US Treasury's Office of Foreign Assets Control imposed a sanction on this Tornado Cash system on the basis that it had facilitated North Korean hacker group to launder proceeds from their activities. And the dispute about this becomes very interesting, is that the Tornado Cash entity was one that they allege comprises its founders, developers, and this decentralized autonomous organization. But according to others in the blockchain community, what they were actually sanctioning is a list of smart contract addresses. And so this was seen, at least especially in terms of US law, that they were trying to sanction code as speech. This means that no one, including the development team, because they say that the smart contracts operate autonomously, that because no one has control over its operations, there is no way to modify or shut down this system. So there was a recent decision in Joseph Van Loon, which also had to consider some of these issues. Namely, was Tornado Cash truly autonomous, or was it controlled by its founders, developers, and the Tornado Cash DAO, for instance, through periodic updates or of the existing smart contracts? The first instance court held that Tornado Cash is an entity that may be properly designated as a person, and that it's an association within an ordinary definition. This entity comprises of these founders, developers, and the DAO, that were, maintaining the GitHub. The DAO was, governing the platform. Tornado Cash was also posting job adverts and paying compensation. All of this indicated that this was not just software, but was an association too, according to the court. And the court also ruled that the Tornado Cash had a beneficial property interest in the smart contracts. And importantly, and in contrast to a case I will come at the end of my talk to, Tornado Cash was financially benefiting from the transactions that were happening on the protocol. There were also indictments handed down against two of the founders of Tornado Cash, and there was also concern being raised about OFAC expanding its reach beyond US citizens and US parties, because people started to be scared that the Treasury is going to sanction them and penalize them in some way. So in the view of some, this sanction contravenes existing liberal approaches to regulating software code as speech, which is protected by the constitutional right to freedom of speech in the US. And the court disagreed that the sanction in Joseph van der Loon curbed the writing of of open source code, as the plaintiffs can still interact with the software code and can be lawfully used to analyze the code and use it to teach cryptocurrency concepts. So they said, well, we're not actually sanctioning code and sanctioning speech, because you can still use, Tornado Cash to teach, for instance, a much more limited use than what it had been designed for. So others, though, have called for a more fundamental and drastic change to how we regulate open source technologies. For instance, the famous cybersecurity expert Bruce Schneier said that the Tornado Cash imbroglio necessitates a revisiting of the long-established doctrine of considering code as speech. Tornado Cash, they argue, is a destructive golem, referring to the mythical artificial creature in Jewish folklore created from inanimate matter. This golem can exist and mix transactions for as long as the Ethereum blockchain exists, leaving a long trail of broken laws and regulations in its wake. And in their view, only some code is speech, and speech that collapses speech and action in the way the DAO does should not be protected. And of course, it's true that the law cannot directly alter the code on the blockchain, and these KYC and AML compliant Tornado Cash rules would defeat the purpose of this software, but we see indirectly regulation starting to become effective. A lot of transactions with the Tornado Cash initially diminished, but what also became relevant after a few months was that even though this indirect sort of effect started to take place, once it became clear that the OFAC would not be able to impose their will across all of these states, the amount of transactions with Tornado Cash continued to grow, even though the developers were being arrested, the GitHub repo was gone, a lot of the forums became dark and so on. Again, showing that how difficult it is to stop this digital golem, as Bruce Schneier calls it. So what we end up with is basically this issue of not law of the horse, but what we call the law of the platypus. So how do we approach crypto law? The problem of the platypus is that we end up looking at it and saying, is this a beaver? Is it an otter? Is it a duck? Is it a mammal? But how come it lays eggs? So the law of the platypus, as with cyber law, we are seeing that crypto law is growing and becoming more complex. It needs approaches that protect individuals, the economy, and society, but also doesn't lead to the extinction of the platypus. So it needs a distinct approach that acknowledges the differences of this particular species. And so what we call for is this regulation via governance approach, where essentially you use off-chain governance to try to influence social norms. Those social norms will lead to a change in the architecture, and that will then eventually lead to changes in the market as well. So if I skip ahead to this particular one first, it's very simple. Essentially, there was a lot of criticism about the Ethereum blockchain being, like Bitcoin, very energy intensive, consuming a lot of electricity. But because of the social pressure that this created, there was a shift in norms that, well, when we want to plan to move to proof of stake anyway, this will be much less energy intensive. And so the nodes who could not be coerced into changing the consensus system voluntarily complied to do so. And as of last year, they switched from Ethereum 1.0 to the Ethereum 2.0, which uses the proof of stake system, and the power demand dropped dramatically. This is figures not from Ethereum, but from the Cambridge Judge Business School that acknowledges this particular change. So to come to my last example, I think another issue is not just to shape social norms, but is to also understand how the technology and the ecosystem actually works. So if we look at a DeFi example of Uniswap, Uniswap is a decentralized cryptocurrency exchange in which buyers and sellers are empowered to use non-traditional methods to trade and create tokens, including liquidity pools. So liquidity pools are essentially comprise a pair of tokens. So imagine Ether and a new token issued by a private issuer, and then you can basically use these liquidity pools to swap one for the other. The market value of the former token, so Ether or Bitcoin, supports the value of the latter, and then the liquidity provision is being encouraged by those who have Bitcoin or Ether through a pro rata share of the transaction fees that is generated through trades on that particular protocol. These fees cannot be immediately withdrawn because that would affect the incentive system, but eventually they can be along with the liquidity provider's own contribution after they burn their liquidity tokens. And the whole idea behind this is to create an open, permissionless, middleman-free ecosystem for commodity exchange or token exchange. The main issue in a particular case that happened recently was that the plaintiffs who basically were burnt, to use the pun, were burnt by scam tokens, so-called scam tokens, were suing Uniswap for saying that, well, you facilitated the sale of these scam tokens, and they also alleged that Uniswap directly, through its various social media posts, encouraged the sale of these tokens. The court, showing a great degree of technical nous and knowledge, dismissed all of these charges because they essentially said that the protocol is not directly involved in any sales, and that this facilitation was one that was not the equivalent of, was basically ancillary to the actual trade. And what this really brought this home was another example that is about an automaton or a digital golem type of example. They analogized this with an automated car. They said that a self-driving car, you can hold the manufacturer guilty if there's a bug in the self-driving car, but if the self-driving car is used to commit a robbery, you cannot hold the manufacturer liable for this. And so here they said that the guilty party are the issuers who are issuing these scam tokens, but not the person who created the foundational contracts on which these trades happened. So again, another analogy they used is like with Venmo, that Venmo can be used for drug deals, but that doesn't mean Venmo itself is doing something illegal. And so that's what led to this particular charge being dismissed and the securities claims being dropped. One other last aspect of this, this court was also one of the first ones to distinguish between decentralized exchanges and centralized exchanges. And so they said that here, in the Uniswap case, there was self-custody. There was no transfer of title of the assets to Uniswap or the companies or the other parties that were defendants here. In contrast, in Coinbase, there is the possibility of transferring assets to this centralized exchange like Coinbase so that they are able to then claim that they have title over these tokens. And so this distinction is very important. Another very important distinction is between the Tornado Cash case and this case is that there were no transaction fees going to Uniswap, even though they had the option to. All of the money that was coming from liquidity provision was being distributed pro rata to the liquidity provider. So again, the distinction between the value of the Uniswap token and the trades happening was more than in the Tornado Cash case. At least that's how it's been construed. So with that, I'd like to conclude, and thank you very much for having me today, and it's a great honor to be able to speak before you today. Thank you very much for the invitation.
Thank you so much. Normally we would now use the time for questions. However, Morshed is actually going to join us on stage for the next panel discussion as well. And it's going to be about one of the many things that you've mentioned during your talk about DAOs. Where is the liability, who's responsible under what jurisdiction, and so on. So for this purpose, we have assembled an expert panel where, yes, Morshed will also join us, but we also have several other experts on stage. Please welcome to the stage Anne Veerpalu from Tech Legal, Astra Tikas from Internet Native Organization, and Priit Lätt from PricewaterhouseCoopers Estonia. And the panel will be moderated by Mari-Liis Kukk from the Finantsinspektsioon, so I can follow the thread conversation just alongside you. Welcome them to the stage.
So thank you, everyone. I'm Mari-Liis Kukk, and I'm heading our innovation and innovation facilitators at the Estonian FSA. Today, this session is going to be about DAOs, or decentralized autonomous organizations, which can be governed through using blockchain. Of course, I'm sure that many of you already caught on from Dr. Mannan's keynote that this is not actually only a fintech topic. It's a topic that is much wider. And I'm sure that this topic is going to affect the way we operate more widely than just through financial sector. But of course, fintechs today, they are moving towards this way to operate through DAOs or using this kind of organizational structure. So today, I'm really happy with this 4 people here to help us to understand and build this better solution for DAOs. I will start with you, Aster, as you are also the co-founder for Internet Native organization. This is an organization that is actually dedicated to fostering this using DAOs. And my question to you is that maybe you can explain us all what are DAOs, how do they differ from traditional organizational structures, and maybe also what kind of value do they add to our society?
Thank you, Mari-Liis, and very honored to be here on the stage with such an innovative topic. What a simple question we have. What is a DAO? I mean, it's a decentralized autonomous organization, right? But everybody who hears this, they think, first of all, what is decentralized? And is it possible, like, autonomous also? Like, this is maybe something that I don't want to know anything about because it seems very dangerous. Maybe they think like this. There are a lot of concepts like what is a DAO, but right now on the screen you can see numbers, how many DAOs there are. 19,000 approximately, and if you see the treasuries, we are talking about billions, and it has been raising for the previous years. I think it was 1.5 years ago, it was 4,000 DAOs. So what are these? What is growing in our world, in our society? So what's happening is that we are growing globally into smaller, we can say, right? Because we collaborate literally in the internet. So the DAOs, they are not some new term. They are with us, I would say, since 2016, even earlier. So we can say they are community-oriented and code-driven collectives on the internet. But what is important there about DAOs is that they have smart contracts which are using the blockchain technology to work. And what we talk as an Internet Native organization, our organization always talks about this part of the DAOs, that what is the most important sometimes is not even the technology, even though the technology is saying what the DAO is. But the most important part of that is the collective intelligence, the governance models that you can foster, and transparency. So even we can talk about a lot how much confusion. I mean, we have the panel name, right? We have so much legal challenges. We're going to talk about that probably. Even though there is so much confusion, that the other part is still that we have a technology that can provide us transparency and clear understanding of the process, what has been happening, who voted for that, for what and why. So the DAOs can give us that. And from INO perspective, Internet Native Organization is working on a concept which defines the DAO in a different way. We want to not promote DAO itself, we want to promote Internet Native organizations, because DAO is Internet Native, right? And what is happening in this world is that most of the companies right now are Internet Native. You have website, right? You are using digital assets. Even our cash is somewhere in the cloud. So we are totally Internet Native, but still we are in the back of times where the law is kind of on the paper, you know. So how to reach out to that point that we will have internet-native organizations like really actually working. So this is our goal with internet-native organization. And on the screen, I mean, you can just take a picture of that. There are some examples of different DAOs in the world, very shortly going over literally investment DAOs, service DAOs, research hubs DAOs. For example, Vita DAO is a longevity project where different researchers come together. So, and investment DAOs they have a lot of venture capitals with them. And Ukraine DAO, probably you already might know that. Ukraine DAO is a very good example of what can happen if war starts and one side decides to collect money on crypto, let's say, because this is very fast. It happens without certain limits, right? Kind of dangerous as well. Okay, there's so much to talk about DAOs, definitely. And one thing I want to mention here, that DAOs come from Web3 world, but they will not stay there. They will join your daily life in the future. They are the future of collaboration, because we will take the best out of the DAOs, we will put it to legal forums, and we will use the ways how to collaborate on-chain, off-chain. We will use the governance methods and all these kind of things that the DAO machines have provided us until this moment. This is my personal opinion and also my organization, our organization opinion. But very, very quickly, next slide. I am so excited that we are here in Estonia talking about this topic on stage of FSA, literally. This is something extraordinary. The talks are going on in US and other jurisdictions as well, but as Estonia has been the country, I think it's time to really seriously talk about what we can do there, because if we don't do that, we will miss out heavily. And what's next after e-residency? There has to be something, right? Maybe it's an internet-native organization.
Okay, thank you, Astra, for this really great beginning, and I love the sparkle in your eye. Anna, I would now come to you, as you have written actually your PhD dissertation on the topic of regulatory challenges of DLT. And you have also been interacted with, I think, most, I would say one of the most or some of the most innovative companies through your company. Maybe you would give us this example of this globally known business undertaking that could be, more effectively managed through DAO than the organizational structure that it's using currently.
Thank you, and hello from me as well. I was thinking about this when Astra was speaking, that I think for most of us in the room, even maybe for all of us in the room, something like a DAO feels like very foreign. And I would say that you are right to feel that. DAO is not for us. It's not created for us. We will be using them, but we are not the creators behind it. Similarly, if you go back to 2007, 2008, 2009, and when sort of all of us became, were introduced Bitcoin, we thought this is not for us. This is somebody else's problem, or this is somebody else's solution to a problem. But the problem actually was somebody recognizing that the financial system needs a change. The intermediaries need to be sort of removed from the system. That was Bitcoin. So DAO, in a sense, is sort of the same sense. It's a strike of the nerds, the ones with a PhD in science, the engineers, against people like me and Priit and maybe Dr. Mannan here, because we are the legal science experts. We're from this discipline. We have maybe MBAs, you have science from the financial world, PhDs, and we make most of the money in banks and in corporate structures. We are the ones who are the CEOs, we are the ones who are in the board, we are usually also the ones who control the finances. And the engineers are sort of striking back and saying, well, we don't care about that. We want to develop our protocol, and we want a nice sort of revenue stream for it. And if you look at the sort of, I think, changes from Corona, you can also see people are preferring remote work and many revenue streams. They don't want to work for one particular employer 9 to 5 anymore. So whatever the structure is, whatever the organization is, I think all of the organizations are actually falling apart. I'm a lawyer, so I do organize, and I help my clients to organize general meetings of listed companies. Do you know how many people attend those general meetings? I'm alone in the room. So I think every single organization where you have many people who should care about how this organization is run, maybe the direct sort of participation in governance, like DAOs allow, is the next step. And because it allows sort of direct democracy in this sense, you can participate in every single decision if you want to. Or you can code it into the code and the decision is automatic. And maybe the organizations of the future will be like this. It won't be like it is now. It is something different. Whether it makes it more effective, I don't know. I've seen most shareholders who are not controlling shareholders, they don't actually care about, signing shareholders' resolution. Even with our digital signature, we don't want to really do it because our vote doesn't really matter. The majority already controls. So you asked the question, more effective than management or governance. I think people want to sort of be participant. They want to be heard. They want to sort of feel we're owners. We want to sort of feel that our vote matters, or at least that we are in control of our assets. And I think the engineers who are leading the DAO revolution, who have been leading the cryptocurrency, the Bitcoin revolution, they are sort of saying that we don't care about your bureaucracy. Don't send us your resolutions for digital signature. We can do it much easier, much quicker, much user-friendly for us, not for you guys.
Okay, thank you for this really great explanation. But I will come back to my question, and maybe I will get my answer from Priit. Maybe you can give us some example or.
Okay, thanks. Can I make 2 remarks before answering your question?
Yes, of course.
I wanted to make these remarks in the beginning of this panel, actually. So firstly, the title of this panel is Financial Innovation to Legal Headache, okay, DAOs or DAOs. So I disagree with this legal headache because every legal issue is a legal headache for lawyers and mostly for the businesses. So DAO is not some kind of special legal headache. That is just another legal problem to be solved by lawyers, by regulators, by lawmakers, by businesses. Okay, first. And second is more substantial remark. Please understand, DAOs are not crypto. This is totally wrong to assume that DAOs are crypto. Yes, some still argue, for example, Vitali Buterin still argue that Bitcoin was the first DAO. Okay, they refer to the network, blockchain network, but to me, DAO means much more. It's organization which deploys or uses smart contracts which work on top of blockchain networks, so DLT technology. So And for me, it's surprising to see statements recently from leaders from, okay, no name, but telling that the DAOs are root of all evil, or they are very, these statements are very crypto oriented. And it reminds me 2013 when Paul Krugman said that Bitcoin is evil, okay? So it's wrong. So please understand, and this is very important for the mindset, that DAOs, this is not crypto, okay? Now, answering your question, okay, yes, we do have some good examples how to use this great governance model in order to achieve some business purposes, okay, yeah. For example, we've worked with my colleagues with Estonian project, Teledisco, which uses DAO governance model inside of a private limited liability company, OÜ, okay. So I think this is the first OÜ in Estonia which is connected to the blockchain technology inside. It operates as a DAO. Outside there is a legal wrapper, private limited liability company. But this is actually, this is not the crypto business. It's actually operates some 6 mini disco telephone booths. 4 of them are located in Berlin. 2 are, you know, moving all around the globe. I do hope we will see one of those booths soon in Estonia in December. Let's see. So, and the idea behind the DAO is actually to manage the shareholder register, okay? And secondly, you know, to make voting more transparent and easy, okay, yeah. And last but not least, to do justice. I mean, instead of, you know, focusing on shareholders, they want to using the DAO model, they want more employees or contributors to be part of the business, okay? Using the governance tokens, which they share with those contributors who put their time and efforts to the business, okay? They treat the contributors as shareholders with the help of DAO governance model. This is one great example from here in Estonia. And another one is totally different thing, again from Estonia. One of my clients established non-profit association, M2, okay, to use as a legal wrapper for a DAO in voluntary carbon credit market, okay. And at one point of time, they decided, hey, stop. We will not implement DAO model. Why? Because the market wasn't ready, or, sorry, investors weren't ready to adopt this governance model, and they said, hey, maybe we just, we have a progressive decentralization plan. Okay, let's come back and instead restructure our business using ordinary legal forms, limited liability companies. And they did it. But still, they kept the long-term plan, decentralization plan, which still entails implementation of DAO governance model. So you see, the lawyers are blamed to be deal killers, but in some cases, real-world examples, the businesses or investors, venture capitalists are themselves not ready to use DAOs. And they say to the great business minds that, hey, let's use some traditional models, which means that there needs to be a culture first, and then machines. And we need to speak about the DAOs. And thanks to this event, this is good platform, you know, to tell to the people that DAO is not crypto, it's not evil, okay?
Thank you, Britt. Thank you for those explanations and also those additional comments that you gave us. Morshed, you have a book upcoming on blockchain governance, and you have also in your research focused on the challenges that DAOs face. Maybe you can give us this overview. What's the biggest challenges currently?
Yes, absolutely. So I would say there are many, but three that I would mention right off the bat, and following up on Britt's point, is that we're seeing DAOs that use a legal form called a legal wrapper. So that can be a corporate entity, like a private limited company. It can be a private limited by guarantee, a non-profit. Also cooperatives, trusts. There's a zoo of these sorts of different entities that can be used. All of them present different sorts of challenges. So let's say the true DAO, the ones that are not using any wrapper, what we're starting to see, especially in the US, are cases that raise the prospect that these DAOs, as organizations, are general partnerships, and as such, all of the members of that general partnership are jointly and severally liable for anything that DAO does, especially if anything goes wrong. So we have a case called UkiDAO related case that happened earlier, and the early opinions that we've seen about this UkiDAO case basically raises all of the problems that can emerge from joint and several liability. 2 people were identified out of the many other pseudonymous people. They happen to be in the US, and they're the ones who get put onto basically trial because they are the ones who've been identified out of this. So of course, that's one big challenge for those who might be interested in a DAO, saying that, well, if I do this, I put my neck on the line. Maybe I'm in the US, maybe it's easier to find me online, et cetera, et cetera. Even when using a legal wrapper, and many of the examples that Astra mentioned earlier do use a legal wrapper, Britt mentioned Estonian ones, there the issue can sometimes be bureaucratic compliance. So this can range from issues about, well, we are a DAO which doesn't have a board of directors. We are forced to now have a board of directors because our legal wrapper requires us to have a board of directors. What does this mean? It means that I now have someone who is an administrator. That person doesn't want to be an administrator. That person might not even be in the jurisdiction where the legal wrapper is. How is registered? How do we actually, match these requirements and then actually, interact with the whole state apparatus, everything from the business registrar to tax to, all of these different issues in a compliant way while still being true to why we created a DAO in the first place. So the first is the different legal uncertainties that arise for both wrapped and unwrapped DAOs. The second that I would mention is it relates to the points that Anne and Britt both mentioned about participation. So some of my research recently has been about looking at governance of DAOs and platform cooperatives, which is an allied sort of concept, a little bit broader, doesn't necessarily use blockchain. And a recent paper I published studied 21 of them and did a lot of interviews with the founders of them to understand how participation is working. By appealing to cooperatives, they go a bit further than private companies. They don't have, one share, one vote. They're one member, one vote. So they pride themselves on being democratic firms. But what I found in this research is that even whether they use blockchain, whether they don't use blockchain, whether they use other tools, there have been participation problems because just by giving them the tools doesn't mean that people will actually use those tools. So that's one aspect about a challenge that I see. The same can be said to transparency. You actually have to do something with the information that is transparent for it to actually be effective governance. But the other aspect is another case, and I'm sorry that from my talk and today I'm giving one case after another, but I think it makes it more tangible. There's a case, again, a financial case about the mango markets, which was basically an issue where the governance tokens were considered to be fraudulent. At least that's what the complaint says. That hasn't been decided yet, but the charge is that you give these governance tokens, they supposedly give you some governance rights, but then what if they're fake? That can obviously mean that you end up having a lot of problems of holding accountable the issuer of those governance tokens. So I would say that's the second one, the problems of participation and transparency. And thirdly, I mentioned the DAO attack in my keynote. that's not the last time that there's been a technical vulnerability found in a DAO or in a blockchain project. And those technical vulnerabilities still exist, which is why we're now seeing almost this little bespoke industry or boutique industry of auditing, of smart contracts, auditing of DAOs and so on, to be able to constantly try to make sure that DAOs are not vulnerable. And I feel that any future of this particular sector will rely a lot on these auditing and accreditation bodies.
Morshed, I have this another question for you. You have also worked on this Koala model law for DAOs project, and maybe you can also describe this one and maybe also the approach it proposes.
Absolutely. So,
sorry, this is a law, model law.
So this is, it's a few years in the making. Essentially, we started working on this around the time that I was still working on my PhD, and it's already been a couple of years that it's published. We're actually working on version 2.0. A little bit of very brief background. Koala is essentially a nonprofit organization comprising lawyers, software developers, and other interested parties who work together to develop a model law for DAOs, recognizing that especially unregistered DAOs face certain challenges, and we need to be able to think of how to overcome those challenges. It's very, in that sense, the very simple explanation of this. What we follow in terms of principles is something called functional equivalence and regulatory equivalence. So those of you who know internet law or e-commerce law would be familiar with this. So functional equivalence is the idea that a digital signature is equivalent to a written wet signature under certain circumstances. So we try to use that as like a through line through all of the text to see how can we build functional equivalence of DAOs with existing corporate entities. The second, the more ambitious one, is what we call regulatory equivalence, which is that we try to identify what the policy objective is of a particular law that exists in company laws. So for instance, registration in a business registrar, and think of whether there are certain technical means that can be used to achieve that public policy objective. So for instance, if we think of the example that, well, we want to register companies in a business registrar so that there is publicity, there is transparency, et cetera, et cetera. This is quite common across many jurisdictions. Then we try to say, well, can we achieve the same sort of public policy imperative of publicity by having all of the data about a DAO available on one single interface, on one single web page, for instance, or other type of public forum, which would meet the same requirements while being a DAO native solution. So that's basically the whole idea behind this, without having to force DAOs to use any existing legal form. So what this leads to, and the scheme of the DAO model law very briefly, is that you follow everything from like what the purpose of a DAO can be all the way till what does it mean if there is like some sort of technical problem in the DAO, what does it mean for a DAO to be dissolved, the internal governance of the DAO. All of these aspects are covered. We draw a lot on other model acts that have been created for for corporate entities in the past. We looked at, in Europe, you had the Model Company Act in the past that European corporate lawyers developed. The Organization of American States also developed one for the Simplified Stock Corporation. We looked also at a lot of UNCITRAL and UNIDROIT rules as well, that all concern tax and corporate entities. So we recognized, and this is what I will end on for my part right now, is that DAOs, if they're to have a future, they're not going to just be in the financial industry, even though that's where it started. A lot of my work looks at service DAOs. I have a paper that just came out that's a case study of DORG, for instance, which is basically a software developers collective. So I think part of that will be the future of this. And our model law tries to cover all sorts of DAOs, not just the financial ones. It tries to, by using this functional and regulatory equivalence, lead to a type of middle ground between keeping the true qualities of a DAO and the type of concessions that the state will expect in terms of meeting public policy imperatives, so that in exchange, these DAOs can benefit from limited liability and legal personality if they are good actors. And so we have provisions about when you would be considered fraudulent, when you would be considered to be acting in a way that you are challenging judgments or trying to ignore judgments, and what are the implications of this. So our hope is, as we develop version 2.0, we address issues like taxation, going beyond using the Ethereum blockchain to other sorts of blockchain blockchains and the DAOs that are created there. But I'm really excited to be here, partly to hear about what would be the concerns from, let's say, the Estonian state or Estonian regulators about creating or acknowledging the existence of a new legal entity form in this particular type of historic moment where we might see not only corporations and cooperatives, but internet native organizations and a new type of entity coming into existence in the next few years.
And thank you, it was comprehensive. Maybe Priit and Anne, you can now just reflect on that. Is it something that we could use in Estonia, or are there some additional options for us?
No, I just wanted to sort of react to this, that a lot of the sort of first discussions on DAO to people who are not accustomed to this word or this abbreviation sort of makes it, this is like from another world. Just, I want to remind you, or maybe bring you back to the basis that there are humans, like we exist like organisms, and there's things, and it's easy to grasp that. I can hold it, I can touch it. Then we have created abstractions such as rights, and securities are also rights. So we have created abstractions like legal entities. They're abstractions. It has developed over time. Now, the sort of abstraction of a DAO is sort of like just taking another step further and recognizing that maybe there should be something different now that we have something different existing in the sense of an infrastructure, the infrastructure of the protocol or the network or like blockchain that Dr. Mannan was talking about. So the infrastructure of World Wide Web also changed everything for us. And we are just used to it now. Like we are used to securities, and like we are used to commercial registers, and like we are used to legal entities in the forms we recognize them now. DAO is just one more abstraction, and if we have expanded our mind towards rights and securities and legal entities and commercial registries that are based on protocols now, centralized, but still protocols. So expand your mind towards DAOs. It's just one tiny step further.
Thank you.
Great. Yes, when I read this great model law back in 2021, okay, when you released it, then I said, yes, Estonia has to adopt this model law. But now I'm not so sure anymore because as I already told, my experience showed that we can manage somehow using, from legal point of view, using, the available legal forms in Estonia, for example. But it all, what is the question? What is the Estonian policy objective? What is our ambition as a country? And for example, for UK, it's clear they want to be the global crypto technology hub. This is their clear vision. I like it. We can't copy, I'm afraid of. But if Estonia still wants to be a technology-oriented country, then I think Estonia should consider adopting this model law, and even I think this model law is intended for unincorporated or unregistered DAOs. Okay, yes, register is a very central thing, It's, but maybe when in Estonia DAO is not registered, then it's called the partnership seltsing in Estonian. So maybe we need to amend Estonian Law of Obligations Act, võlaõigusseadus in Estonian, the partnership chapter, implementing these articles, not many of them, some 20 plus articles to Estonian Law Obligations Act, to have clear legal, framework for partnerships which don't want to be registered in a commercial register, but who still have some great features of legal persons who are registered. So my answer is yes, we should, Estonian lawmaker should consider this model law.
Can I say one more thing? Because it's related to, as an attorney at law, recently there was a training by the Supreme Court Judge Urmas Volens on the Commercial Registry Act that is quite recent, that has created a lot of problems for practicing attorneys as to sale of shares. It has changed our life and made it worse. So we had a situation where there was a double sort of, we had the Estonian Central Register of Securities, and now we also have commercial registers sort of meddling in, and there is another option. There is the option of shareholder register being maintained by the boards, like we used to. And like you mentioned, functional equivalence. My PhD was also focusing on functional equivalence and the principle of technology neutrality. I did look at this option of using blockchain technology on maintaining or administering shareholders' registries, the ledgers. So the core topic of what the Commercial Registry Act now changed. And I said, well, we don't need an administrator. We actually need a process and a protocol that is transparent. When I say the word transparent, and when Dr. Mannan was saying the word transparent, and you were like thinking, well, transparency in the world of code, I don't understand code. That is not transparent for me. I'm not an engineer. I can't understand what transparency is in that context. But I do understand that if I say that this registry or this depository is given like a permission or a certificate by a state, then I trust it. Like my confidence is not based on something I can understand in code. My confidence is based on the sovereign giving a certificate, just the same way as digital signature works. You trust only the certificates issued by the ones who are given an authority to issue certificates. All of the digital signature system is based on the sovereign issuing a certificate, not a protocol that is transparent. But, it's just a frame of mind. Either you see that you trust a person, or do you trust a system or a procedure or a protocol? And the transparency, I do understand, and I feel the same. I'm a lawyer, I'm not an engineer. If somebody says the protocol is transparent, I'm like, I need a technical guy to look at this and tell me what it does. And this is what I also do. I do hire the technical guy to look at the code and tell me what it does. And then they interpret and translate this to the lawyers and judges and the state and the regulator and maybe the sovereign. And this is sort of where the transparency comes from.
Thank you, Anna. I think now it's time to take a question from the audience. So, yes.
Hello, Veerpalu. One question, it's maybe more philosophical. Maybe one thing which confuses a little bit myself is on DAO side is the D and A. And if you look at the examples, are they really decentralized and are they really autonomous in the most cases? The example Preet mentioned, is it really decentralized? Is it really autonomous? And can the decisions be reversed and changed outside of technology as well? And I think, for example, from Estonian perspective, first DAO, as I see, at least attempt to build a DAO was Vabaerakond, actually, who tried to build their whole political party on same voting principle, that we don't have to have like political ideology, but we have the possibility all the members can vote. But yeah, my question is on the, is it really D and is it really A? Thank you.
Yeah. Can I take that?
Yeah.
Thank you. Thank you for the question. It's a very easy question, actually. Because I think every person can think differently. It depends on the data which is in your hands. So DAO doesn't have to be decentralized. DAO is a technology. We can say like this, right? It's an organizational technology, and you can use that to foster your organization's processes, automated decisions, governance. You can use transparency, you can use more privacy there, but it's your decision how to make it. It's your decision how automated or how decentralized you want to do it. So again, we come back to the point like, what is a DAO? It doesn't have to be fully decentralized, it doesn't have to be fully autonomous. It's your decision to make what kind of organization you build and what kind of entity you want to use for that, or what kind of code, and how do you connect the points. So it's a technology.
Thank you, Esther. I think this is a topic that would need just an hours of discussion, and I think we don't have it anymore. So I will thank you all for listening this panel here, and of course, big thanks to you all.
Thank you.
Thank you. Thank you, everyone.
Thank you very much to all the ladies and gentlemen on stage. I'm going to keep it very short because we're a bit behind the schedule if you take a look at the agenda. However, before the lunch break, we have one more panel discussion, and we already talked about showing the code to the programmer who can give a better idea of what the protocol is about and so on. We want to go one step further in the direction of cybersecurity. I mean, the question is overall, how does cybersecurity get dealt with in the area of digital finance? Does digitalization of finance mean that the path for bank robbers to the bank is a lot easier than it used to be before? Is it better or easier for police to track the footprints online than they used to be trackable in the mud? Where do we stand on this? And for this, we've got, from many different stakeholders, again, a lovely panel. We've got Ago Ambur from the National Criminal Police, Matis Mäekar, who is from the Financial Intelligence Unit, Tõnu Tammer from Estonian CERT, that's the Computer Emergency Response Team of Estonia, and Marliis Uusjärv from Swedbank Estonia, and the moderator will be Kalle Klooster from Finantsinspektsioon. So please welcome them to the stage.
Okay, everybody's here. Thank you, Florian. Thank you, everybody, for coming here today. So we tried to make it a little bit more interesting that way, so we wouldn't fall asleep before lunch. So, and start talk about criminals and cyber criminals especially. Maybe to make it more personal, I start with a confession. When I was a teenager, like in 7th grade or somewhere, I was very interested in internet and computers. When it was first introduced to me, I was fascinated. So me and some of my friends...
Before you finish, sorry to interrupt, yes. Think whether 10 years has passed and if you're going to confess.
Yes, I'm also a lawyer now, so thank you for this remark. Everything is considered safe at this time. So that's why I mentioned we were like 13 years old. Minors, so no criminal act can be committed. Ago is also looking positive so far. Anyway, we started our adventures in the cyberspace mostly driven by curiosity and mostly committing, how to say, acts that are now considered hacking, I think, and some maybe terrorism. Anyway, it was very interesting times, and me and my friends had always the best grades in the computer class because the teacher was so afraid of us. And but I still remember the feeling, the good, positive feeling that I had when I first acquired control over my computer, over my teacher's computer. Through the network, through the local network. Yeah, well,
times have evolved, and now such cases can be read in the newspapers. And well, today it's already second time I meet with Ago. First time was we had morning coffee together, and he was in the newspaper headlining one of the maybe recent evil hacker case, which is successfully brought to the table of prosecutors by Estonian police forces. And well, the acts are somewhat similar that I described, but they are not anymore driven by curiosity of teenagers, but they have a more serious, let's say, background. So maybe, Ago, you can introduce us a little bit modern cyber criminals and...
Sure, thank you. Yeah, well, maybe just to quickly reflect.
Handcuffs are here. Let's go.
We will have time later on to discuss about that a bit further. But I would still like to reflect. Back at the time, do you think like it was more the young people at your age back in the time? Do you think they were more aware of what they're doing, of the like possible implications of those acts, or do you think like there was no awareness for those youngsters at the time in terms of what the cybercrime is or what those acts that they're committing could bring?
Yeah, for us it was, well, in our minds it was something like that. If it's technically possible, it is allowed, because there was nobody to ask. There were no laws. Well, of course, I don't think we were in the, let's say, very interested in Riigi Teataja back at the times. But now I do know that maybe such crimes were introduced a little bit later to our penal code. So our interest was pure curiosity, and well, we high-fived each other, and everything we achieved was for us considered a great success. And a teacher in a way, I think, teaching computer class in some sense was happy as well for us. Yeah.
So you made improvements over time.
Exactly. Yeah. This is a learning process.
Yeah, I think this is one of the like key points that we try to focus on as well, to introduce. Like we've been talking about like cyberbullying for ages, but actually like the awareness on cybercrime, especially for young people, we need to bring that topic into light. But to move on to as you mentioned, like the penal code has changed, and so has the cybercriminal ecosystem. So today, when we're talking about cybercrime, we're actually talking about something that's very service-oriented. So there is, in order to commit the cybercrime today, in order to penetrate those computer systems, you actually don't have to have any skills, whatever, to understand how those systems work. You just pick different services online, accumulate those, and you will be in the network, and you will also have, as a side effect, you will be able to pick services online. If you're financially motivated, then those services would allow you to extort those financial gains and launder those financial gains. So today we're talking about a very service-oriented environment where there are super skilled criminals working behind those services who are experts at their field. And today, I guess one of those fields we're going to talk about is with a financial nuance. So we're talking different money laundering services, different operators who allow you to register, who would register accounts at cryptocurrency exchanges for you, and so forth. So I think that it's good that you brought this up, because this has changed over time a lot.
Actually, where this comes from, oftentimes, is how we feel as people. At some point, it gets reflected in the law. Similarly to you, when I was studying in the UK, it was my first. Well, I started in 2004, and this was in the winter of 2004. I somehow found online the examination for the first semester. with all the questions. I only looked at the first 2 out of I don't know how many, printed them out, went to the dean's office, and I said, well, if I could somehow, get lost into that system, which wasn't by no means deliberate, then maybe someone else will do it and use it in a more malicious way, and you should maybe think about the security and all that.
White hat hacker.
Well, I was thinking of that principally, and then followed 2 hours of the best time in my university, when Dean, who was also responsible for cybersecurity classes, did a private lecture on ethics and why people feel hurt, and sort of, if I steal your car, you are probably feeling, you have strong emotions towards me, and it might get physical at one point, and this sort of thing can happen. If we look at these days, and in the case you referred to, where Ago was famously in the media this morning again, then a few years before, a similar incident occurred in a similar service, which could have been far more disastrous. The vulnerability that was in the system provided, at least in theory, access to much more of the information. However, again, that bug was discovered. The person who discovered and then disclosed it to Estonian Information Systems Authority tested it with themselves and used their sister as someone else. You did not have to repeat the process 300,000 times to verify that it is possible. And they did disclose to us at the time, and you did not hear about them in the media in that way. So I think people's perceptions have slowly started to change, in the sense that we do recognize that the systems become complex. We need to look at other ways of dealing with security.
Yeah, definitely, I agree with you 100%. And this reminding back to 2004, this brings into my memories another maybe somewhat famous case of cyberspace criminal activity of maybe more directly connected with financial sector, which is actually the topic today, when some young stockbrokers invented a way how to access some newswire information before the other investors, and therefore gained some tens of millions of dollars profit from trading using inside information. And this case was, I think, also pretty publicly disclosed in media, and somewhat considered as maybe appearance of professionalism. But talking about penal code, I also see the same paragraph used for hacking is sometimes, well, under the pretty basic activities, like somebody has stolen a bank card and used the PIN code, which one is not supposed to, and therefore gained access to computer system. But actually, the activities behind that are, well, I wouldn't consider them very professional. It's just basic theft. But I think banks these days are very interested in even such cases not happening, and therefore we share with regulators and other authorities, we share similar goals. Mari-Liis, you certainly have some insight into that. How is Swedbank doing in that sense, fighting criminals?
Yeah. Oh my God, that's so weird to hear my voice here. But yeah, thank you for inviting me. I heard somebody whisper that it's interesting that commercial banks are not represented, so don't worry, I am here from Swedbank. So yeah, the security of our customers' data is yes, really important for us. And we also are performing annually the threat landscape analysis. And in top 5 risk, yes, it is the customers and the frauds against our customers. So it's a really important topic for us that we try and also do to raise the awareness of our customers to not fall as a victim of any fraud attempt or phishing emails or smishing or phishing or whatsoever. But we see that it gets harder and harder. And I haven't heard a long time here that somebody has spoken about AI or ChatGPT, especially ChatGPT. I know Tõnu is coughing here because
there are other buzzwords.
Yes. I myself also don't like this definition AI, because for me it's code writing, code composing. There is no such thing like magic behind that.
Well, actually, ChatGPT scored when it comes to language models, IQ of 155 for an average Estonian. It's just over 100. So in terms of that, there is a...
Yesterday on Microsoft conference, they said the average IQ is 115.
In world?
Yeah.
For people?
Yeah, for people, yeah.
Don't trust Microsoft.
Those are only the ones who passed the test.
No, I feel bad now. But yeah, since we are talking about ChatGPT, and we also talked at first about the childhood, so I can relate for that in that topic, because my son turns 18 tomorrow. And I think it was about half a year ago, he asked me, Mom, we have now ChatGPT, why I have to go to school? I was like arguing with him. He's a very good argumenter also. He's a quite smart dude. And I said, no, you have to go to school, because then you are developing your brain and brain cells, and then you have more connections with other topics, etc., yada, yada. And he argumented, but I never used this knowledge in my real life. And we argumented, and finally I said, if I run out of my arguments, you have to go to school, because then you have a certificate that you ended your school. And he was like, okay, but I can generate it in ChatGPT and print it out. And I was, okay. So, and another thing, then after that, inside my brain, I have a monitoring system also, and an alert was blinking that something is wrong with the mindset right now with youngsters. And a few months ago, Jaan Aru, this brain scientist, spoke in one of the security conferences, and also said that ChatGPT generates such results that you see that it's like a trustworthy source, and it sounds like you can believe it. And he said that he got an email, and there was like an email, you are the chosen one, you won some kind of a science award. And he was really flattered that, oh wow, it's every scientist's dream to win such an award, and felt very happy. His inner side was jumping around. And then he looked twice this email, and then he realized, no, it's a fake, it's a scam, some kind of a scam. So my message is that it is harder and harder every day to understand if the emails or SMSs or whatsoever, are they really valid? Yep. And my message is that you have to be critical what you see, what you read, what you hear. I'm not thinking that you have to second guess everything, but you have to use your common sense in that respect. And also when we are talking about my son, because he's turning 18 tomorrow, so I will lose the view in his banking account. I'm a bit worried because I know how the fraudsters work, and I also became a fraud victim. I think it was 1 year ago, but it's quite embarrassing to talk about
just between
here.
us.
Yeah. Promise you won't tell
Supervisory authority
everyone.
will not listen.
Yeah. But since we are broadcasting this over YouTube, so if you are interested, you can join me at lunch, and I will tell you. But you have to promise you won't tell anyone.
Okay.
Thank you.
Thank you, Mari-Liis. Very interesting indeed. And of course, I just read an article before coming to the stage here. Do you know who is one of the main, most popular finfluencers these days? One of the most popular was Anu Välba, and also Kersti Kaljulaid was having a lot of finfluence amongst, I can say, victims of modern cybercrimes. They were fake identities, of course. But I can confirm you that on this stage at the moment, it has nothing to do with deep fake or holograms. So we are real, and I think we are not only real, but also some pretty smart minds fighting cyber criminals. And maybe this is a good situation to let Mati speak about modern algorithms and smart tools that FIU is using, as I've heard of.
Okay, thank you. First of all, thank you for inviting me here, and a very well rehearsed introduction to this panel. I was just thinking to myself, there is this person, a man called Eamon Dean, who is actually a converted terrorist out there, that after 9/11 in 2001, he decided that he doesn't want to deal anymore with Al-Qaeda, and he became a spy of a British agency, and now he does a show telling people how those terrorists operate, how they think. So if anyone is interested, there is a show or a podcast called Conflicted, and it was, the start was a bit of similar, that we have a cyber criminal here helping us to unravel how cyber criminals operate. So well done. If to answer the question that we have at hand in our panel, how can financial innovation make life more difficult? I think the first question we should ask is whether it makes the life more difficult. And I've thought about this a lot. So I think, first of all, financial innovation has made it easier to do the crimes, to commit the crimes. But it's, yet again, the financial innovation helps us to protect the assets at the end of the day. It is very hard to use the assets stolen by the cyber criminals, and it's also more difficult to hide a crime that they have committed. So there are two ends of this game. First, yes, it's easier to commit the crime, but it's harder to protect your crime. It was very interesting to hear about the professor talking about different crimes being committed over the technology, over the ledger. And yes, you see, for example, this tornado cash. I don't know how many of you have knowledge about this case, but yes, there is this North Korean crime group, Lazarus, who actually goes around, steals people's assets, or takes you into hostage and asks for a ransomware. And they use all kinds of technology. They use smart contracts, and then again they use tornado cash to obscure the true origin of the assets, to launder the assets. And you see that there are actually no ways how to block tornado cash, because they were sanctioned by the OFAC. I think that this is one of the most, the biggest authority in the world that people are afraid of, because if you're being sanctioned by OFAC, basically you're being cut off from everywhere, and tornado cash is still operating. The same is with Garantex, which is one of the leading laundering factories for the Russians. Incidentally, it was an Estonian company at first, but now they are operating in Russia. And they are still operating despite that they are sanctioned. So here you have proof that it's really difficult to take the criminals and put them to work as you hope that they would work. But then again, they cannot use the assets. Or, I mean, I don't know how many you know, the third-party vendors, I don't know, Chainalysis, TRM Labs, that also help to see what is happening on the blockchain. And there, for example, you have bells. Whenever you try to wire your assets further, the bell starts to ring. And now the law enforcement folks, they just wait when the assets are in a place that they can get hold of. So then again, it's more difficult for the cyber criminals to use those assets. And I know most recently, we know we have a war also in Israel. We have a Hamas that has publicly said that don't send us assets through blockchain because we cannot use them, because law enforcement folks are there waiting for the assets to come on our wallets and they will block it. So don't use this tool. So yeah, all in all, I think that there are two sides of the story. It is more easier, but then again, is it easier to use the assets if we all apply the regulation, if we all are diligent enough as financial institutions, we are diligent enough as FIUs or law enforcement people?
The reference to North Korea and the tech side, I think it's relevant to make. If we look at the history of financial crime, we heard a lot about card skimmings and attacks towards ATMs, etc. We don't hear them anymore so much because technology has improved to the point where this sort of attack is no longer beneficial. And the reference to hacking groups who target high-value enterprises, they generate a lot of media coverage because they are asking a lot of money. It's understandable. But my argument is that technology is there already to make that sort of attack virtually impossible. If we look at the last attack, which took place towards Okta, it's a big authentication system provider. Cloudflare had the technology to stop, even though you had all the credentials, you had all the possibilities, but you simply came from the wrong device. So technology is there to counteract a lot of those risks. Where we don't have technology is upgrading this little thing over here. Mm-hmm. And I'm not talking about only myself. I'm talking about how many people we have in the world? 7+ billion? 8. Well, there you go. So talk upgrading that, and we see a lot of people falling victims where the attacker isn't even too much of a technically skilled person. They are simply manipulating on our social understanding and all that. And maybe this is an answer to the question to your son, is that it's not the technology that perhaps you need to understand, but more on understanding how you as a person can be strong. And this is not where technology can help us. And this is something where we need to learn for ourselves. And although we have put in place different technologies, do people realize what happens when you do beep, beep, beep on the phone and you've just authorized the financial transaction of someone else? Do we realize? Do we actually get this taught in school? That inserting a PIN when you use a POS has a legal consequence.
Yeah, but Lazarus is, sorry to interrupt, but Lazarus is using different approaches, not only through people's minds, but they are also taking the smart contracts and trying to find a backdoor. And I don't remember the case specifically, but I think it was around 600 million that they stole. They cannot use it, of course, because people are tracking where the assets are. But they looked at the code, and if you did a specific action, all those assets were transferred to the place that you said to be transferred. So there again, they looked at the code and they breached the code. Of course, the latest case that we have in Estonia, I don't know how many you know, but there is one virtual asset service provider, a crypto firm, that was hacked during the summer. And it wasn't hacked because they breached the system or customers' accounts somehow. They breached through a human being, as you were saying. A person was clicking to a wrong link, and the lawyer could get access to, they said, not customer assets, but some assets, at least 35 million euros or dollars, I don't remember anymore, were stolen. So I think that they are using both mechanisms, not only human beings and their stupid minds, or however we call them, but also the protocols, the systems, the technology itself.
Yeah, human is very often the weakest link of the computer system, right? As we heard these cases, and but still there are other humans who are behind the schemes and hacks and everything, and usually they have created an international chain of servers, proxies, jurisdictions, persons, and when the victim goes to the AGO and says, hey, you are the police, please help me bring my money back, or at least put the bad guys to jail, your job is not easy.
Correct, and I think if we come back to the point of cyber criminals having an ease of access to those kind of services, and those kind of services being quite easy to implement. If we come back to this current example, for instance, well, yes, we have those bells and notifications and alerts in place, but if we also read on a report that was made like 3 weeks ago on how Grantex was able to, quite simply by having a few indirect proxies in front of their own wallets, to funnel funds through those, was able to bypass some of those detection mechanisms, then we can actually assess that this was some kind of capability that they probably built with a week, whereas in a traditional financial system, it would have taken potentially a lot longer to implement all those proxy banking accounts. So it makes it, as was mentioned earlier, a lot more easier for them. And for us, it highlights the key point that we operate on factual evidence. And this means observability. We need to have observability into what we investigate. One of the reasons being the example you provided, if somebody's losing funds, we need to be able to find out, follow the money. That's one of the ways police investigates crime. Another one being also, if we want to see where the actual impact, where we can have the actual impact in the case of, for instance, the Reda cache, we also need to have observability. We also need to be able to understand like where those criminals accumulate, because it doesn't make sense for us to investigate 100 criminals when we actually can see that they use this one specific service, and by disabling that we can actually have more impact and potentially go after those 100 later on. So in that sense, observability is key, and here we can safely say that financial innovation has made it more difficult for us, because there's just so much abstraction, so much different technologies that we have to understand in order to pursue those funds and actually have insight into what's going on. And this is very costful. This costs a lot in terms of human man-hours, in terms of, if we need to outsource some kind of solution, partnerships. So this is, for us, the key issue, having good observability.
The title of this panel, just to remind, is how technology can make it more difficult for cyber criminals, not for the law enforcement authorities. But at the same time, it is true that when we look at possibilities created by technology, I think you all remember the time when during the business day, money you could transfer from Estonia to Belgium, well, sort of took at least 4 hours to 2 days. So let's say I send you a fake invoice, you accidentally authorize it, and you realize that within sort of 4-hour window, you can call the bank, yep. they can put a halt to that, you can turn that transaction back. Now, how many hops can that payment make throughout Europe since you discover it, and it takes you some time to write an email to AGO, please help me? How many hops can it make? And then for each of those hops, team behind Ago's work need to draft a separate letter for assistance to different countries. You know, you look at all these possibilities, and it's evident that to a degree we are not making it more difficult for cyber criminals. We are actually making it more beneficial. But what is the financial benefit of having those payments move instantly? And which amount is bigger, the benefit or the damage? If the benefit is bigger than the damage, which principally it should be, the question is, how is the distribution? Because somebody gets the short stick always.
Yeah, that's true, and I think it's like, if we think more about society, there is always, let's say, a vulnerable part that we shall protect as an authorities. We as an FSA do it, you as a police do it, Mattis does it, we all do it. Commercial banks also are interested in protecting their clientele and also themselves. And I think that maybe that's like, if I say, we introduce cars to the people, and but there is always somebody who would say that cars are dangerous because
it allows the bank robbers to escape faster.
Exactly, and so on. But
yeah, I think this is a very good point, because as we were talking about tornado cash here before, I think the analogy here, let's take guns, for instance. You can protect yourself with a gun. You can take the gun and go to a shooting range and, you know,
rob a bank.
Or you can use it to rob a bank or murder someone. And if we take this tornado cash, I would say that somebody has designed a system where there is a button somewhere in the ceiling, and you can use a stick, you know, to poke the button, and it will drop a gun on your head. You can bring it up. But we can't reach the button. We can't disable it because it's up there. You can still poke it, you can still drop the gun and go do something with it, because somebody said that, well, I need to protect my, you know, my Bitcoin transactions, my privacy with those. But then again, you know, there is no real way of actually establishing control over the button or bringing it down. So hence, the people behind developing this button were taken responsible for that. So I think this is a really good analogy, and I might be biased because we in police, from 8 to 5 at least, see crime. So I might be biased. There might be good use to this button, but I'm pretty sure if you take a breakdown of the funds flowing into tornado cash, we probably see you know, a lot of red and not so much green.
Can I jump in here?
Yep.
I just want to say that we shouldn't blame the financial innovation here. We should actually blame the regulators for not having enough resources, and the market participants for not having enough resources to protect those transactions. If you would have enough systems in place not to allow those dodgy transactions to go through, as you were saying, within hours or within minutes, if you have proper systems in place, they would not happen. So right now we are blaming that the system is too speedy, or that we don't have systems in place to track down those criminals. But perhaps we should look into our eyes, to look into the mirror, to say, what have we done? Because the cyber criminals, or the criminals, they are always 2 steps up ahead us. So what should we do then to first catch them and then surpass them? So I think this is the trick here, not to say that the financial innovation per se is helping a lot them, because it is, but we are not doing enough. And this would be my argument, counter argument.
If it came across like technology is bad, then this wasn't necessarily how I wanted to phrase. A colleague of mine told a story of a relatively old woman, sort of in their 50s, coming to a branch office, wanting to make a payment to Turkey. The clerk working there realized that she's a victim of a love scam, but the woman was insistent. It's my money, get the head of the office or the branch, I want to make my payment. So she got to make the payment. Within 3 days, she comes back, eyes looking red and wet, you know, saying, this is the 3rd time this is happening to me. How is this possible? And the point is that the technology keeps developing faster than the education of people. And we need to recognize that the tech can actually help criminals. Where we don't do enough is actually educate our users. What risks come from all the benefits that the new tech brings, what are the risks? And hey, with these opportunities, please be aware of those risks.
Yeah. Can I continue?
Of course,
yeah. I agree with Tõnu and everybody here, but I'm just thinking that smart technology and intelligent solutions are for smart people and intelligent people, but maybe I rephrase it. I don't mean by that you have to have A's in the school, but you have to behave in a smart and intelligent manner. That's what I'm referring to. And since our topic here is how can financial information make life more difficult for cyber criminals, I wanted to bring Swedbank, one of the solutions in here that may help in the future to fight against the cyber criminals. At the beginning of the summer, we were piloting Swedbank own ChatGPT, and the piloting period will end at the end of the year. And this is a one-way solution, that which means that we can download from external network information, but can't upload it to external. That's our own ChatGPT. And as far as I have heard, the feedback is really good. 60 or 70% users said that they are satisfied with this solution. And where I want to go from here is that in the future, when this pilot project is over, we can see that it may help us in KYC procedure, know your customer procedure, which helps to finally helps to fight against the cyber criminals and money laundering. So, but yeah, we have right now rules in place. We cannot process confidential or sensitive data in there, or personal data, and also rules that you cannot use it to process any violation info or something like that. So yeah, we have rules in place. Also, we are piloting right now. So yeah.
I just wanted to say, I think there has been the same discussion 35 years ago when the Financial Action Taskforce was created. So this is the organization that fights against money laundering, now terrorism financing, now proliferation financing, now to human trafficking, etc., etc. And the discussion 35 years ago was how to deal with Pablo Escobar, who was dealing or selling drugs and making loads of money, and he could not be stopped. I think we have the same discussion. How can we stop cyber criminals? And the FATF, or the G7 back at the time, what they came up with is that let's have the regulation, money laundering, anti-money laundering regulation, that, okay, Pablo Escobar sells drugs, but what if we take those drugs or the money away from him, that he couldn't use the money, so then the crime does not pay. So we need to fight from that angle. I think the discussion is the same here 35 years later, that we are still hoping that we would somehow fight the criminals, the cyber criminals, and educate more people. No, we just need to take away the money from the cyber criminals so that the crime would not pay.
Yeah, absolutely. If you look at the criminal, they are like good businessmen. I have yet to see a millionaire or a billionaire who, for 100K investment, made only 10K in return. This is not the route to become a rich person. It has to be the other way around. And if you either increase the cost of crime or decrease the revenue, you are actually breaking that chain.
Yeah, the history has a tendency to repeat itself, and but just listening to you, I felt at some point a little bit terrified, thinking of the first case which might happen sometimes in the nearest future, where let's say me and my team in my everyday work, we detect, for example, we detect market manipulations and illicit trading in stock markets. But what if we detect a case and we discover that it's purely run by algorithms and AI and ChatGPT, and we have nobody to send our invitation for coffee? That's maybe not a good situation, as the algorithms are already trading. But our time is running up. We would have much more to talk about, but considering the lunch coming, I would maybe conclude this panel here and give an opportunity to our listeners. We might have time for 1 or 2 questions. So please, if you have any questions, we would gladly accept them.
There's one hand over there.
Yep. How do you see someone? I don't see anyone. I see just...
Hey, I'm Taavi Tamkivi, also crime fighter. I'm trying to be optimistic here in terms of like how financial innovation actually can make life harder for the cyber criminals. So Mari-Liis touched on this a bit, but like, what do you think about? Okay, the financial innovation is creating more layers and faster payments and like this more complex schemas, which is true, but it's also creating many more data points, like about the money, or like if money is getting moved or criminal procedure getting moved. I think if we compare, it's hard to measure, but if we compare like a number of data points that each euro had 10 years ago or like 50 years ago, then now there are like many more data points stored in different places, in the crypto space, in the banks, in different places. So maybe we're just in the short term, like a weakness period where we are not able to use these data points well enough, or these are not gathered. Or what's your thought on this? Like, actually, do you see the light in the end of the tunnel that actually with this greater amount of data points around each stolen euro, actually we all together we're able to build a better technologies also to stop financial crime, cybercrime?
First of all, yes, you're right. It all begins the quality of data where you get your input. You have to know exactly where your sources are, and your data governance should be mature enough. But as I said, ChatGPT, yes, helps to automate some processes, but not anything. Today we can see that there are some processes where we can automate it, but yes, we cannot only rely on this automation tools. There must be a human between the system and the chair. So yeah, we cannot right now. Yeah, I agree. It's not possible to automate everything.
Okay, I don't see any more hands, and that's good because our time is up. And thank you again for listening, and I hope you enjoy the lunch. That was professionals against cyber criminals.
Thank you.
Thank you very much. Thanks, guys. I was going to make a joke about, and now for our next panel, but you extremely concretely announced lunch, so I will keep myself very short. Yes, we will have lunch again behind the screen, then walk straight and then to your left. We will expect you back at 1:15, so a slightly shorter lunch than initially anticipated. But we're looking forward to the next 2 panel discussions afterwards. We'll talk about the digital euro, we'll talk about unicorns. Have a nice lunch and see you back then. Okei. Lihtsalt igaks juhuks. kõik on hästi, kõik on valmis. You can see that the curtain is coming back down, which means that we are also back in session. I hope that you had a lovely lunch with a nice poke bowl, some nice dessert and refreshments. Before I introduce the next panel to you, a quick reminder with regards to the Mentimeter that we have in use. You've got the QR code behind me. You've got the access code as well if you want to enter it directly on the website. And please share with us your opinion on what were the most important discussion points today. Sorry, I should probably get out of the way. And so yeah, please use that before the end of the event. Without any further ado, let's talk about the next panel discussion. So after a 2-year research phase, the European Central Bank decided to move into the first part of the preparatory phase, which is another first part, effectively, to lay the foundations for a potential digital euro, as we know. And so this includes finalizing the rule book, selecting the providers that would develop the platform, the infrastructure, and so on. And the focus of today's panel will be about the opportunities that fintechs can find within the digital euro and how it potentially might disrupt the current value chains as well. For that purpose, we have a lovely mix of academics, of start-uppers, from the inspections and the European Central Bank. Please welcome to the stage Professor Dirk Draheim from TalTech, John Helge Egerson from Monerium, Karel Kudu from WISE, Kilvar Kessler from the Finantsinspektsioon, Markus Hertel from the European Central Bank, and your moderator, Veiko Tali. Welcome them to the stage.
You have possibilities to change? No, I don't know. It's over here. Got it. Thank you, Florian. Good afternoon, everybody. It seems we will have a very difficult task to keep our auditorium awakened after lunch, but we have a real opportunity to succeed. So that we have a very interesting topic, very concrete topic, and we have excellent panel, as you can see. So basically, the plan is following. First of all, we will start with Markus from European Central Bank, who is speaking, telling us what is digital euro, what is the situation with this project. Then we will have a round of opinions, discussions, and then we will have some second round, and finally, hopefully, we will have very interesting questions from the audience. Altogether, 50 minutes. And let's start. Markus, please tell us what is digital euro, what is the situation with digital euro project now in European Central Bank. You have been deeply involved here, and also maybe more specifically where you see potential opportunities for innovation and fintechs. Please.
Thanks, Veiko. Happy to be here. You see the title is Evolution or Disruption. Up to you at the end to decide. What I can tell you, the introduction of the digital euro is kind of the biggest thing we have done since the introduction of euro cash. That's a bit the dimension, because it will affect every one of us, it will affect every merchant, it will affect every citizen, and it will be next to cash. At the same time, as mentioned, it is next to cash. So you can also see it just as the next step, as the evolution. So what is it? What are we talking about? We are talking about central bank issued money, very important for retail payments. You all will have heard about digital currencies for wholesale. They are experimented in many countries with a purpose. The European Central Bank and the Euro system decided to go for retail first, to really have this outreach to everyone, to cater for every citizen, and to bring something to the table which every citizen can use. So the idea is really to give a payment instrument to the people of Europe, to enable them to pay everywhere. Most of you say, okay, I can pay everywhere. What's the point? What is he selling here? You might be able to pay everywhere, but try to travel to Frankfurt. You will find many shops which only accept the national debit card issued in Germany. They will not accept your Visa or MasterCard. Even in a taxi it can happen. You can rely on cash. Maybe you have no cash. The digital euro will be something where our goal, our aim is to give you an instrument at hand where you can be sure that you can pay with every merchant in the Eurozone, be it POS or be it e-commerce. If you want to shop with a Dutch merchant, which currently only takes Ideal, you will be able to pay with digital euro if you want to. If you want to is a very important point. We will not force anyone. If you love cash, continue loving cash. Most German citizens love cash. Austrians are even worse. And you are free. You can also continue with PayPal if you prefer it. It will be an additional offer next to the other ones, but it will definitely strengthen European resilience. Because if you think about the point, what happens if US-dominated payment service providers would stop their offers in Europe? It would be very dark in payments. There would be hardly anything we can do. There would be no online payment. There would be hardly any POS payment. Some countries still have their domestic card schemes running, but yeah, only some of them. So that's the other big point. Next to making payments easier and reliable for citizens, strengthening the resilience. In which way do we want to do this? We want to do this by offering a big choice. So on the left, you see the core use cases covered. So P2P payments, POS payments, and e-commerce. So what people usually do for payments. Again, we are not doing wholesale. It is not to facilitate payments between merchants. It's not to facilitate DVPs for big investment companies. We have a pilot running in the Eurosystem also for wholesale, but it is far, far behind. We are currently, today, talking only retail. How should you do this? That's the very important second part, the connectivity. We all know pay by tap. We know online payment. But what is very important for us as a project is this very tiny point there, offline payments. It's something which really will distinguish the digital euro from any other thing you know currently. Because to get really close to cash, the idea is to have something which even works if all the other infrastructure breaks down, where you can still pay your neighbor, where you can still for a certain time period pay your merchant, without any reliance on any other infrastructure. So really, genuine offline payments. That's something we want to ensure. And this, the rest is just giving you all the choices you will have. So it will support QR code. It will support NFC, really to give big flexibility for everyone. Where do we stand? The lovely introduction already hinted at it. We just concluded our investigation phase. The Governing Council decided we will move to the preparation phase. And you see there is no end date here, meaning we work very hard to deliver in as short time frame as possible, but bear with me. Most of this room have a FinTech background. You know IT projects, and you can get an idea about the scale of our endeavor. So it is very hard to estimate really the final day, but this is what we can share so far, that really the next phase is now for the next 2 years. Then the Governing Council will make the next decision point. There is no decision yet whether or not this is going to be issued. This is not decision yet made. Still, we are preparing, we are looking at things. It is likely, but is not yet decided in any way. So briefly, what's in for you? Why do we do this? We do it to make offline possible, to cater for resilience, to cater for digital financial inclusion. It will not be a problem of this room, but we talk to many consumer protection agencies and representatives. Current digital payments are not really inclusive for elderly or people with disabilities. We want to address this. We want to give this highest level of privacy possible. So we really work on something which has privacy by design. So even if you would put a gun to my head, we had these cyber criminals and all the other criminal people here as well on stage. If you put a gun to my head, I would not be able to tell you what your holding is. This is what we want to do, that it has privacy by design. The central bank and any kind of government agency does not say it. Of course, always respecting AML considerations. This will be the balance we have to find. It should be a good bargain for a merchant, and you should be able to travel. But this is what's in for you as individuals, what's in for you as fintechs. Yeah, as well, something. The idea is to have a basic service. What we want to enable the market is really to build value-added services on top of the digital euro. What we also want to address, currently, e-money providers and payment initiation providers have no access to the back-end infrastructure. The digital euro settlement infrastructure will be designed in a way that from the start on, EMIs and PIs can get access and can be directly interfacing between the customer and the digital euro. Because the Europe's euro system does not want to deal with you. This will be a job of licensed entities. They will provide you the interfaces. On top, easy switching. Switching from one provider to the other should be as easy as changing your phone number. Simply to have this competition in the market, who offers you the best deal, that's the one way you go. And it shouldn't be a hassle. It should be really easy. You just file something online, I want to switch. You keep your ID, you keep your DIN, and you move along. And that's also pointed out at several panels today already, you have instant customer base. You have an instant merchant base and you have an instant customer base because it's a product offered all over Europe on the same basis. So that's in a very short nutshell what we did for the last 2 years and what we tried to come up with. I hope it made it also clear for those not yet fully familiar with the digital euro. It's a huge endeavor, and I invite everyone to follow us on this journey.
So, whether it will be evolution or disruption, you started with that.
Yeah, everyone has to decide at the end. For me, it's an evolution. But it is an evolution as we invite really, and I think that's what this last slide should also show. It is everyone is invited to come with us. We do not want to push out anyone. We do not want to challenge the current structure in the market. The players there should have their gain, and we want to extend these market possibilities, also especially with fintechs in mind. That's why we deliberately said from the beginning on, EMIs and PIs as licensed entities should be able to be the face to the customer. They should not necessarily need to rely on any credit institutions.
Thank you, Markus. Let's turn now to Turk. Maybe in the broader sense, how this digital euro project looks like from the point of view of potential of CBDCs altogether, and where you see whether it will be evolution or disruption, or whether it depends on what conditions, and what are the potential for innovation and fintechs, please.
To answer your question proactively, so evolution or disruption, evolution with a high innovative potential. Why not disruption? Because the term disruption has been, I mean, overused in in the blockchain area in the past decade, I would say, and is again overused in the Web3 community currently. Central bank digital currency, CBDC. So what is it? It is definitely an M0 money. It is not just another electronic payment system organized by the central bank. We have seen such successful initiatives. In India, we do have the UPI, the Universal Payment Interface, UPI. I have been in India in June. It's amazing. The adoption rate is amazing. So it's used by everybody, everywhere. And it's so easy. So I have been on the Arabic market in Delhi, right? You have shops that are just 2 square meters. It's basically a table standing in the sand. They're selling some specific goods, and it's paid electronically. It's paid with UPI. So, but it is an electronic payment system. It is organized by the central bank. So what you need to use it is a bank account. So when you want to use it, basically you need to have a phone number, and your phone number is connected to the bank account. And why that works is because in India, your identity is connected to your phone number. Even for tourists, when you want to have a prepaid card, it's connected to your ID. You need to show your passport. So, but the adoption rate is great. So, and that brings me to the point, what is the advantage of a CBDC systematically? We can consider this in 3 fields maybe. This is about the transaction costs. This is about the privacy or anonymity, and this is then later what the panel actually is about the innovative potential for products and services. So when it comes to the transactions costs, of course, you know, it is a question about how much fees we want to pay and where it is paid. So basically, it's about lowering the transaction costs. It's an immediate advantage, as you know, and also where it is paid, right? So it is paid maybe on, not to some company in another country. So there are the immediate advantages of that one, but you don't need an M0 money for that. We see this in India. This is the example. Yeah. I mean, when it comes to anonymity, in privacy, it's completely different, because it is per definition so that you want to break free then from the M1 tier and the bank accounts. You just want to do it genuinely without the need having a bank account. So imagine the refugee crisis. A refugee is coming. You would give him some welcome money. You can do this today only with cash, because the refugee has no bank account, and he wouldn't get one because he has no passport, he or she. So CBDC is an M0 money, and for anonymity you need a M0 money. When it comes to the innovative devs for product services, again, of course, adoption rate and basic payment is of course an immediate effect. And I said with UBI we have seen that it works. You don't need necessarily M0 money for that. But when it comes to the deeper innovations, when you want to have a programmable, what has been called a smart contract by Nick Szabo, and what's currently discussed as smart contracts in the Web3 community also, you won't have all that with established technologies and an established technology stack. So that brings me to the next point. You know, we want to have seamless and effortless integration in today's services. So the real adoption opportunities is about to have it effortless. Yeah. So you need to break free from the current stack, how it is organized. And it is, yes, it is often said it is not about technology. It is not only about technology, but it is basically about technology, and critical and significant, and that is actually the institutional design. So in the sense of institutional economics, Oliver Williamson, of course, yeah. But as a whole, it's a huge engineering effort. You need to care for the institutional design as well as for the innovative technologies to make these things happen. And if that all is orchestrated well, then you have the opportunities to get all these small. I mean, you have seen all the initial coin offerings in the last decade. It has been thousands, and you just need to look at what the innovative potential is imagined by people, but they didn't take off, by the way. So all those and beyond, seamless and effortless integration in all the processes that you currently see in e-services, right? That it's a huge potential. Mm-hmm. It's amazing too that something like that is started now. Yeah.
Okay, thank you, Doug. Very, very interesting. This Indian experience. It's very scalable. But okay, let's turn closer now to the industry. Let's say, Carl, what do you think about the digital euro? Is it useful for?
Sure.
Or why are you going to use it?
So yeah, we had some discussions in Wise, like, so how would we use this, or what would be the benefits for us, and then, like, by and large, like, we've been facilitating international payments for like more than 10 years now, and we see that customers mostly care about 4 things. So you have the speed of the transaction, you have the cost of the transaction, then you have the convenience, like how fast can I do it, like how many hurdles do I have to pass to set up the payment, and then of course the coverage, meaning where can I use it. So I think what Markus covered in the beginning here as well, like there is understanding how the coverage, like potentially with offline payments, will be like increased from what, let's say, for example, card payments or SEPA transactions can allow, and then, of course, like the speed will come down a lot to what Dirk was talking about is the technical rollout of this, which is going to be, yeah, it doesn't have an end date, and for a good reason. Like, this is going to be the hard part of it, because today we see some, let's say, Bitcoin and some other, let's say, crypto transfers taking up to 15 minutes and sometimes longer. But people are already used to instant SEPA and instant card payment, so it's like, okay, so where's the innovation there? Like, we're slower. So that's something that has to be like really planned through the technical implementation phase, is that, okay, we want to actually launch something that would be minimum as good as the other options on the market. And then same comes like the cost side of it, I think is still like pretty unpredictable. So, but it has to be like meeting some criteria so it wouldn't become more expensive. So I think like if we keep like these 4 kind of core customer needs in mind, like, because eventually there has to be like, you know, somebody in Estonia, somebody in Belgium, somebody in France doing their everyday business, thinking about this as their first method. Okay, of course I'm going to use this. And how do we kind of get from this phase to, okay, so it is actually meeting those customer demands. And I think still the key there is just understanding these 4 key elements and making sure that it's set up in the best way to actually kind of meet that. Of course, like there will be like some other challenges along the way for us. Like we, of course, and this was very happy to hear Markus already covering this, is what we've seen across the world. Like, so we are integrated to 70 odd different payment rails, going from instant to not so instant, and then going from direct access to like having 2-3 middlemen in between, and what we've seen as well is like some new payment rails that are taking care of maybe the instant part and also to some extent the speed part. They've been launched in a way where you still have to knock on the door of one of the big banks in the market to get access. I'm very happy to hear that we're already considering direct access for everybody, because I think this is where the true like gateways for actual, let's say, product improvement will come from, because as long as you have still like a select few controlling the access to the end product, it's going to be very hard to achieve actual kind of, let's say, fast innovation, because it's still going to be down to the speed of the existing players in the market, let's put it this way. So that is like very, very good to hear. And that, of course, like will enable the fintechs integrating to this work a lot faster on the end customer like offerings as well. Whatever else on top of payment facilitation might this enable in the future.
Great, thank you. You mentioned coverage, speed, cost, convenience. What about reliability, resilience? Is it important?
That's kind of already taken for granted. That should already come out of the box. That the downtime should not really be there. Whatever double settlements, etc., should not be there. So yeah, that is definitely. And of course, there is the security angle of it. Can I trust it? Can I trust it? Do I know that by using this, the money will actually make from my account to point B, and I understand also that point B has actually got the funds in their account, which of course is kind of what all this kind of trust is actually based on. So yeah.
This is one of the ideas of digital euro, provide additional resilience and reliability. Okay, great, thank you, Karel. We will have time to come back for certain issues, but Jon, what about evolution or disruption? But the digital euro is something which is doing more, let's say, good things or creating some kind of risks, or in what extent, in your understanding, it's fitting to the development of the technology and private sector providers? And can you, let's say, share your view? But before that, maybe you will describe how Monerium is doing and what is the main business of Monerium.
Yeah, well, Veiko, thank you, and thank you for having me here. It's great to be in Estonia. This is the world champion in unicorns, 10 unicorns. That's really an achievement. And I was thinking, why is it that there is so much creativity and innovation in Estonia? Estonia used to be a part of the Soviet Union, where everything was centrally planned. You had central government, and maybe there was this unleash of creativity after that collapse. I don't know. But you asked about Monerium. I come from a country where the whole banking system collapsed in 2008. All of the banks, all of the major banks. And I was living in the States at the time, and the problem with that when a banking system collapses is that you don't have access to your money. That is the main problem. And this is what, the US Fed in 1913 tried to solve this when they established the Fed. They wanted to basically make sure that there was no need for a bank run because they want to be the bank for the banks, right? This year, the Silicon Valley Bank, there was a bank run, just an old-fashioned bank run, right? So it hasn't succeeded. So when I saw Bitcoin in 2008, in October 2008, then I thought it was a fantastic innovation. Not very useful for everyday payments because I don't know what it is, it's Bitcoin, right? But then I was part of the, shall we say, cleaning department of the central bank in Iceland, taking care of the banking collapse. And then Ethereum was introduced, and then I saw an opportunity basically to change the system in a way that you can get rid of the intermediary. You can basically issue regular fiat currencies as tokens, but under the European regulation, which was introduced 23 years ago, the e-money directive. And the e-money directive is basically saying that we want to issue, or we want to regulate a digital version of cash. So digital euro is nothing new. Most of the money in Europe, the money supply in Europe is digital euro. And when banks, they settle between themselves, it goes through a central bank, right? So that's one form of a digital euro. So what we thought when we saw Ethereum in 2015 is that, well, we can basically issue fiat currencies under this fantastic regulation, which is the European e-money legislation. Make sure that there is consumer protection, anti-money laundering, and know your customer, know your transactions, and all of that. So we set out to do that. And we actually, it took a long time to basically build a system to make sure that we comply with the regulation, because the technology is one, but there are requirements in the law saying, what you have to be able to do. And then the system has to fulfill that. So we were the first company that basically got the license, and we became regulated to issue fiat money on chain. So we issued the digital euro already in 2019. As a token. And you just have to be a customer of Monerium to basically get the digital euro. And then in recent years, then we also integrated with the SEPA system. So now, basically, there is no friction. You can go back and forth between the SEPA system and blockchains. We support multiple blockchains depending on the need of the customer. And there are all kinds of needs to support innovation, okay? So this is Monerium. We issue the digital euro, and there is no monopoly of the term digital euro. It's not, in my mind, it's not something that the European Central Bank is pioneering. This has been for 23 years in Europe, a digital version of CAS. There's nothing new about it. When you asked if is it a development or a revolution? So CBDC can be many things to different people. In my mind, then, I think it's important to understand that, like in Estonia, there is competition, which is driving progress. If we don't meet our customers' demand, we will go out of business, okay? And others will take over. If the central bank goes out of business, it cannot happen. So I'm always concerned when there's a central governmental body like a central bank which wants to compete with the private sector. And if the central bank is offering, their own wallet, it's basically turning into a kind of a software house. Then I ask, okay, so is the private sector really going to compete with a central bank, which can make all the money they want, which is going to regulate their competitors, and they're going to oversee them? No. This is not the way to facilitate competition. And I started this by saying that Estonia is a remarkable place because it has created so much innovation. And it has had a ripple effect throughout Estonia, but also through other areas in Europe. And that is what we need. Actually, since you're from WISE, then Monerium is supported, and the investment in Monerium was led by Tavet and Sten from Estonia. Mm-hmm. And this is a private sector trying to make sure that we do it as best as we can to nurture innovation. And I'm really concerned if the central bank thinks, and I say this as a former central banker myself, if the central bank thinks that it's the role of a central bank to compete with the private sector, no. But the central bank has, of course, a big role in all of this. And the central bank should facilitate competition, but not be a part of the competition. And there are many ways to do it. And a CBDC can be a part of that. But the central bank has to be very mindful about its power not to stifle or discourage innovation. Europe has now, the economy of the EU compared to the US is now about 65% compared to the US. It was about 91% in 2013, and the gap is increasing. And then we have another central banker, Mario Draghi, which wrote this report, How to Increase Competitiveness in Europe. Well, you have to decrease bureaucracy. You have to lower the barriers to enter. So we should be mindful of that. So that's why I'm really concerned about if the central bank is going to go competing with the private sector. I hope not. We had a discussion, Markus and I, yesterday, and I think there are many things, in many ways that the central bank can facilitate this and be helpful, but the central bank has to be really, really mindful what they do. Sorry for the long answer.
Thank you, but maybe Markus, you will have a reference about this.
I would love
the PPP
to
project. Project, of course, and it's a public good. You have roads, of course. There are risks, of course, maybe not very distortion of competition, but it can be handled. I think so. You want to?
I would love to take at least one point of Jon, because I think it's very important for the audience. You said rightly, if a private company goes bust, you phrased it because you did not meet the customer demand, it's your fault. But if it goes bust, in most cases, also the money is gone, which you have with a private entity. And that's also the same in the e-money directive, because it is backed by deposits, but if we have a major crisis, they might also be backed. What we designed here is something which is central bank money. As you rightly said, a central bank usually doesn't go bust, meaning this is, we call it the monetary anchor. It should be the trust by the people in the monetary system. Like today, you can take cash, you can put it under your mattress. Maybe not the best idea, now that I know how many evil people are here in Estonia, but you can now take then digital euro. That's the equivalent, kind of. And, but also be assured, we do not want to compete on a competitive level with the private market. We want to build a basis on which innovation can happen.
Yeah, sorry, yeah. You want to, let's say, reply, but...
Just very short.
But very shortly, yeah, please.
So Markus is saying that if Monerian goes bust, then the money goes with it, is wrong. That is the beauty of the e-money legislation. It's different from commercial banks. Because you, as a holder of the e-money, you have the claim on the underlying fund, not on Monerian. So it's totally different. It's more like a narrow bank, in a way. And we are obliged to keep it in high-quality liquid assets. And what we have been promoting, and many people, including economists from the IMF, have been suggesting, is that e-money issuers should be allowed to hold the money in the central bank, and in that way, it's even safer. It's safer to hold the money with Monerium than most banks.
Yeah, so these changes are already planned, if you know it. Be state free that e-money issues can hold.
I think that would be a benefit, yeah.
Yeah, so it's, sorry, Kilvar, you have heard a lot.
No, nice discussion.
You have a lot of questions, I suppose, yeah, of course, but what is your conclusion? Whether we will... The last panel before lunch, there was a question about whether the benefits are higher and damage, what is, and whether, what do you see from the point of view of supervisor, or let's say maybe potential user of digital euro, let's say, where are risks, where are opportunities, how we can combine it, how we can design all these opportunities and risks, and what is the role of supervisors in this process?
Thanks, Veiko. Yeah, indeed, I mean, Markus was like explaining the point I wanted to start with. So, what's the difference between the digital euro? As I understand it, it's something which is issued directly by a central bank, or in European or Eurozone case, European Central Bank, versus the cards what we have, and when we are using them, those are just claims against the credit institutions or other financial intermediaries, and they can go bust any given moment. But of course, we do our best. That will never happen, but still it can happen. So this is the major kind of, I would say, architectural or structural difference between the digital euro and then the bank-issued money, so to say. So the second thing, which is more the kind of starting point from my side, is the Estonian banking structure. If we are looking at the savings accounts, So the retail saving accounts, I mean, the vast majority, number-wise, of them are way less than 3,000 euros, the balance of them. So majority of Estonian population have very little savings accounts. And then if you look at the distribution of those savings accounts, they tend to dominate the smaller banks. Now, and of course, the risks and opportunities, what I'm highlighting, they are subject, of course, to change of the technical and legal setup of digital euro or any other central bank currency. But my sense at this very moment is the following: like a couple of risks and a couple of opportunities, as Veiko was proposing. Though the first risk is that, of course, if the digital euro is introduced, the question is now how the retail customer behaves. Probably very many customers will move out of bank savings accounts because they offer anyway zero. Okay, now we are increasing the interest rates, but they are offering anyway the zero interest rates. So why should I keep my money with the bank if I have more safe, so to say? It's more psychological, but still digital euro. And how this affects smaller credit institutions. I mean, they have to refinance themselves somehow. And then they kick into wholesale markets. Then the question is that, and it's reality, wholesale markets for micro banks, like Estonian smaller ones are, basically are inaccessible. We have seen it in the MREL case, the bank recovery resolution stuff. You have to issue MREL instruments, very difficult for smaller ones. So first of all, digital euro, I'm not sure, but I have a gut feeling that it somehow affects the banking market, the structure of banking market. Whether it's positive or negative, I'm not sure. Maybe it's a leeway to even more concentration. And I'm not sure whether it's good or not. The second point, and it's kind of, it's a derivative of the first risk, is the liquidity risk. If something, if there's a hearsay that something bad is going on with one or another bank, it's very easy for people to get their money out to the safe haven, so to say, the digital euro. So the liquidity risk may be, this instrument may amplify the liquidity risk. And then the central banks should be ready to provide liquidity assistance. And then we again face the potential problem that maybe some, especially smaller banks, their credit portfolios are not ready. They are not, ready to be collaterals for the central banks. So liquidity risk, second. And third, operational risks, we call them like that. And then on the operational risk, you have technological risks. It's basically what is the software, what is the setup, what are the incentives of central bank to keep the software up to date? Because the technology is, it's light speed development. You have to be all the time up to date with software developments there. Technological risk, privacy risk, you were already saying that, more or less it's handled. And then flip side of privacy is AML. I mean, if we are very private, if we are, making sure that the digital euro is very private instrument, then in turn, there could be additional window open for, the bad use of this type of money. And then the risks, I stop here. Opportunities. And I see like 1.5 opportunities, starting from half opportunity. It's the inclusion, financial inclusion. I mean, it's not a big problem in Estonia, but sometimes we see that banks are a little bit, I would say, over-conservative when it comes to servicing consumers, even basic services. And then digital euro is a nice kind of balancing act to lower the bank's appetite, so to say, not to take risks on board. And the second, which is the full opportunity for me at least, was already mentioned here, the offline payments. For example, if something happens in Estonia or in the region, the hot payment systems doesn't work, so to say, don't work, then maybe the digital euro is some kind of temporary solution there to keep economy running in times of crises.
Right, thank you, Kilvar. We still have some time. I really want to give opportunity to somebody to ask the questions before we will. Yeah, please. Piinastatakse ära kapost.
Markus, you stressed very much the usage of the digital euro in in-store environments as well. And you mentioned it should be probably a chip card, and it should also be possible to do offline. I mean, we have probably, I don't know, 10 million payment terminals in Europe. Do you envision that all this gets replaced or updated? Who's paying for that? What is the motivation for the merchant? I mean, this is a big building block of, I think, the whole model you're creating. I would really be curious to hear more about that.
Well, thank you for the question to Markus. Do we have any other questions? Yeah, there.
Yeah, maybe because it's related to that, my question would also be, what is the incentive actually for merchants to adopt it? Because like there are many other forms of payment, right? I mean, you could actually pay with e-money, as we have discussed before, right? You could pay with PayPal at the point of sale if you want to. It's a bit cumbersome, but it would technically work. So my question is, what is the incentive for merchants to adopt it?
And question is to whom?
Also to Markus. Yeah.
Okay, poor Markus. Somebody else? Last question? No, okay, thank you. Then Markus, you are overwhelmed, please.
No problem. Let's start from the back. If you are a merchant, I'm not sure if you ever sold something on eBay in the old times when eBay was still linked to PayPal and you sold it at your merchant capacity, you encountered the dramatic fees PayPal is actually charging merchants. And luckily, we are not alone on this digital euro front. We are accompanied by the co-legislators, so by the European Commission and by the Parliament and the Council. And only in October, the Commission issued the first draft of the digital euro legislation, together with a draft strengthening the role of cash. And part of this legislative draft is also a cap on the prices you can charge regarding a merchant. So the idea is that you have a market-related fee, but at the lower end. So that's the incentive at the end for the merchant, that the merchant knows the digital euro will be relatively cheap, especially compared to the likes of credit cards or PayPal, if we think about it. At the same time, it also stipulates the merchant has to accept it. That's one of the strongest instruments you can have. But overall, please be assured the whole considerations about the business model, about a sustainable business model for all sides of the market, because we're not only talking merchants, we also need incentives for all the distributing sides, be it classical banks, be it new fintechs. They also need to make a living. They also need to be incentivized to distribute the digital euro. So we really have to square this circle in the way that we find an equilibrium in terms of all incentives for both market sides. Payments is a duopolistic market, so it has to work. And one of the things how we intend to achieve this is that the euro system takes the share of what they do. So the back-end settlement infrastructure, which should be provided by the euro system, will be provided to the market for no costs or no additional costs associated. This means there is a certain leverage that even with a lower fee attained at the merchant side, if this is then transferred to the issuing side, it still should be possible to find an equilibrium. But you've seen the timeline or the indicative timeline. We are still at the beginning. We worked very hard for 2 years, but there are still many, many open questions. The business model is one of them, but I'm very confident that we will find something, because otherwise the digital euro is dead, honestly. If I do not convince the issuing and the acceptance side that this is nothing they will become rich on, at least not on the basic service, but at least something which takes the cost and gives a small margin, otherwise they will not accept it. If we think about value-added services, which should come by the market, of course, they can be charged also towards the client, where there is additional potential for revenues. So that's the idea for the overall business model there.
Thank you, Markus. We are already in red, as you can see.
But they cheated. They gave us 5 minutes less.
Yeah. Have you fixed it?
Yeah, it was 45, and we got 50.
So still, we have some 3 minutes. So my question is, whether somebody from the panel want to ask from each other something or to comment something which is important to know, let's say, to the panel, something which is unclear, something which is important?
If no, please, I don't want to cut off anyone, but I loved Jon's four points, what things have to fulfill for you, because I would say we tick many of the boxes with the digital euro. You have the customer base, simply because it will be offered by any PSP and every merchant will accept it. It is instant-based, though we are not talking about 15-minute processing time. It is comparably cheap. For you as an end user, the basic service will be for free. And for a merchant, it is, yeah, as explained, relatively cheap. But I forgot the fourth one. Help me, please.
I also spoke about the speed of the actual kind of, let's say, transactions.
That's instant.
Yeah. So, but also, like, let's say, like, based on today's technology and what's out there, like, it still takes a bit of effort to actually make sure that they will be instant. And then you have the cost side of it, the customer convenience side, and the coverage of, like, where and how can you use it.
By the point of coverage, I forgot one of your questions. I'm very sorry. You asked about the POS terminals. A very fair point. We're doing intensive research on it, how to best bring it to the POS. And you have to see we can leverage the time frame until we finally issue. The current life cycle of a European terminal is between 4 and 7 years, then they get replaced anyway. So if we go out early enough with our specifications and what we want to do, we hope that a lot of this can be leveraged in the normal update cycle. And for the rest, there will be some remaining ones we will have to see. This is not yet decided.
Okay, thank you, Markus. I think anyway, even you said we had 5 minutes cheated, then still we have maybe some 25 seconds left. As I understand, all of you said that it's not disruption, it's evolution. So basically, we answered to the question of the panel. And of course, it's difficult to predict what is happening after 15, 20 years and how this CBDC, let's say, framework or ecosystem is looking like all over the world, globally. Whether we will have CBDCs, let's say, communicating and making cross-border and cross-currency transactions with some agreements between central banks. This is definitely difficult to predict, but this is one possible development. And what is also very, very clear that some risks, which Kilvar mentioned, Jon mentioned, that about the involvement of central banks and balance between have impact the competition, let's say, and the role of the provider of the public payments system. These are definitely which we should address in the further process. Yes. But unfortunately, we have to conclude. Thank you. Let's see, maybe when the next FinTech Forum will happen next year or next
tomorrow.
Tomorrow.
Every day
okay.
we have FinTech, development going on.
Okay,
and
so
if you are considering to, establishing your headquarters in Estonia, in Tallinn, please pay a visit to Finantsinspektsioon offices. We are always open.
Yeah. Okay. It always, even during night. Okay. So thank you, everybody, and let's see what's happening with this project. Thank you.
Thank you very much, gentlemen. I hope that you will not lose your German citizenship over these 5 minutes over time, but we'll send our best to the German embassy in Tallinn. Sorry. This actually brings us to the last panel discussion of the day. we've heard many references throughout the different panel discussions and keynotes with regards to the Estonian unicorns. I mean, even around the world, I would say that unicorns are very rare, but also quite interesting creatures. And I'm very glad that we have the representatives of 3 unicorns on stage with us today. We will talk about things like what happens when globally dominant tech companies suddenly flood into the financial sector? What role does regulation play? If data is the new oil, then why do my co-founders' Porsches not run on data just yet? And what is the strategic decision making and the situation of Europe in the global competition for innovation? So here to have a chat about all of this are Kristjan Okas from Bolt, Svetlana Minina from Wise, Victoria Rube from Verif, and your moderator Kaidi Rusaleb from Thunderbeam. Please welcome them to the stage.
Just in the center, please. Good afternoon. And very pleased to be here at the conference, talking about the regulation with unicorns. 2 out of 3 are not regulated entities, and this is actually the topic what we want to discuss and touch is whether tech companies that have nothing to do with financial services and regulation are stepping on the toes of regulated entities and stepping on the toes of traditional banking and banking services. What's the good balance of regulation and not regulation? And we definitely talk about totally new asset class, starting from data. So if I mention you the names Apple Pay, Grab Pay, we were just talking about digital currencies, Libra is a name, and then Google Finance. These are huge, large global tech companies that all of a sudden decided that it's a good business strategy to start offering financial services. And we have Bolt here on the stage, and Wise and Verif on the stage, and we actually started with you, Kristjan, and Bolt. So Bolt is in how many markets?
About 50, let's say.
About 50, right. And you have massive approach to clients and a lot of clients and client data. And I know a couple of years ago, you also touched the point that maybe Bolt should open a Bolt Finance, right? So what's the thinking behind global unicorns all of a sudden deciding to go to financial services? And do you think it would be beneficial for you?
So, of course, we will have lots of fantastic ideas, but the question is, will they get implemented? So, at the moment, let's say, future for us is still in mobility sector. Mm-hmm. Maybe something extra will come out of this, but let's say we are a bit cautious. We want to do our thing in excellent manner. And let's say starting a brand new, unrelated business line is absolutely risky. It needs new know-how, and of course, it has a steep learning curve. So let's see what the future brings, but nothing certain at the moment.
So for you, when you think about new services and going into the new services, you have a clear focus, which is mobility. And every service that serves the mobility is part of your business, and what's outside is like you decide to keep this opportunity door closed.
Yeah, no. So let's say we want to keep our business lean at the moment. Yeah. So this means if we want to get some good service outside of Bolt, we'll find someone who knows their thing and they're specialized on it. So let's say we are betting on being lean. Okay.
Verif and clients identification, right? So what you plan to do, you are already identifying customers and solving the problem of KYC AML. KYC AML is a very small, from KYC AML is a very small step to financial sector. So in Veriff, when you build your next strategies, do you also discuss about maybe it makes sense to go to financial sector because you already serve some of it?
Talking about Veriff is business-to-business service provider. So when we look at the financial services, we partner with the company in financial services to help them to meet their KYC and AML requirements. So for example, with Wise. So for us, this is still part of the strategy. But you know, comparing to where we've been 5 years ago and where are we now, so the as our customers are growing, businesses are growing in terms of the services they are offering, we're kind of growing together with them. So the company is going global, and KYC requirements in each and every jurisdiction, the regulations can be translated quite differently by each and every market. So for us, what we are looking at the identity is how we can help the financial services sector, you know, to become global, to meet those requirements, to offer the user experience that is seamless, but that meets the regulatory requirements of the specific market. And this is where we're standing in terms of the identity verification. So for us, it's rather partnering and working together than providing the financial services to the end users. But financial services as such, like, also been part of the big tech. Before, for example, I've been part of the Facebook and Meta. So just giving that aspect, seeing how WhatsApp has been expanding into financial sector, it was just looking at opportunity. So the first financial service was offered in Brazil in WhatsApp. And because, why? Because people didn't have an opportunity to make a payment. So going sometimes not as the core strategy, but as an opportunity because you see the gap in the market is also part of those big techs moving into financial service sector because the need is there. Financial service companies cannot solve it. And already big tech has all has an all access and knows the identity of the user, and then they can actually just plug it in the service and provide that as well.
And they have resources to build it, right?
They do have the resources, and if you think about, you know, is it a core business or non a core business, resources are there, and it's also the customer base is quite massive, so it becomes quite natural. Because, for example, Amazon Pay, when they integrated the when Amazon integrated Amazon Pay, they managed to improve the conversion of the purchasing card by more than 30%, just by integrating these. So it's like a win. It's win for the user, it's win for the merchant, it's win for the business, and it's like extremely naturally integrated into the user experience. And plus it drives the revenues. You can monetize it really well as the big tech, and you have the resources as well. It's always a question if it's a core or if it's, you know, if it distracts the business. But with the resources and opportunity, it's definitely on the table.
All right. So we're coming closer to the sector itself, right, Wise. So when we think about the story of Wise, you basically started as a currency transfer provider across the globe. Now you have your own banking card. Now you have B2B business. Now you have partnership with Switch, right? So where do you see and how do you see the power play between fintech companies and really unicorn fintech companies and the mainstream financial sector?
Yeah, it's actually a very good question. So are we basically enemies or are we friends? Yeah, and I think what is important here is to know what is your mission, yeah, and Wise is really keen and passionate about what we're doing, yeah, and our mission is actually really simple, as Karel just mentioned, just provide our service fast, instantly, transparently, and eventually free. And this is how we look to any expansion and to any additional services is whether they will help our whether we can help with them to achieve the goal for our customers. Yeah. And yes, we have built a wonderful global network for money movements across the border, and eventually now we're focusing on building the unique infrastructure for banks and larger businesses so they can use our infrastructure to help more and more customers to get the access to our good service. It's like actually a closed cycle, that how we get to the idea of let's build Wise platform and let's integrate banks into Wise, is that the Hungarian bank staff were advertising Wise to their customers because they were not able to get the right service. And this is where our initial idea were born, that, yeah, why not help banks as well to get there.
Where do you stop? Where does Wise stop? Because you go and you take the parts of the banking value chain.
Our mission is not yet solved, unfortunately.
Here we are.
Far from that, but we are doing our steps, and we will continue till we have energy and force to do this. And we look at everything we have. We've touched AI today and other different ways as a tool. Yeah. So this all is a tool for us to achieve the goal, and we will keep going.
Okay, you mentioned AI, so I'll switch two of the topics what we're about to discuss, because when you think about the new assets and assets that didn't exist 20 years ago, data, as we mentioned, is a massive, massive asset. Millisecond is a massive asset. It's like huge trading companies are ready to pay hundreds of millions for having 1 millisecond faster line. And now we talk about AI, we talk about ChatGPT and all of it. Now, if we take all these new assets and put it in the hand of tech companies, huge global dominating tech companies, and talking about AI, you mentioned, where do you see tech evolving in using AI?
Yeah, I think there's no way now to fight against AI. AI is here and there, and we just need to find secure ways to iterate with each other. Yeah. So for us, AI is the tool. Yeah. So it definitely can help with automation. It can help with the data, big data points, but at the same time, again, don't forget about the problem you are solving, and don't fall in love with each new tech piece that is on the market, but if it's helpful for the business, yes, let's do this in a secure way, but if this particular one is not helpful, then keep searching for the one which will fit the purpose.
Because one of the panels previously during the day was the question about this cyber crimes and the tech in the hands of villains. So also tech in the hands of tech companies actually makes the life of customers better, right?
Yeah, exactly, yeah.
Okay. An interesting point what you mentioned in building digital identity, and I know that Veriff's big goal and dream is to build like a global digital passport, right? While Veriff is owning such amount of clients' data and clients' identity, right? So when you think about what you possess, the power what you possess, and you at one point maybe have the assets that some autocratic countries have, do you feel the responsibility, and do you feel also that the tech companies are totally entering into the government's field, which is passports, identities?
I'll have the question, and I will start from breaking the myth that we are possessing, owning a lot of data and customers' users' identity. Because we are building the digital identity, and our core product is identity verification. So it's literally making sure that the document that the user is using and the person that is using, it's a match, so it's not a fraud. So the identity and the credentials, they still belong to the user. So we process that data. The concept of digital identity is, and this is why I actually really love working on this, which goes beyond of having this data owned by government, or owned by some companies, actually giving the power of owning the data into the hands of the users. So it's data privacy, where users have their digital identities, digital ID. They have an access to their credentials, basically through the wallet, and this is what this European Union is building with AI. That's the 2.0 EID and the European wallet, where you can see who is using your data, you can track the usage, you can see who is accessing it, and you can give an access in order to use any service you want in the platform. Is it a financial service or non-financial service? And you can also revoke that, based on the agreement between the user and the business. So in that sense, owning the data is not exactly what we're doing, but we are facilitating different data that the digital credentials that is, or credentials that is using the government or other institutions. And we are helping to make sure that this data is in good hands, there is no identity theft or any kind of breach, and that the user can securely and safely use that to access the services, and that the financial institutions, for example, meet their KYC AML requirements and also protect it from fraud. So that's what we do. But the power of data and is massive, and there is this like good AI and bad AI. This is what they're saying like that. This is how the future will look like. So the data is needed. I think the data, large sets of data, to find the patterns, to understand where, like if the fraud is happening, if it's one company can see fraud patterns only within their data set. So we are working with global companies, financial services, non-financial services, like mobility, gaming, globally. So having that anonymized data and those data signals and those patterns help us to understand like where's the network of bad actors is happening, and actually do this cross-linking of anonymized data and give the companies the signal that that's a bad actor who is trying to access your services and so on. So I think using the data is necessary. And I think talking to the users through the user research, users understand that, but they want to have understanding of why the data is used, how the data is used, and how they can revoke that data. That's the most important thing. If people do not understand that, then it's a very hard sell.
So owning or actually processing data, or processing data, both. This means also responsibility.
It means definitely the responsibility, and it means having, complying with all the regulation and requirements, but also having all the internal processes to make sure, the cryptography is there to secure the data, privacy by design is there, interoperability, and kind of, that's definitely.
Excellent. We'll soon talk about regulation, but go into AI and machine learning and all this, what machines can do. So we've all, I think there's nobody in the audience who haven't used Bolt services, right? So AI and machine learning, is it to service really better the customers, or do you milk them, by selling them much more services, much more whatever you can offer, and also because I know the way you work, you very seriously take the GDPR, right? So is owning the data a curse or responsibility again?
Opportunity, I'd say. So yeah, let's say it's a multi-layered question, and yeah, we are using preliminary tools for processing our, let's say, internal requests already in an automated way. And let's say our end goal is getting our processes so in line that we can streamline them globally. So let's say if we can cut out some middleman, some additional work by using digital tools. So this is definitely something we are doing. Now, regarding the data. So I think we have stated quite clearly what data we are gathering and why. So yeah, if you take a look at our public documents,
yes,
then yeah, fortunately or unfortunately, you won't see, let's say, offering you a personalized offers. In the future, who knows? But let's say there are more burning questions or more important questions having more business value that we are currently handling.
So, I mean, because I'm both using Bolt markets and I'm using Bolt and I'm using Bolt in all the countries where I am, then you, in a way, can put together a picture about who am I. So that's... But you don't do it.
No, actually not. So we take data protection like very, very, very seriously, and our privacy team is top-notch. So if they see something they don't like, they will be knocking on your door. So yeah, sorry. We have absolutely no idea about a general picture of you.
Good.
So yeah.
All right, and now we reach to the regulation and the role of the regulation. So those who haven't yet read, and it's quite a new book, maybe a month old, Michael Lewis just released a new book called Going Infinite. It's a book about FTX and Sam Bankman-Fried. And he started to write it, I think, 2 years ago, and now ended with this kind of blow up. But the story itself is amazing. Everybody should read it, especially regulators, to understand how some of the companies can be run. But when I read the book, I started to think, would this company have been saved if they would have been properly licensed and regulated? Because what they've done, they totally messed up two assets, client assets, and then Sam's personal investment vehicle, Alameda Research. There's so many layers in the story. But the question, what I want to ask from every one of you, the good balance between the regulation and the services, the technology, because again, when we go to FTX story, then the way they built a trading with the futures and on the futures was quite novel. So there's not only the bad side and the good side, there's something interesting and innovative as well. And maybe starting from Svetlana, because why is it regulated? And why is it regulated for the payments in Belgium and then investment firm in Estonia? So regulation and innovation and technology, how do you match it?
I think we are matching this well, and we see how regulators can help us to achieve our goal, and we are totally happy to follow regulations if it will make our customers' life more safe and secure, and innovation the same, so it's not, they are not fighting with each other, so it's how to find this balance between being innovative, but as the first panel moderator told, like we're playing the cyber games being teenagers, so where is this balance, where you just being innovative, doing something out of curiosity, and where it's already crossing the legal boundaries, and that's why it's really important to have a clear, transparent regulational framework in place, and the type of dialogue that we have currently today, and in general, it's really helping to get us there.
You have two type of journeys entering new market, because the company started out of UK, so UK license, then European license. But when Wise, I remember when Wise entered US market, it was under somebody's umbrella on the license Wise. But now it's like full licensed business in US. So why this step instead of being like fully regulated?
Where it's possible and where we see that it will, it can reduce the price for our customers, then we are going and asking for the license and trying to cut the middlemen in the process. And actually really good that currently we see more and more direct access integrations as well with the payments systems. So not only banks now can have the direct integration, and Wise was the first not bank in UK who got the integrated with the faster payment scheme. So it's all helping us to get to a more instant, cheap and convenient service. We use all the opportunities. And again, kind of interesting that now banks are using us as their sort of service provider as well, using the Wise platform. So it's the one ecosystem where we're all working and hopefully friendly.
So the trust is actually a good combination of an excellent service and a proper license.
Yes, it should be trust for someone. In order to get the trust, you need to have a license. For someone, maybe not. But we still think that the regulatory framework should be in place, and it will help everyone on the market.
Christian, for Bolt, you mentioned you're in more than 50 countries, and it's not about financial sector, but Bolt is also operating in quite regulation-heavy areas, because there's one regulation in London about the taxi, and in New York, and then different countries, and there's local regulation and central regulation and all of it. So if you think about all your markets where you're in, what's like the best combination of a good balanced regulation and innovation tech services, or innovative tech services?
Oh, that's a difficult one. So from one hand, I'd say any cooperation with the public authorities is a must-have. So we would have clarity how, when, and why we are operating, and being transparent what we're doing. So we want to create value by offering services, not cutting down on regulations or skipping something entirely. And let's say, from my point of view, trust is essential. So let's say if we know that if we have something in the gray area, we can go and ask and find a solution with authorities. That's the way to go. But let's say if you're already in the zone where we know that if we ask this question, there will be something coming towards us. So that's not a really good approach. So balance. Let's say we definitely don't want to see overregulation, and we definitely want to see trust, and this goes like both ways.
Going to you, balance between the regulators and the innovative service, because we mentioned identification, and identification being the domain of the governments, right? So how do you feel when you develop, and do you think about the regulation, and do you kind of try not to step on the government toes, or this is somewhere goes, because also the governments need some disruption?
I think the previous panelist said like really well, it's about the balance and keeping the balance, because regulations are needed, collaborations with the regulators and with the governments are needed. So in order to create that layer of identified digital identities that other companies can use, we need governments to do their jobs really well, right? So they need to innovate from physical document to the digital document so that we can actually digitize more the services. The innovation by regulators that was accelerated by the COVID, where the remote digital onboarding became a norm. Before that, in some of the countries, many of the countries, it was a norm. You needed to go, to the bank and do your identity verification, and a human being was trusted more with identifying that you are the right person and you're not a fraud than like technology and then machine learning and AI in a way. So in that sense, the balance, the kind of this collaboration is important, and we see as partners rather than trying to step on somebody's toe. It's important to have a dialogue, because fintech companies, tech companies, we have a lot of insights in terms of like what's next and how these technologies can actually help to also meet the regulatory needs, but in a way disrupt it in a way so that they still, we don't have the FTX situation, let's say like this, but we still can innovate and move forward. So for example, the conversation around decentralized digital identities in financial services, where again, the data is not stored centrally. So we're solving the issue of identity theft and a data breach, and who possesses somebody's identity and data. But in order to offer this decentralized digital identity and that financial services, for example, can use them properly, regulators actually need to innovate as well, and they need to accept, and the governments need to accept. So it is a collaboration. It needs to be a dialogue, and I think there is a way to learn from each other and actually kind of shape the innovation together, like what's next, and shape it in a way that we understand together what it means, but companies not going like literally crazy and doing whatever they want.
You actually touched on a very interesting point, and this is the last thing what we discussed, what we'll discuss on the stage today. What's in this game for Estonia? When we talk about regulation and what can we do in Estonia and what can we regulate or attract or not regulate to be in this competitive game, because in the world, not only companies compete, but the governments and regulations compete. So identity and Estonia and the regulation.
I think it's not, kind of becoming like really still and not moving forward. For example, a really good example, in digital identities, we are solving for KYC outsourcing in financial services. And we looked at certain markets where we can go and solve that, be that facilitator between one financial institution and another. We looked also in Estonia. And the rules are quite rigid, so we could not actually experiment and provide that service for financial institutions. But the number of countries out there where we could, where it was like, there is a framework, there is a legal framework, so it's not, again, Wild West, but within the framework, companies are given, based on their risk appetite, to decide how they work within the framework to meet the KYC requirements. So like US, UK, even Finland, Sweden, Brazil, like in so many countries, there is this innovation happening where you can go and you can start develop the services that actually help to offer better services for financial institutions, better user experience, like operational efficiencies, more innovation, less fraud. And here we could not offer that because we could not navigate with that innovation within this regulatory environments. And I think it's really important to keep your eyes open, learn, and actually adapt, and also like within the regulatory environments that will actually make companies, global companies, to launch that innovation in Estonia.
Bolt and Bolt services, what should Estonia do that companies like Bolt are born and grown and scaled globally out of Estonia?
Okay.
You are the largest osaühing in the whole world.
We're going into politics, eh? I'd say predictability is the key factor here. So let's say if we start something new and interesting, we more or less know that in 3 years' time or 5 years' time, let's say the conditions, how we can get talents here, how we are paying taxes, how we are presenting some kind of reports, this will stay more or less same. Okay, there can be some slight deviations, and that's absolutely okay, but I mean, nothing drastic. So stability is one thing. And of course, let's say if we have some regulations from 30 years' time, maybe we should overlook them and, let's say, open our economy to a world even more.
So the cooperate matters, and actually sometimes not to rush to regulate, let the market regulate, and then introduce the best practices through the laws.
Yeah, I mean, the market is usually one step ahead of the regulations.
Yes.
So let's say if we can take a minute and analyze what's going on and see what is the minimum essential regulation that will keep this industry alive. Yeah, that would be okay. But if we start over-regulating, it will create more problems, more loopholes, more confusion, and let's say predictability, stability will suffer because of it.
Okay, and Svetlana, with you, will actually raise up to European level because Europe has introduced this beautiful passporting, licenses passporting system. Has it helped or has it not actually helped because we have 27 countries still?
Yeah, it's a good question. Actually, it will, I think, eventually help a lot, and we are really keen for harmonization and synchronization across the Europe countries. But here is a big but. Yes, still there is a lot of challenges, and like, for example, marketing campaigns could be treated differently in all the jurisdictions across Europe. Yeah, taxation is different, and sometimes it can create for the companies, I think, sort of fake safe feeling that now I can act across the Europe, and I have one license, I can do what I want in each of the countries, and it could hit actually badly if they afterwards will find out that, okay, actually in this country there was the stamp duty, or there was this or that piece which no one were looking for. So yeah, kind of it eventually will help, but if it will be a fully harmonized, which I think is hard to achieve, that's why companies need to be really careful making kind of expansion decisions. Yeah, so consult and consider all the risk on the local markets, even having one centralized Europe license.
So there's the European harmonization, but in real life, it matches with cultures.
Yeah, and even examples of how different governments interpreting the same unified law we have in Europe. It could be kind of different country by country. Yeah, so that's why don't do any assumptions that, but go and double check, and it will be more secure.
Excellent. Let's see if we can smash into the cultures of very engaged Estonians and get some questions from the audience. Because really, there's nothing to be seen from here, but if you have any questions, we're happy to take it. If not, then luckily we're the last panel, and you can approach people on the stage and ask questions one by one. All right, I think we'll conclude the day. So thank you everybody who stayed in the audience and listens what the global unicorns and technology people have to say. And that's it, right? Yes!
Yes, I don't know why I'm coming on stage anymore. You already did a lovely wrap-up. Okay. It does say wrap up behind me, and so that's what we shall do. For me personally, it's been very interesting from the start actually to the very end. We've talked about the classical regulators versus fintechs. We've talked about what the European Union is working on these days. We've talked about cybersecurity. We've talked about unicorns as well. I hope that for each and every single one of you, both here physically and also with the digital audience, there has been something that you will take away from this. I hope that we will have given you enough food for thought to spark future discussions, potentially some collaboration. We've heard a lot about more dialogue, more dialogue, more dialogue. So let's make sure that that dialogue actually also happens. Before I wrap up, I would like to extend a small thank you, forwarding it from the Finantsinspektsioon. Could we ask Mari-Liis Cook on stage, please? Yes. So she's been the mastermind behind all of this, and we have a tiny thank you to be presented to her. We've got hugs, yay. And that actually leaves me with the final few words. Thank you very much for being here. We see that some people had to leave because they do have very busy schedules, but thank you so much for staying with us until the very last discussions. We hope to see stronger collaboration, more dialogue between the Finantsinspektsioon, between the different stakeholders from the private and public sector, and we hope that the fintech ecosystem, both in Estonia and abroad, will only be strengthened over the next couple of years. Thank you very much for coming, and have a lovely day. Thank you.